All right, welcome everybody to day 2 of the 2026 TraderLion conference. Super excited to once again have a fantastic lineup of presenters. Day 1 was excellent with Jim Ropel, Peter Brandt, and Pradeep Bande sharing a ton of knowledge and experience with us, and day 2 should be no different. To kick things off, just a few reminders. Again, we keep this 100% free. And one ask that we do have in return is if you do find the presentations valuable, to help us share this resource with your friends, other traders you know. And a great way to do that is by scanning this QR code, sharing it on Twitter, and you can also click the link that should be popping up in the chat or is in the description. So again, if you're able to, please go ahead and share this with folks who might be interested and find it valuable as well. Here's basically the schedule for day 2. Kicking things off, we've got Ariel Hernandez discussing the puzzle pieces of profitability and performance, really getting tactical, going through a ton of examples, not just showing you the concepts, but showing how to apply them as well. That will be excellent. Then at 12:20, we'll have Brian Shannon, one of my absolute favorite people to talk trading with, an excellent educator and trader, discussing Anchor VWAP and the golden rules of trading. And then at 1:25, and this is going to be really special, we've got more of a laid back panel with Matt Caruso and Jason Shapiro. Matt is obviously a fantastic CanSlim trader, top performer in the USIC. Jason Shapiro is a market wizard with over 30 years basically of experience in the markets. And they're basically going to discuss they're going to compare and contrast their different styles, discuss what holds true overall, what are the principles of trading, and what really matters to achieve success. So another fantastic lineup. Let me know in the chat right now who you're most looking forward to learning from on day 2. And again, Ariel at 10, Brian Shannon at 12:20, and Matt Caruso and Jason Shapiro at 1:25. Huge thank you to our sponsors, DeFu, TraderLion University, and the Trade Lab. A little bit about each. We're currently running the DeepView sale. This is my go-to platform for screening, charting, idea management, and we're going to be adding a ton of additional features this year, including a journal, trade analytics, and getting into agents and a lot of fun stuff that helps us become more efficient in our routines. So with the summer sale, we're currently offering a special deal on your first year of DeepView. You can check out the link down below in the description for the details, or visit deepview.com for the annual deal. Moving on, we've got the TraderLion University Summer Sale, 25% off any masterclass of your choice. Let me know in the chat right now if you've taken a TraderLion masterclass. What did you think about it? Would you recommend it to others? Again, we have fantastic resources across the board, from swing trading to position trading to the psychology aspect. There's a great class that can help you expand your knowledge. So I highly recommend checking out these options over at TraderLion.com/university and use code SUMMER for that 25% off. Moving on, I also want to mention my educational service, which is the Trade Lab. This is a daily report, but it's also much more than that. With it comes a lot of built-in resources that basically help you teach yourself how to build your system and refine your strategy. We've got the Building a System course, which comes included, helps you walk through writing your trading rules. We've got the Trade Lab Bootcamp, which I know many of you guys have taken, which walks step by step with a dedicated webinar on one aspect of trading. So whether it's sell rules, whether it's position management, whether it's journaling, there's a webinar dedicated to that subject that can help you basically dive deep into your process. And each month I also do a case study on one market leader from the past and distill those characteristics and how we can apply that going into the future to basically find the next batch of market leaders. So again, I recommend checking out the Trade Lab. And if you're interested and want to learn more, basically just email me at richard@traderlion.com and mention Trade Lab conference deal, and I'll go ahead and send you some additional information. All right, so I know I'll get this question today, so I figured I'd just mention it right off the bat. Will this be recorded? Yes. You can already actually scroll back on this same URL and rewatch. So it'll be present on this URL even after today ends. And you can already rewatch day 1 as well if you missed it or want to revisit Jim, Peter's, or Pradeep's presentation. So yes, this is recorded. And if anybody asks in the chat, please just kindly say, yes, it is being recorded. How to get the most out of the conference experience. There's a lot going on here. So the best way to do it is in pieces. So we'd highly recommend subscribing to the TraderLion channel so you always know where to find this resource. Join the VIP pass with a QR code, which will include the slides. We're setting up the resource right now. We'll be basically letting you guys in and getting access set up early next week. And basically you'll have access to all the presentations, all the recordings once they're available, all the slides, everything organized in one place for you. I'd also recommend engaging in the chat with others and with the speakers. Share notes and key takeaways on X. I saw a great, great bunch of notes yesterday on X. So great job on that. I think taking notes is the best way to learn, and I really recommend writing things down instead of typing them up on a computer. For me personally, that just helps me internalize the concepts that much more. Typing is kind of one step removed somehow. So I highly recommend taking, notes and then maybe transcribing them over to a Google Doc or wherever you want to store it in the digital world. But definitely recommend taking notes and sharing them on Twitter if you can. Then again, this is all recorded so you can rewatch your favorite presentations, and hopefully you get even more golden nuggets the second time around and even more the third time around as well. So again, just a reminder to unlock the VIP pass. It's 100% free. Click the link down below in the description. It's also pinned in the chat, or you can basically scan this QR code right here. I also mentioned, if you're looking for more additional free resources, we have plenty over at TraderLion University. We've got model books, we've got historical studies, we've got the ultimate screening guide, the beginner's guide to stage analysis, so much packed into one place. Again, 100% free. Just go ahead and scan the QR code and go ahead and create accounts, and it'll be all right there available to you. Each year we partner with a charity. So not only are we putting on this conference, but we also are trying to pay it forward. And this year it's a little bit more personal for me, the cause that we chose. Earlier this year, my grandmother, Grandma Jackie, passed away from complications with Parkinson's. And basically this year I want to pick a cause that would help do research to help others who are impacted by this disease, whether you're the person who actually has it, or it's a family member, a dear friend, whatever the situation is. Paying it forward with a donation can help treatment, help us, deal with this devastating disease that impacts over 1 million Americans, and really can negatively impact their quality of life. So I recommend, researching this cause and donating if you're able. Even $10 is great. And here's a photo of my grandmother, my mother, and my aunt right here. We raised an enormous amount, yesterday. Let's keep that up. So if you're finding value in the conference, again, help pay it forward with a donation towards Parkinson research. The way to do it is over on the right-hand side, I think below the chat, but also feel free to ask in the chat if you can't quite find exactly where to donate. But I highly encourage you to do so if you're able. One other thing to mention is not only do we put on this conference each year, but we also have plenty more to offer on the channel. The TraderLion podcasts, in-person interviews. I'll be doing additional ones later this year. You guys seem to dig that. Tutorials, free webinars, key clips. It's all located right here. Our goal is to make this the best possible resource for serious traders to learn and expand their knowledge. That's our goal. And our long-term goal is 1 million subscribers to help 1 million traders. But in the short term, help us reach 200K. Go ahead and look down below. And if you are subscribed, awesome. Thank you so much. But if you're not, go ahead and click that button, 100% free, and you'll have access to all those resources that we're building for you. All right. And with that said, thanks so much for attending once again, day 2 of the TraderLion conference. Super excited for our lineup, and we'll be right back. But with that said, sit back, relax, get your notebooks ready, and enjoy. All right, welcome back, everybody. It's my pleasure to introduce the next speaker, Ariel Hernandez. He's going to be discussing the puzzle pieces to profitability, discussing how to build your trading system from the ground up the right way. Ariel is a full-time trader. He's the founder of Market Pulse, and it's a pleasure to have him. So, Ariel, thank you so much for being here, and appreciate you taking the time.
Thanks, Richard. Thanks for having me. Yeah, this should be tons of fun, and hopefully talking to some newer traders, aspiring traders, and kind of setting them on the right path.
Let's do it. Let's dive in.
All right. So I did go ahead and I've been asked a gazillion times, and you and I have spoken privately. When you're talking to a brand new trader, it can feel pretty overwhelming because how do we say this? There's so many things you need to know, right? And I kind of call them non-negotiables. But if you try to learn everything all at once, it can feel very overwhelming. And the way I kind of like to view things, and I view the stock market this way too, it is just a big puzzle. And the more you know, the more the broader picture, the whole puzzle makes sense. But you can't start by learning everything, or effectively you'll learn nothing at all. You have to start by digesting and ingesting little bits at a time, effectively small puzzle pieces. And like a puzzle, when you put it together in your mind or on a table, you pick up a piece, you see where it fits, you see how things click together, and you can't complete the entire puzzle in your head without knowing these individual pieces, or as you and I both know them, non-negotiables, right? Things such as how we might scan the market, how we view relative strength, what sort of technical setups you use to get yourself involved with a stock, what proper position sizing looks like, what progressive exposure looks like, how you might trim into strength if you trim into strength, how do you trail your remainder of your stocks. And so a lot of these things, if you try to learn it all at once, it feels very overwhelming. And every single year that you do trade, you always have that light bulb moment, that aha moment that, I didn't know that. I can't believe I trusted myself to trade without knowing that whatever that thing might be. And so I kind of wrote this ebook and turned it into a little bit of a presentation for us today. And hopefully we'll go through some of this, and this will help some people make some sense of the market.
Perfect.
Yep. And for anybody who doesn't know, I am Ariel Hernandez. I've been swing trading now for just over full-time trading for just over 6 years, swing trading since the start of 2022, about the worst time that anybody can become a full-time swing trader. Markets were obviously super incredible in 2020. Everybody knows that we were, driven by monetary policy, just money being created and printed and flooded into the markets. Everybody kind of had to sit at home. A lot of people became traders. Not everybody stayed as traders. And that is the unwillingness from some people to kind of sit back and learn when market's environment change, how to keep the money you've made, and then, sidestep a bad market. And it's not like I sidestepped a terrible market. I decided to become a swing trader in 2022. So I effectively stepped right into a bad market, but fortunately, and you've talked with some of these people before, some people that I absolutely admire, from a Stan Weinstein to learning Bill O'Neill and some of his tactics, through some of the people who have learned from him, like a Pat Walker, momentum, from a Dan Zanger or a Mark Minervini, taking concepts from all of them, applying it to my own trading is what got me through. And then the market has been pretty incredible, late 22 and obviously into today. Recording June 17th, and we are basically in the best market that anybody has ever seen since 1999. So it's a blessing. But
at least since 2020. At least since 2020.
It was a little bit different in that environment. The difference was, what was going higher were NFTs, and what's going higher now is on the back of billions, hundreds of billions of dollars being spent. In fact, Google raising an extra $80 billion just so that they can fund their growth in the AI space even more. I remember in 2020, you had meme stocks, right? You had COVID stocks, unprofitable biotechs flying. You had your TCAT and your DLPN, unprofitable, people paying millions and millions of dollars for photos of a JPEG rock or a monkey, where this is much different. It feels in some points a little bit overdone, but what it really is fueled by hundreds of billions of dollars of real money being spent by the biggest companies in the world. So a little different. And obviously, before we started recording, you and I were talking about how today felt a little odd with, rates unchanged, markets getting hit, in particular the mega caps, a lot of them living underneath their 50-day and their 200-day. And, they're innocent until proven guilty, but today definitely wasn't a pretty look. But we try to not, think about that too much until it comes into play.
And I'm sure one of the puzzle pieces is the market analysis, situational awareness. It all plays into exactly what you're covering today.
Yep. Yes. And one of the things that we don't want to do is operate, and we'll get to it. We don't want to operate, and some people have kind of seen me tweet this recently. It's not what you buy, or even sometimes where you buy it. Those can be very important, but it's the when you buy, and understanding that your environment ultimately trumps everything you're doing in the market. If the market is no good, and that's not to say that individual stocks can't perform well in a crummy market, but if the environment is no good, the market will let you know, and it'll let you know through the feedback that you're getting on your individual position. So we'll kind of move on here into this next slide, and it's how the pieces fit together. I'm sure I could have come up with more than 21 pieces. I'm sure that if we talked about it a little bit longer, we could probably find 7 or 10 more pieces to talk about. But it's effectively your foundation, your selection, your execution, your management, and your survival. So you have to, it's hard to find the winning stocks that could be winning stocks if you don't know how to scan the markets. So, and then it's hard to get yourself to hold a position if you oversize. But again, as a brand new trader, these are all things that we kind of have to learn. And instead of being overwhelmed with all of the things that you have to learn, we're going to try our best to break it down into individual pieces so that it doesn't feel too overwhelming. So with that, let's talk about the foundation, which of course, Richard, as you mentioned it, read the market before you read the chart. It is incredibly important. And the first foundation or foundational piece would be risk on versus risk off, reading the market environment. And then I put here 75% of stocks, and that's typically, and I say that because it's majority of the stocks that we're going to be trading, growth names. A lot of people aren't necessarily, and I guess to this, before I continue, if you're trading a gold stock, I don't care that the S&P 500 is coming down. I'm focused on GLD or gold futures. If I'm trading cryptocurrencies, I don't care that the NASDAQ is going down. I'm focused on maybe Bitcoin or Ethereum or any other one of the cryptos that might be moving. And so when I say if you're focused on, and if you're buying an energy stock, oil and gas, what crude oil is doing is important and maybe has zero to do with the NASDAQ. So, and I would say half of your stock's price appreciation is directly correlated to the group that it's in, but even more so, it is correlated to the underlying market as well. So majority of your stocks move with the market. The biggest lever to your own P&L is reading the market regime than it is picking the stocks. And it goes back to what I mentioned earlier. It's not the what you buy and where you buy it, it's when you buy it. if you had been going through the correction and the choppy phase, which was, middle of October, November, December, January, February into March, and then all of a sudden, ends of March, you start to get Marvell, acting better, ARM acting better, Dell gapping up on earnings, hanging in there well. And we could even look at some of these charts quickly. When you go back to this period here, let me know if you can see this well, Richard.
Yep.
Okay, so this is ends of February. So the market is still acting poorly, yet Dell is gapping up above all key moving averages. It's giving you a big pickup in volume. That's certainly not my Aunt Susie. And then it's beginning to digest while the market continues to be choppy. You could see this even when you go back to the correction in 2023, which is one of my favorite corrections. It was just the simple 3 waves down in the summer. I won't forget it. This would have been right here. So it would have been this simple 3 waves down correction. And then right when you got this market follow through day going on November 1st, and then you look at a name like Netflix, you look at ANET, you look at DEC, you look at AMD, you look at Uber, right around that time, 5 industry groups, I won't forget it, right at that time, at DECK was gapping out, and this would have been right in here, effectively into a new all-time high when the market was still going through a correction. And then Netflix, I won't forget this one. This one proceeded to double right from there. And this would have been in, let's go back to 20. Here it is. So this thing gaps back up above the 200-day. And while the market continues lower, this thing is just going sideways. And that is one of the most important things when you're trying to find the stocks that are showing relative strength. And we'll circle back to this topic again here momentarily. You want to be understanding of what the market is doing and how stocks typically act in that environment, because stocks have a hard time going up when the market's going down, but the stocks that are holding up best when the market had been going down are the names you really want to focus in on when the market environment starts to shift and you get what is known as that classic Bill O'Neill follow-through day. So simple, very simple exercise. Risk on. Your index is above your 50-day. Your 50-day is above your 200-day. Typically, breadth is expanding. We saw that big time in April. Names that are offense, semis, software, growth, right? Anything tech-related tends to be when tech is leading, when the QQQs are leading the move up. That, for me, is risk on. Risk off. Indexes are below the 50-day. Breadth is contracting. Usually, you'll see distribution days, so bigger volume on the down days. On the up days, it seems like the volume just kind of dissipates. Although, let's not mistake low volume rallies for rallies that cannot be durable, because, again, we saw that from April 8th of this year on, you could absolutely have a rally on low volume. And then everybody doesn't believe that the rally's real. What's most important is you have group and stock participation. And once you have that, in particular, some of your XLK, which is, let's say, 30% of your S&P 500, acting well, you almost can't be negative in that scenario when you've got growth name after growth name after growth name trending higher. So that's super important.
Yeah, and just to add here, completely agree with this. And I actually wrote an article kind of looking at the case study of the last April 2025 correction, where obviously we had the big sell-off due to the tariffs. And basically, I think my opening point was, what was the greatest opportunity coming out of that correction? And the main point was that it wasn't picking one stock that doubled and tripled from there. It was getting aggressive when we reclaimed the 21 EMA, the 50 SMA. Like you said before, it was about when you kind of got aggressive, not necessarily the single instrument or group of stocks that you were focused on. If you got aggressive at the right time, it almost didn't matter where
what you bought.
what you bought, that natural breadth expansion at the start of a new market cycle, it's going to lift all boats. So it's more about being open-minded to a rally working, getting on exposure while managing risk, because that's obviously a huge part. You want to protect yourself if a rally fails, but not, you got to risk stuff to actually participate in an uptrend. And we saw that last year in 2025, and then this year in 2026. Like you said, low volume rally, nobody believes it's going to work, but the stocks were telling you, the setups were telling you, and that's why we have to have a market cycle system, which is, I guess, is your point here. You got to know when it's risk on versus risk off, and that, I think, is. I'm glad you led with the slide, because I think it's the most important component of trading. And it might take a year or two, multiple cycles, to really internalize that, when to get aggressive and when not. And you learn something new every cycle too. The little tells, deck gapping up, and you learn more over time.
And
but yeah,
it
just want to
wasn't
add that.
just
Yeah.
deck, Richard. It was, and you go back to 2025, you go back and look at when stocks went and made a new low in March, and stocks really washed out through those March lows, except a few.
Yep.
Your CrowdStrike, your CLS, your Robinhood, your Palantir.
Yep.
I remember I bought Palantir at 100. It doubled. I bought CLS at 100. It more than tripled. I bought Robinhood in the 50s. It went up almost 200%. Now, I, for other reasons, got shaken out of Robinhood and then didn't buy it back, due to earnings. But it almost didn't matter what you bought. It's more about recognizing the shift in the environment. And, most follow-through days tend to fail. But that's also why you have to have, and you have to know what progressive exposure looks like, what proper position sizing looks like, so that even if you are caught on the wrong side of a follow-through day, it doesn't really do a lot of damage to you. But if you get caught on the right side of a follow-through day, that's the market saying, hey, this is working, go find something else. This is working, go find something else. And all boats are being lifted. Everybody feels like a genius in a really good environment. And that's exactly what the market tells you. Immediately after a valid follow-through day, you get stock after stock after stock after stock really going to work. And that, I think, is super important to be paying attention to. And all of it really ends up stemming from the feedback in our own portfolio, really irrelevant of what you buy, so long as you know how to find the quote-unquote needles in the haystack, and you are paying attention to names that are showing relative strength. How do you do that? Well, you do that through scanning, but the easiest way of doing it is what stocks are less than 20% or 15% or 10% from an all-time high while the market is going down. That's a pretty big tell. If a stock is going up over the course of 30 days, when the market's effectively going sideways or down, that's relative strength. If a stock is sideways when the market's down, that's relative strength. If a stock is up if the stock is more up than the market when the market's up, that's relative strength. And then when the market's getting absolutely hammered, but your stock is down 1% or 2%, again, that's relative strength. You do that over the course of 30 days or 40 days or 90 days, what you have there is likely a chart that's gone up and then is just consolidating. And the more the market gets beaten up, and that's why, as a swing trader, I welcome corrections. In fact, give me the worst possible correction ever, because we know that from those ugly corrections come periods of awesome, low volatility, swing trading, and then they all stem from a market follow-through day. So yeah, understanding risk on, risk off, what that follow-through day might look like, and then what stocks you're looking at after, during, and just before you get that valid follow-through day is important. But I think finding relative strength is not nearly as hard as I think some people make it seem. Or you and I both, having studied a Mark or Bill O'Neill or Stan Weinstein, those are the stocks that, they just stand out all the time, right? And I say this as well, even if you missed SanDisk from 40 to 200, as soon as it goes sideways 7 weeks, party's back on, right? It's like the momentum on these things are up. They stop and they take a breather. and then they continue higher. And you welcome a deep market correction because that just makes the leaders that much more explosive when you finally come out of that corrective period. So with that kind of leads us into industry and sub-industry groups, and this will be your foundational piece number 2, hot. And then what I want people to do is to think in themes, not in tickers, right? Because if you sit there and you find a chart and the chart looks great, but it's in a weak group, I would tell you this. I would rather own the worst fundamental company in semiconductor space April 8th than I would have owning the strongest food stock, right? Or home builder, right? Like if you own Toll Brothers, great. They're the best acting home builder. But if you owned the cruddiest semiconductor on April 8th, you did much better than the guy who bought Toll Brothers. And it's simple. You have to think in themes. Again, half of any stock's move is explained by its sector. And then if you're not focused on stocks within the top 40 groups, which is almost like a universal thing for anybody who's a canceling trader, you want to be focused on stocks within the top 40 groups. So without it, you're just like not bound to fail, but you're bound to find less stocks that make big moves, which
you're swimming against the current a little bit.
Exactly. Yeah. And like I said, I'd rather own the worst semiconductor I'd rather own the worst stock in the strongest group than the best stock in the weakest group. Stocks, they don't move alone. They all move together, and they tend to move. Just think back to last year. It wasn't just Oklo. It was Oklo. It was SMR. It was NNE. It wasn't just Rigetti for the quantums. It was Rigetti and IONQ and QBTS and QUBT. They might be like these unprofitable, unproven businesses, except they all broke out of big bases and they all doubled. And it's the same thing. You've seen it with the neo clouds. Has it just been HUT moving? No, it's been HUT with Wolf and APLD and NBIS and Cypher, and they're just all moving together. Was it just AMD? No, it was AMD, ARM, Marvell, Intel, for the semiconductors, equipment, and materials. Is it just ASML? No, it's AMAT, it's KLAC, it's LRCX. Was it just SanDisk? Nope, it was MU and STX and WDC. These things move in groups. And so identifying themes and groups is much more important than identifying a nice chart setup. A lot of times someone will ask me, hey, what do you think of XYZ chart? And the first thing I do, if I don't know the company right off the top of my head, I go and look at what group they're in. If they're group number 97, I don't care. Right? Like, it's a decent chart. You can draw a pennant, but congratulations. It's group number 97. The odds that this becomes a failed breakout go way up just because it's group number 97. If it's group number 3, now we're talking, right? Now we're talking. And so that's really important. Think in themes, not in tickers. Money rotates in groups. Semis run together. Home builders will run together. Uranium names will run together. It's happened since the dawn of time. It'll always happen like that. Institutions, they put money to work in baskets. And I always think back to, not that I didn't already know this, but when Stan Druckenmiller was doing an interview one time, he said, he tells the guys at his trading, who will buy stocks for him. He'll just tell them to go buy it. And he said something, Milei got elected as president. And he is like, oh, this is going to be super bullish Argentina. He told the guys on his desk, go buy me the 5 most liquid Argentinian stocks. He didn't say which 5. He didn't sort them by fundamentals. He just said, buy me the 5 most liquid. Well, he's not the only family fund with a few $billion to run. And so when Argentina becomes a theme, they allocate to just the whole theme, right? MELI and YPF and GGAL. Like, why does a bank and an oil stock move together? Well, they're moving together because it's Argentina. It's the theme. And it's the same thing, but now just think about that same concept, but with more broad implications. It's the fourth industrial revolution. It's AI. It's everything that goes into it. So it's the AI data center build out, the powering it, the actual infrastructure and construction of it. And so there is just money flying to every which theme that AI even touches. So very, very good to think about. And it's the reason why, there continue to be some groups which just are not nearly as loved. And so a simple way of scanning. So every watch list, I kind of tag it with its sub-industry group, and then track names that are leading for 1 week, 1 month, 3 months. You could even go out as far as 6 months. I find a little less relevance there, although it can continue to be relevant. And I've even done a video on this where how to scan for relative strength. And if you looked at, and I did it exactly a year ago, and exactly 1 year ago, the stocks and the group that kept hitting my scans and hitting my scans and hitting my scans, gold and silver. Well, does anybody remember what gold and silver ended up doing from the middle of last year until the beginning of this year? They had already been in established uptrends, but then they finally went parabolic into that move. And I know you and I were actually in New York together during that move. So, but you didn't miss the parabolic move if you had just tracked the relative strength over, right, who's the best groups over the last 3 months? Gold and silver. Let's pay attention to those. And then you did not miss the parabolic move if you even tracked those and found those names in June or July. And you go up and then you go sideways. And I always like to reference this gold chart because it is picture perfect and depicts exactly that. You have a massive 10-year long cup and handle, and gold finally emerges from that in February going into March of 2024, and you make a move up, and then you consolidate, and you make a move up, and then you consolidate, and then up and consolidation and up and a longer consolidation. And I mean, some of this up the right-hand side, this is just as absolutely picture perfect as any consolidation is you'll ever find in any book anywhere, where you go up and then all of a sudden you go sideways from April until August. I mean, you just don't find anything prettier up the right-hand side. You want to talk about volatility contraction. You want to talk about all key moving averages, above all key moving averages, getting really tight on the right-hand side, a nice clean horizontal pivot, which for me are always the most reliable, and then just another breakout. And then finally, you finish that off with just a very nice parabolic move. And then, something that's either going to roll over or, will continue to build out its long base because it's what it needs before it can ever continue to go higher. But thinking in themes, not in tickers. Relative strength and relative weakness. So again, reading the market scoreboard, relative strength is how a stock performs versus the S&P 500 and then its sector. So for me, I always have the S&P 500 as my baseline. And I like to think about how my individual stocks act, or how my group is acting versus the S&P 500. That gives me the strongest groups to the forefront. And then you can do that one step further. How is your stock acting versus the group? And then that's how you end up in, let's call it AMD versus NVIDIA recently. So again, how a stock performs versus the S&P 500 or its sector. Again, I wrote here, the math is trivial, but the implication is enormous, right? So if you're focused on the names with the strongest relative strength, you end up in the best names in the market. Again, institutions only, they move stocks from 20 to 200. They don't chase weak charts. They accumulate strength. And that's exactly why charts look strong, is because institutions are accumulating And the best time to find those names are when the market's going down. They effectively stick out like sore thumbs. Markets going up, these names go up more. Markets going down, even on a day like today, or go back a few days ago. And what was it, Richard? It was last, what were the two big recent down days we just had? It was last Thursday and Friday. Yeah. Is that correct?
Or maybe the 2 days before that. Let's see.
2 days before that. So Friday and Tuesday, excuse me. And what stock was acting really, really well? CRDO. And I remember we had that nasty down Tuesday, and this is on Tuesday. This stock closes green, right? Like if that's not a stock going up 5% on the day when your markets are closing down, it's like you better be paying attention to this stock because it's trying to tell you that it is trying to go higher. So making sure that you are recognizing that in real time. Obviously, it's pretty difficult if you're a brand new trader. Sometimes you think it's extended, maybe the market's not so good, etc. But those are the sort of names you want to be paying attention to. And then obviously, if you are a fan of IBD, you do want an RS rating of 70 plus. That's kind of even on the low end in my opinion. I prefer 80, 90, right? 90 is like even better. And that's typically ideal. And then, yes, up 5% while the index is up 8% is relative weakness. That is not relative strength. And then just think about that when the Qs are down big and CRDO is up 5%, that is huge relative strength. So making sure that you're paying attention to that, super, super important.
Before you go to the next one, can you go back to the CRDO chart for just a sec?
Yes, I can.
Because on June 5th, and CRDO had a big wick on that day. Two more to the right.
Yeah, here.
Yeah. So this looks weak, right? But the index was down 5% this day, and this held above the prior day's low. So there's the fact that it didn't break the prior day's low when the index is below the 21 EMA, breaking down 5%, that's RS. And there's RS on a one-day basis, but then you want to kind of collect evidence of RS over a period, right? You don't want a stock that's just strong for one day. That can be an outlier, but especially during the later stage of a correction, if you kind of keep a list each day of stocks showing RS, subtle signs, gapping up when the market's pulling back, holding above its moving average when the market's below. If you do that for like 5 days and 5 stocks show up every single day, those are the ones you want to kind of keep an eye on closely and look for that next setup.
And Richard, what will you notice too? Like with the CRDO, was it the only semiconductor acting well? No.
It'll be a theme.
ARM, Marvell, AMD, like these AMAT, KLAC, ASML, LRCX, these things are just not going away. And the market gives like a little reprieve for a day, and AMAT is often flying. I had, by the way, sidebar, I had AMAT really well. I mean, today, again, not the prettiest chart, but I remember I was looking in here up this right-hand side, and I was like, boy, this looks like a really nice cup and handle. And sure enough, it ended up playing out pretty well, but of course not until I got shaken out, which was in here. But if you're saying to yourself, it might have broken down some, what was the market? What were the names in the group doing at that time? And did it really do anything wrong? Yes, it failed to break out in that moment, but it wasn't long before it was back above all key moving averages and going and printing a new all-time closing high. So something to pay attention to. Obviously, stocks don't make it easy to get involved. They tend to shake out all the time, which is, I know why some people love to buy the shakeout instead. But if that's something that you study and I talk to Nick every single day, for instance, and he loves buying support gaps, the Drendel gaps, which I know you guys now have on Deep View.
Yep.
Those are perfect. Those can literally be perfect. And speaking of those support gaps, when the market shakes, I remember I bought Dell on the shake into a support gap, which is basically going back to this day's close And then as soon as you go back and retest that level, you hold a support gap, you hold the 20 simple moving average, you're buying that as it's responding to that level. Your stop is minuscule, like $1 and change for something that I buy at 156 and just a few months later is at 400 plus, right? So it's like those are in some cases can be the best risk reward sort of spots. So even on something like CRDO, you'll hold the 20. And by the way, that stock moves 10% per day. So to close down only 5%, it didn't even close down its full average daily range. That's something else that people can look at and say, wow, okay, the market might have been down however much percent this day, but it only closed down 5%, and it actually moves 10% per day. So definitely something to keep in mind. And exactly what you said, Richard.
Yeah.
Paying attention to
one more thing, Ashley?
No, go ahead.
Yeah, sorry to keep interrupting.
No, dude, you interrupt all you want, brother.
Yeah, RS is just so important. And one other tactic that I want to mention today is like, and this is like full correction. We're in a full correction. We've got a key low in, and we're counting the days until a follow through day. What I like to do is I'll look at how many days we are since that key low. So let's say we make the key low 4 days ago. I'll go ahead in DFU and run like a general screen that has general criteria, right? Liquidity, stuff like that. And I'll sort it by price percent change over 5 days, because we're like 5 days from that key low. So what you're seeing is which stocks have bounced the strongest since that day. And I'll also kind of look at a 1 month view. So if it's been 5 days, I'll look at a 1 month view, because then you'll see which stocks are holding up the best in that last leg down before that key low. And I picked this up from Eve Bobach. Shout out to her. So that's just a key. That's a way that you can see what's holding up the best and what's bouncing the strongest. And you can even do this, if say we're 3 days after the follow through day, you could do a price percent change 3 days, or price percent change again for that key low, and have a little bit more of a bigger window. But you're trying to see which stocks are bouncing the strongest and are in proper setups, holding up the best big picture. So sorry to jump in again, but I think that's a good tactic.
Please keep going. I love it. I honestly think that's a perfect compliment, because one of the things too that I think there might be some misconception around is just because you didn't buy something on the follow through day does not mean if it's a valid follow through day and it's going to be a leader, it'll have hit new 52-week highs first. It might feel stretched, but that does not mean if you like buying pullbacks or support gaps, or there might be a high type pennant, or I know high type flags can be a little bit more rare. That does not mean that you're not going to get a follow through or another continuation setup down the road. So many stocks, and this goes for even SanDisk. Again, I know this is kind of an anomaly with how strong this one has been, but it gave you a setup in the 40s. It gave you a setup in the 200s. It gave you a setup on the 50-day reclaim. It gave you a setup at 900 with a high type pennant. It gave you a pullback buy going back to May 19th. It's just giving so many opportunities to get long a leader that I even bought this. I missed the 247 breakout because I bought A-Lab in January. Big mistake, although looking at it now, that I don't own it, it's a heck of a lot higher. And I bought a Reddit, which again did not work. And I passed on SanDisk, just bad to not buy something like that. But that's not to say that it didn't work buying it at 900. I didn't buy Micron at 150, right? But I bought it at 406 and it worked great. So just because a leader might feel extended, that's exactly what leaders do, but they almost always seem to give you a secondary and another follow-through, especially if that follow-through day is valid. And to what you said, Richard, is there when you're doing that scan for stocks up the most percent change from the lows or from that date, are you also recognizing that you're looking for particular themes that are holding up?
I have a column in DFU right next to that price percent change that will be what GICS industry it'll be in. So you'll see exactly, you'll see the top 5 are semis. You'll see the top 5 are software. Also, like just in general, like Deep View, if it's the most common industry group, Deep View will color it in blue, just kind of highlighting again the strength in that group. So yeah, 100%. That's so key because it'll point you towards the group, and then you can investigate, be a detective, find the instruments you want to play, whether that's looking at liquidity, looking at the quality of the setup. But yeah, 100%. I'm really focused on what theme is showing up, not just like which individual stocks are holding up the best.
Yeah, and for anybody, I know in the other slide too, I had, was it one other slide up? Yeah. Trading tickers without GICS context is flying blind. For anybody who doesn't know what that means, that is the, if I'm not mistaken, global industry classification standard. So it's just basically stocks being grouped into groups. So
sectors,
exactly,
groups, sub-industries.
Yes.
Yep. Industries. Yep.
Just for anybody, because you said GICS and I knew, but somebody might be listening to this guy. I have no idea what he just said. Okay, so moving on, the fourth puzzle piece is leaders versus laggards. Leaders, they tend to build higher lows. They have shallower pullbacks. They've got, usually decreasing volume even on those pullbacks. We're not really too worried about the indices here at this point. Usually leaders tend to show up before the market even gives you that follow through day. And then their rallies tend to be on a pickup in volume. And then when they do base, they give you tighter bases. Obviously, we just looked at that gold as an example. We could even, and another great example of this would be NVIDIA. When it went on its own 5-month base, this is exactly what leaders do. They make a gigantic move up off the lows, effectively 200 and some odd %, and then proceed to go sideways 4 months on end at the top of the range. That is exactly what leaders go on to do, and it seems to happen over and over and over. The longer the base, typically the longer and prolonged the breakout can be. The shorter the base, you can still have some very explosive moves. We've seen it even out of a name like SanDisk, which, again, hate to keep bringing this one up, but it is just such an absolute textbook beauty. You make this big move off these lows, 500%, and then you build a 7-week sideways base, and then you proceed to build a 9-week sideways base. And at each of these times, the market is going through a little bit of turmoil, which is completely healthy and normal. And then even this one before the market broke out in January, well before the market. And then again, as the market was going through its own period of consolidation, so was SanDisk before proceeding to its next leg higher. So leaders tend to do that, shallower pullbacks, sharper rallies, and then rank a group a distance from its 52-week high, and then look at its relative strength rank. And something that, we continue, even Richard and I talk about all the time, it's the easiest way to put yourself on the side of a big winning trade, paying attention to relative strength. And then watch the laggard. And I don't actually know that this is the best way to do it, but there has been some, kind of looking at this, when the laggards start to break down, that can start to affect some of your leadership. Not necessarily, but I can give a pretty good example with the optics names recently, and it's hard to call CIEN a laggard, but you break down on earnings, you start to roll over below the 50, and this entire time when CIEN breaks below the 50, after this thing had been in a really nice prolonged uptrend, the other optic stocks, whether you're looking at Light, has done absolutely nothing. Whether you're looking at AOI, has done absolutely nothing. So hard to call a name like CIEN a laggard, but it has become one, especially within its own group. And you have to start to view that under a lens where you say, hey, if these laggards, CIEN, start to break down on earnings, you got to be careful with these other quote-unquote leaders, because just when you think that they are leaders, they start to follow suit with the others, right? With CIEN. And if you look throughout all the optics, GLW, VIAV, they have all turned into a headache. If you're trying to buy a pullback, buy a reclaim of a key moving average, they've all become a real big pain. And so paying attention to the quote-unquote laggard. When it breaks structure first, the leader is usually 1 to 3 weeks away from doing the same, and that's just kind of from my own observation. CIEN just broke down 10 days ago, call it 2 weeks. If I'm looking at AOI, you certainly look, and LITE, you look like you are right there from also breaking below their 50, and you start to break below the 50, and it can get all sorts of ugly quickly. So something to pay attention to. Finding the needle in the haystack, puzzle piece number 5, how and why we scanned the market, right? So you've got over 7,000 listed stocks, right? I would say much fewer than 50 of them are ever worthy of your attention on any given day. I personally like to shrink my list down even further, 8 to 10 to 12 stocks that I even have an alert on. I would say 100, 150 names in my universe list at like any one time. I was talking to a student today, and he said he had 300 names on his universe list, and he's done a really good job of holding some big winners, Marvell and Dell, and he still has them. But one of the things that I said 300 names is maybe too much. And because you like holding names for a longer period of time, the way you can kind of shrink your universe list is have some accelerating earnings and sales. If they don't have accelerating earnings and sales, maybe they could be kind of that, I don't know, I don't want to call it like a wallet patter, but just know that it's going to be like you're just trading this for a few day momentum burst for your equity curve, and then that's it, right? But if you want to sit in something for weeks and potentially months, usually having accelerating earnings and sales is the thing that stops that stock from round tripping all of its gains, right? So Oklo was fun last year, but it more than round tripped the entire thing. Why? They make $0. So they're fun and they work when the theme is working, but if you really want to sit in names and you want to be more of a position trader multi-month, even a full year, accelerating earnings and sales, 25% quarter over quarter or trailing 12 months near their 20-day highs. I personally like stocks with over $1 billion market cap. And people are like, well, Ariel, at $1 billion in market cap, do you feel like you're missing names? The reality is no, right? $1 billion nowadays for a company is actually kind of small. I mean, as crazy as that might sound, right? You could still have 2,500 stocks to pay attention to north of $1 billion. And to this, I'll say, if you are into trading momentum, Rigetti had $1 billion market cap at like $2. Did you miss anything if you didn't buy it at $1.50, but you bought it at $2, right? It still went to 50s. So you didn't miss anything. $1 billion for me is perfect. And that's a really good scan to run. Another one is your highest momentum. So 70% above 52-week lows. That's already charts that are going up. Greater than $10, trades more than 2 million shares a day, and then price above the 50 simple moving average. You can adjust that to prices above or below the 50 simple moving average, or even below up to 5%. And that will give you a couple stocks that might just be consolidating just underneath before you get that old Oliver Kell wedge pop, potentially right back through the 50, which is a setup that I do not mind trading at all. And then episodic pivots or earnings gap ups, power earnings gaps. And then you could take that as you gap up on news. You trade big time elevated volume, could be on news or earnings or after the stock's been neglected. And then again, shout out to Amit, trading a high volume close setup, but right behind those as well, if they meet the criteria. So finding the needles in the haystack is a non-negotiable. Any questions there, brother?
No, do you have a preferred market cap range? Like I like the 5 to 20 billion range in general, and trading those for a nice
so
move.
they can double and triple and quadruple. Not, I don't want to neglect, because I didn't mind the move that AMD made, right? And AMD was a $500 billion, or less, just a little less. So I don't want to neglect, because you can just be over $1 billion. Of course, there is that sweet spot where, you're call it a, $10 billion business and you can go to 50 or 100 or what have you. Like if I had to have a preference, I happen to like Rocket Lab, even though maybe right now it's not acting the best, but you know, that 60 billion with SpaceX at 2.5 trillion. So it's like you got this $60 billion business with maybe some wiggle room up to 100 plus in the future, right? Like that to me feels fairly comfortable. Yes, and like once you get to, sorry, Richard, once you get to like these $2 and $3 trillion market cap, I ask myself, like, yes, they can go up, but how much meat is on the bone? Like we all want to catch 100% move. Is NVIDIA going to be the stock that gives us 100% move here and then what, becomes an 8 or a $10 trillion company? Not saying that it won't, not saying that it can't, versus catching, you know, NBIS or ARM or even Dell, right? And it's got that opportunity to, you know, double, triple, quadruple versus something like NVIDIA where you just look at it and you're like, if this thing quadruples, it's like $20 trillion, right? Like the odds of that become significantly less as you get too big for your own good.
Yeah, and I was just going to add, would you mind defining dollar volume and talking a little bit about that aspect and why you look for pretty liquid in the can slim and reasonably liquid in the scan number 2 as well?
Yeah, well, so institutions have to trade liquid names. Otherwise, they're building positions for a really long time in illiquid stocks. But what can happen is if you're trading an illiquid name, you know, something that's only trading 20 million bucks a day, it only takes one player to exit their position to absolutely destroy a stock, right? But if somebody wants to exit $1 billion of NVIDIA, they could do so fairly easily in 2 days, right? Without, you know, crushing the price of NVIDIA. And, you know, as a retail trader, I would always just say, if you're sticking to more liquid stocks, you'll deal with less slippage. And that's really important. One of the costs of doing business, especially as your own portfolio begins to scale, is not moving the stocks that you're trading. There are instances where I'm buying a name like Dockin, and I'm like, if I buy a 10% portfolio size, I don't want to move a stock even 50 cents, right? And there are instances where there are names that I might be trading that are trading $80 million or $100 million in daily dollar volume, where you move them a little bit. And I don't want that at all, because you move them on the way in, you move them on the way out, and as you're buying, others might be doing the same thing. So you're dealing with slippage, the cost of doing business on both sides, versus if I buy Intel, let's say, if you could put myself or any institution could buy $5 million worth of Intel with a single click of a button, and it might move 8 cents, right? So, or 10 cents or 50, like much less. And so your slippage is a whole lot less. And if you're focused on very highly liquid names, even just north of $100 million a day, you're not missing out on any of the best stocks in the market. Zero. No, you're not missing Micron. You're not missing SanDisk. You're not missing NVIDIA. You're not missing ARM, Marvell. They're all trading billions of dollars a day. I know that stocks that are trading 20 million bucks a day, they can certainly make big moves. But, and maybe most people with smaller accounts, like they might be trading with a 30,000, 20,000. This isn't something that they have to think about, because they might only be buying 20 shares, 10 shares, 15 shares, 50 shares. But as most traders, and everybody wants to scale, you have to be trading names that are liquid. Otherwise, it just becomes far too difficult. You move a stock when you get in, you move a stock when you get out. That cost of doing business adds up at the end of every single trading year in a way that you don't even really want to do that math. So again, you're not missing any of the best stocks in the stock market over the last 12 months if you just set a filter at 60 million. And then almost everybody can find, great stocks to trade, good earnings and sales, over $1 billion market cap, over 60 million daily dollar volume. And what it'll do is it'll narrow your focus onto the best of the best. I would even take it another step further. Don't trade stocks that trade less than 3% average daily range per day. You want to make money this decade? Avoid the turtles, right? General Electric is fine. It's going up. But do you want to own General Electric for a 30% move in a year? Or do you want to catch AOI from 40 to 200? Right? So, and even AOI at $40 was trading $100 million a day. And it had a, 8% average daily range and a market cap north of 1 billion. And it, has good accelerating earnings and sales. And it's the same thing with a name like A-Lab, for instance. Like, they've all got it, but what you're doing is you're just eliminating the General Electrics or the Boeings of the world. Slow. They maybe have some good growth, but then they're just too slow. And you got to do something to, quote unquote, find the needles in the haystack.
Yep. Great. Yeah. I think the combo of liquidity plus higher ADR, that there's a sweet spot there. And I don't like the super high ADRs because like those can be their
tough
own
to
animals.
Trade. Yeah.
But I think like 5 to 8% is kind of a sweet spot for me.
Sweet spot.
Yeah.
CRDO.
Yeah.
It's a sweet spot. And those in A-Lab, a big opportunity for those names to double. Marvell, like 6%. Even AMD recently, they move beautifully. But then even sometimes when they become too big, like NVIDIA or Apple, all of a sudden its average daily range shrinks all the way to 2 and 3. And hence the reason why you get these double and these triple leveraged ETFs, which, they're their own monsters, but they can actually be very beneficial if used properly as well. Not something that I tend to trade, but during a period of a momentum burst, they're some of the best instruments. And at first I was like, the market doesn't really need a 3x leveraged, whatever it might be. But there are instances when it's actually not that bad.
I think we need a 10x SpaceX. Is that out
man,
yet?
I think we've already got 2x, and probably 3x if I'm not mistaken.
Yeah. One more thing about
of course,
the universe that I think might be good to mention. Like, this is something that you learn over time, but learning the character of the stock you're trading, is it a stock that when in trends trades cleanly? And this goes to liquidity a little bit too. Does it respect the moving averages? That's the ones I like to focus on. I call them choppy traders if they're kind of the opposite. There's like no respect for moving averages. There's little follow through on breakouts.
IoT, you mean?
Yeah, exactly. And all like the commodity ones, that's what like another reason why I dislike them. But also just like when I'm screening and I find a good setup, it's in a good theme, I'll look at like the last trend, like from a base, and like, first of all, I'll do like a measuring tool in deep view and like measure from the breakout to where it kind of topped or rolled over. And like, was that a meaningful move? Was that a 40-50% move that I would be interested in? And like,
linear
and respecting the moving averages. So those little things, looking to the left, what has the stock done before? Has it shown it's capable of making a market leader move? Is it a serial gapper? Like, does it like to gap up on earnings and positive news? Those are little nuances that you'll pick up and have a running list of that can help you, focus on the right names.
Yeah, I agree with that completely. I know it's tough when you look at an IoT or a TEM and you're like, well, the theme is good, but it itself is such a choppy, inconsistent, but it goes back to learning your stock's personality. If you've watched your stock long enough and you say, hey, this thing loves to shake out the 20-day, so then just waiting for it to shake out the 20-day and then be a buyer there and knowing, hey, this is what this thing likes to do. This is how I would buy this name anyway. It's tough when you're if you're not super adaptable to different entry tactics. If you're just like, no, I'm a traditional breakout buyer and I only like to buy earnings gap ups, or I only like to buy. There are charts that like to gap up on earnings, but then do nothing for a few days. That can be very, very annoying. There have been charts that like to gap up on earnings and then immediately follow through. So that might work for you, but then the others might not. So definitely learning your stock's personality. I like what you said there about looking left and seeing if it's got linear price history. If it doesn't, and it never has, I'd rather it prove to me that this is like a new regime, new market participants in this thing, new institutions that are like desperately trying to own it. They'll drive it up. It'll become linear. It'll have like that Dave Ryan ants, right? Where it's just being accumulated day after day after day for a couple of weeks, and then it'll flag, it'll pull back. It's up 4, 5, 6 weeks in a row. Now you're like, oh, man, I got to own this thing at some point. And then you're just waiting for that new consolidation, whether it be a consolidation like SanDisk or something a little sloppier like VRT. I remember VRT at like $17, and then it just like ran away. And it never made me comfortable to buy it, but that was a big lesson. Those are the ones, that institutions, that they're dying to own this thing. They don't care what it looks like, what the price is. There's no weak hands, and they are accumulating the hell out of it. So those are how it goes sometimes. Anyway.
Yeah, I bought. By the way, I bought VRT like from that gap down at like 17, 18. Sold it on one bad day and just never bought it back, dude.
Oh,
it's just,
never.
It happens. Oh no, not ever, but like not during that initial move.
I was about to say, anytime I've tried to own VRT recently, it's not been pretty.
Yeah.
So speaking of, I think it got back above the 50-day today.
Yeah, I think so.
And so did CEG. Just when you think
they were below it, it faded a little bit into the close. Yeah.
I mean, market was kind of tough.
Yeah.
Okay, so moving on, puzzle piece number 6. Fundamentals and themes drive price, the fuel beneath the chart. The biggest winners always pair powerful fundamentals with a chart confirming institutional accumulation, something that we just talked about. Look for triple-digit EPS growth. Does not always have to be like that, but if you have it, obviously better. Revenue confirms kind of that EPS story. And then great fundamentals plus a hot theme gives you that much more potential. Going back to what I mentioned earlier, I would rather own the crummiest stock, right, in the strongest group, in a hot theme. That increases your potential. You now give me a hot theme with great earnings and sales, then you look like A-Lab, where you look ugly at first, then the theme gets hot. Now it's like, oh man, but they do have awesome earnings and sales. In fact, they've got triple-digit EPS growth. I'm not sure if it's still that, but I'm pretty sure it was for a while. And then all of a sudden, huge move. And then again, same fundamentals, but in a dead theme, you're going to get 20, 30%. Amazing fundamentals in a great theme, you get 100, 200% moves. And that is very important to remember. You can go and catch it, awesome move, but if it's a crummy theme and it's like moving in a vacuum, you're swimming upstream, doesn't make for nearly as awesome of a trade as it does when it's got awesome fundamentals in a great theme. So, and then obviously a chart, the technicals itself, triggers the entry and triggers the trade. Fundamentals and themes decide how big to go and how long to hold. Semiconductors right now, that has been kind of the theme. Anything AI related has been the theme, although maybe a theme that's getting narrower and narrower in as the length of this trend goes. I don't know if that's entirely true or not, but if they've got good fundamentals and a hot theme, that obviously should be the determining factor of your patience and your position sizing. Okay. Puzzle piece number 7, before we wrap up the foundation, improving your situational awareness. Read the whole board, not just your ticker. So hold the full picture in your head, your index, your breadth, your leaders, your laggards, your themes. I don't really focus too much on bonds. I have been focusing a little bit about the dollar. We talked about this a bit before we started recording. You'll notice today the dollar was super strong. The market was getting beaten up. You almost saw those things moving tick for tick. And obviously that is kind of holding the whole picture in your head. The last time we saw the dollar rallying in a big way was 2022. We obviously know what the market was doing at that time. So I at least want to be conscious of it. And that's just part of holding the whole picture in my head. On the flip side of that, I can't lose sight of the fact that WDC, NBIS, ARM, and even Micron all tapped a new all-time closing high today at some point. So, balancing those things is kind of important. For me, what leaders are doing is very important. That's the most important thing to me. But also, and equally as important, is what setups do I have that are buyable tomorrow? If I've got very few stocks that are actionable and then that they're triggering on a technical level, then I just do nothing. And I let names work if I have them. And then maybe if the market shows some distribution, do I have a name or two that I could potentially short on the other side of the market to play some potential unwind in the market? Setups repeat. Context never does. The same chart is a buy in one tape and is a trap in another, right? That's why that when is very, very important. And then your morning checklist, right? What does your index look like? How's your breadth? What's your leadership looking like? And then, what is there any news for the market? Today was FOMC, knowing that, and then your own book, right? What positions do you have open? What's working? What's not? And then taking it from there. And then awareness, catches it early, distribution days, failed breakouts, defensive stocks leading, and then maybe even the dollar, not so much bonds, rallying is something that would kind of raise the antennas. If we start to see failed breakouts, if I start to see toilet paper, I always joke, the XLP consumer staples leading, that makes me a little bit more defensive than if semiconductors and the SMH acts great. If the SMH turns into a failed breakout and the dollar start to rally and my own stocks start to stop me out, those are red flags. Those all go into kind of improving your own situational awareness. But ultimately, that can all be boiled down to your own portfolio. How are your names acting? How is your universalist acting? They were showing relative strength before you bought them. They were going up when you were in them. You eventually get stopped out. Something looks like a clean setup. You go to buy it, it fails. Those are all things that you can kind of say, hey, let's pump the brakes a little bit. But as long as leaders continue to lead, you kind of got to, keep some of the negativity out of your head. All right, moving on. This second part is on selection. So a small menu of setups traded with conviction. So the setups I trade, again, a big move up, tight base. We talked about it in gold. We talked about it with NVIDIA. So you'll get even SanDisk, you get that 30 to 100% move, in some cases even more. Then 2 to 8 weeks of contraction. You saw it again with SanDisk, 7 weeks of sideways, 9 weeks of sideways, then range expansion. Again, you saw it with gold. And in some cases, you can get 5 months of contraction. The bigger the contraction, the better, especially if it's coming off of a really big move. Episodic pivots or power earnings gaps are the other setups that I love to trade. Usually I don't buy them on day one anymore. I kind of will wait for even the Scotland fishhook. I know you've obviously chatted with him before, or the high volume close setup, which Amit talks about so often. And just sometimes a simple, if you're going to buy them on the earnings gap up day, something as simple as a 5-minute opening range break could be good enough. I love volatility contraction patterns. That is the exact chart that we spoke about in gold. Just picture perfect. You get a very big move up, and then all of a sudden, and these pullbacks are very shallow, but effectively they get shallower and shallower as you move the right-hand side of the chart. That is your classic, very classic Mark Minervini VCP, and then obviously a simple bull flag. So a move up, and they could be very, very short bull flags, or they're almost the traditional cup and handles. Think about something like Morgan Stanley. As of late, this is just a textbook cup, and then you have your handle here on the right-hand side. And would you be too surprised if I can find you another banking stock which looked identical at the exact same moment. Well, don't be too surprised because stocks move together. Goldman Sachs, your cup and your handle, no surprise, no surprise. Charts move together. That's probably the thing that I would reiterate more than anything. Setups are fine in a vacuum, but they're better when they're together. Morgan Stanley, Goldman Sachs, I mean, two synonymous names in the banking industry, both with cup and handles, both with breakouts. Surprise, surprise. And it wasn't the only cup and handle that I was looking at. Guess what you had here? And this is a semiconductor, a cup with a handle, right? And we were looking at AMAT earlier, Richard, a cup with a handle. And yes, some of them can be a little bit volatile on the right-hand side of the chart, but would you be too surprised that semiconductors were giving you cup and handle setups and then they're breaking out together? So very important. Again, those are the setups that I like to trade, and that's how we kind of view it as selection. Again, pick 2 or 3 setups, learn them cold, know them like the back of your hand, and let the rest of the market exist without you. That's like a good way to, kind of view it. As you become a little bit more seasoned, I used to trade the earnings gap up, but then I learned from Amit and I learned from Scotland the fishhook setup, the HVC, and then you add those to your playbook. If you happen to miss an earnings gap up on day one for whatever reason, or because you didn't want to buy it, or maybe you've noticed that they've been pretty volatile on day one, that doesn't mean that you have completely missed the setup. In fact, you can buy it a day later, 2 days later, 5 days later, and maybe it still meets the criteria for a setup that you understand. Yep.
One more example, and this is VCPs. Can you bring up MU?
Way down in the base.
Yeah, at least this is kind of my perspective. The most recent base actually is what I'm looking at. This is my interpretation of VCPs. Ariel, you might be a little bit different, but it doesn't always have to be higher lows. We just need some tightening on the right side, and like there was a shakeout here. Yeah, and that's like a perfect high handle, whatever you want to call it. It's not so much about memorizing patterns; it's about like understanding what does constructive price and volume action look like. And it can express itself in multiple ways. But we're looking for a mature base and then a burst up the right side and then tightness. And like, you don't need to memorize exactly what a cup and handle looks like, although it's like the simplest. But that's what I look for, is just like tightness up the right hand side when a stock is in a mature base. And yeah, we've got like, this could be, there's an undercut and rally set up
and
here.
And this is a beautiful, this is a absolutely beautiful shakeout here too. So this is I don't mind when price does this at all. This does not bother me in the slightest bit when price gives a healthy shakeout underneath the base. And I remember the market gave a follow-through day on the 8th, hence the gap up. Surprised that a stock would gap up with the market, because that's exactly what stocks do. They tend to move in lockstep with the market, but some better than others. Micron being a leader, I ended up buying this on the 9th on effectively the little undercut and the reclaim of the 50 simple moving average. We could take it down to a smaller time frame and look at the actual setup itself, but a pretty straightforward setup nonetheless. When you look at just what a 620 setup looks like, and it boils it down to a 5-minute chart, you know what the market's doing, you know what group it's in, you know that these things are super strong. It reclaims a key level. The market just gave you a follow-through day, the prior day, technically, and now you've got a smaller time frame to get in and then to manage risk on a smaller time frame with the bigger picture context in mind, and also with the market environment having changed regimes into a potential, we just got the follow-through day, now it's time to start getting not aggressively long, but it's time to start getting some money to work in the market. And doing so quickly, especially if this is going to be a valid follow-through day, getting positioned anywhere from the 8th all the way up until, middle of April, from the 8th to the 16th or 18th or 20th makes total sense to me. And then obviously, we all know what the market does from there. So
yeah, and one more thing that was a little bit of a tell for SNDK is MU, the base before this. If you could go back to this, stay on MU for just a sec. Sorry. The base before this, so back in
here
December timeframe, this gapped and broke out and was trending before SNDK even started moving out the right-hand side of its base. So seeing the strength here tells you to investigate the theme a little bit more. And then SNDK, so this broke out of the base that on December 19th, SNDK, that same time frame, if you could bring up that chart, was just moving off the lows and didn't break out until Jan 2, Jan 6 time frame. So that's a little bit about how, again, narrowing your focus a little bit and spotting those early entries when sister stocks are developing and setting up. So just want to point out that.
And look at how absolutely tight these days are.
Yep.
Like the range goes from, a big wide range on the way up, obviously pretty nasty wide range on the way down, but then you do develop those higher lows. You are above all key moving averages, and just before you have range expansion, I mean, you couldn't really trade any tighter over the course of 3 days for a stock that moves 7% per day. Effectively, you're trading these days with, half of its typical range.
Yep.
Which
and
is
one thing about that bad bar, and just like really bad bars in general at the beginning of the base, draw a line from that close. When a stock has a really bad bar, this is just an observation I've made, does it follow through below that close, or does it not want to close below that bar? This
Correct.
whole base was based. I don't know if it even closed on that on December 3rd, which is a little bit. I don't think it closed below that.
Okay,
if it did, it
close
was like,
here, 195.96, 194.38. Dude, you're talking less than a buck, right?
Yes.
40 cents. 40.
So,
I mean, a little bit more.
Yeah, so just like HVCs can be helpful on really good days as earnings, as pivots, a really bad bar, if there's no progress down, yes, the stock might need some time. This based out for a bunch more weeks, but, pay attention to whether we get follow through below it, because that can be a tell to keep an eye on a stock. This is a stock that went from, in the prior move, 52 to 300, basically. Then it had that bad bar, built a base, but you should still have this on your radar, disregarding that one bar, because it doesn't want to close below that close. So just something to keep an eye on.
And how important still that 50-day is.
Yep.
At this entire time, this thing was so strong, it remained 10 times its average true range above the 50, effectively the entire way up. And all this bar did was allow that compression to take place even a little bit faster. Let the moving averages... you can consolidate through time, or you can consolidate through price. This one did a little bit of both with that November 20th bar. And in reality, nothing super harmful where you would look at this and go, man, that defeated this, absolutely beautiful name. And just one to study a ton of, because obviously we might never see a move like this, but it's how big moves develop. You make a big move up and you consolidate, sometimes for 7 weeks, sometimes for 9, sometimes for 4 months. Gold was another beautiful base. NVIDIA was another beautiful base. That SMCI was a beautiful base. It's about understanding what those bases look like, how they can develop, how big of a move up it was before that consolidation needed to take place. And I don't mind this bar at all, Richard. I mean, I remember clear as day having that 247 alert, but my problem that day was buying A-Lab and Reddit, both of which were working for a day. So I was like, well, all right, I missed one, and I'm like, okay, I missed it, no big deal. But then obviously this is the one that really ended up working, and the other two, well, we know how those are looking. Although A-Lab is a heck of a lot higher now than when I bought it, but anyway. Okay, so next is entry tactics, getting in, and this is another puzzle piece. Again, it's good to know your setups, know your entry tactics. Entry tactics, getting in with structure and not hope. An entry is not price. It's a moment when buyers prove control. So it's a pivot. Sometimes it's, for me, typically, I love to buy a break over a prior day high. How can you go higher if you haven't broken a prior day high? The other way that I do like to buy is pullbacks into key moving averages. Oftentimes you are still within a prior day range, or you have broken the prior day range, holding a key moving average, and start to turn back up. But something very, very simple for a brand new trader to do, like a SanDisk, is it even really breaking out if it's not breaking above a prior day high or breaking out of the range? The answer is no. And so you're buying something within a range. I've always kind of had this belief, if you're going to buy in a range, buy the weakness in a range, not the strength. Because if you buy within a range and you buy the strength, you're very likely to get chopped up. When you start to buy strength, you want to buy those new highs. And again, shout out to Dr. Wish and the Green Line Breakout. When you're buying an all-time high, there are no more sellers, apparently. Well, that doesn't necessarily have to be true, but you're in price discovery mode. And who wants to sell their stock when every historical buyer is green? So that is a kind of that psychological side of it. And that's your pivot, right? It's that new all-time high or the break of the range, or at the very least, the break of a prior day high. You could play an opening range break, 1, 5 minute, 60 minute, 30 minute, 15 minute. I've seen people do it all multitude of ways. Again, it boils down, in my opinion, not so much to the time frame that you're using to get yourself positioned, but more so the when you're doing it. If you're buying a breakout in a healthy environment after a market correction, your likelihood of success goes way up. If you're buying a stock in a top 40 group, your likelihood of success goes way up. And if you're buying a stock in a good group with good earnings and sales in a good market after a market correction, and you've now gotten the follow-through day, your likelihood of success goes way up. So you're just kind of stacking the deck in your favor. And I don't remember exactly who was that said this. I think it may have been Mark. And he said something like gambling and trading stocks can be very similar. The difference is I get to see my cards first before I put money on the table. And that's exactly what, taking your entry might look like. If I just had to blindly say, oh, FCX is going to break out tomorrow, maybe. But if I got to say, well, copper's ripping, industrials are doing well, metals and mining are doing well, FCX has got a clean pivot, and then you layer, those things in your favor, now all of a sudden your likelihood of success does go up. But you have to kind of layer those other pieces, and that is where, having that situational awareness is something that everybody will get better at, but having that understanding as one of your puzzle pieces is so important. And then obviously the reclaim entry, where it could be the reclaim of a key moving average, the reclaim of a support gap, so its stock might fade at the open. There are times where that's the same case. The market might gap up. You don't want to chase a gap up, but you do wait for the profit takers to come in. You get a little bit of a fade at the open, and then you buy the reclaim of VWAP, and that's just volume weighted average price. And then your stop you'll already have a low in place. And so your entry is your reclaim of VWAP, your stop is low of day. That allows you to understand what you're even risking before you ever get in. And that is something that all of us should know before we ever get into anything, is where you're leaving in case you're wrong. And that is entry tactics. When to avoid buying, the art of saying no. So if you have a market filter, the market is below the 50-day, the 10 days below the 20, both are sloping down. That's your market filter very easily with key moving averages. Not buying a growth stock when that's the case, especially if it's not a follow-through day. If you've had a low and then you're going to float higher for 2-3 sessions and then get a follow-through day, and then you buy it even though you're still below the 50, okay, fine. A follow-through day is its own separate guideline for getting you engaged in the market. But in most instances, when you're below the 50, you're below the declining 10 and the 20, that should be a very simple market filter for a new trader. Just don't be a buyer of stocks. Don't buy stocks that are extended. So either above their flat pivot. For me, I also would say don't buy stocks that are more than 4 times their average true range from the 50. A very simple example is if a stock moves 4% per day, don't buy greater than 16% above the 50 simple moving average. You're already starting to get into, once you're at 6 times, 7 times, and people are like, wow, this looks so amazing, you're buying extended. The only nuance there is if it's an earnings gap up, that becomes the only reason that you can buy anything that's extended because it's on a news catalyst. Extension from the 50 is actually what you want to see. So a little counterintuitive, but again, something that I think, traders definitely pick up on and they have to learn. Also be a little bit more careful with late stage bases, names that are a little loose around pivots, names that look like they built a clean pivot, but then fail once, fail twice, fail 3 times. You got to be a little bit more careful. Look at where the stock has come from. That's not to say that names can't go higher, but when you do get to late stage bases, they tend to be a little bit choppier. They tend to need at least a correction before they can come back to life. Wide and loose base, something of which you're seeing in the optics. Again, do I know that they're going to break down? No, but think about where a name like LITE has come from, and then say to yourself, does this base up here feel like a clean base? Maybe, but just not yet. And it's not that I don't think it's great, but you have to take into context of where this thing has come from and in the time frame it has done it. Just last April, so 16 months ago or 14 months ago, the stock was $45 and it effectively got to 1,000 plus. Is this enough consolidation here for you? Is this clean enough where you say to yourself, this looks a little bit more like this tight consolidation? Not quite. What you're seeing during this consolidation of October of last year was a lot cleaner, and considering that this thing was breaking out when the market was chopping and in fact chopping and then almost going lower. So incredible resilience from this name, but now that you've made this gigantic move up, you've got CIEN, a leader in its group, breaking down. I would just say it's not that it can't work. It's just that maybe the group's not getting as much love as we thought, and maybe this consolidation, considering the recent move up over the last year, isn't a long enough consolidation after a 1,000% plus move. So be a little bit mindful of late stage bases. And then again, you're already at your max heat. So maybe you're already at max heat, meaning you've got too much brand new exposure on, and you know that if you're going to go get stopped out of all those brand new positions without seeing too much traction, your chance for a 4%, 5%, 6%, 7% portfolio drawdown from your realized gains might be a little bit too much. And that's also, kind of dovetailing into what progressive exposure can really be. So moving on here, we've got execution, risk first, share second, stops without negotiation. That's an absolute must. So proper position sizing, the math under every winning trade. Position sizing isn't just how many shares. The question is, how much will I lose if I'm wrong as a swing trader? You have to know you're wrong 60, 65% of the time. My stats say I'm right 35 to 37% of the time. But when you have a winner, right, letting that thing work, letting it make up for a bunch of your little losses, that is the idea. And then obviously your shares is your account risk multiplied by the risk of, or your account size multiplied by your risk percentage, and then divided by your entry minus your stop. An easy way of saying, if you're buying at $100 and your stop is 99, right? If you're buying a 10% position and you're risking only 1%, how much can you actually buy to keep your loss at 0.3%? So how many shares can you buy? So risk per trade, 0.5%. I actually don't even go that high. I know some people like to do that. I think 0.75% can be a little high too, and that are a little high as well. For me, even without a losing streak, I like to keep my losses right around 0.25%, maybe even 0.3%. That makes me feel most comfortable. If you're risking more than 1% on a single trade, you are definitely gambling. You're oversizing. There's really no reason for that. Almost all swing traders will go through 8, 10, 12 losses in a row. The last thing you really want to do is give back, 10, 12, 15% of your portfolio during a single bad losing streak. I want to say it was October of last year, just after we had that, kind of nasty down day, October 10th, I had like a 11 trade losing streak. I ended up losing 1.5% of my portfolio. So by the time I get to my third and my fourth and my fifth loss, I'm taking 3% position sizes, not because I don't trust the setups that I'm trading, or I don't trust myself, or I don't trust the market. I'm either not seeing things well, the market isn't friendly, or my entry tactics are horrible for the market that we're in. I should be buying pullbacks, but I'm buying breakouts. And you notice that by the time you get to your fourth and your fifth losing trade in a row. And if any one of those three things are true, my entry tactics stink, the market's a little bit choppy, or I'm not seeing things well, all of those scenarios, I want to be trading smaller and smaller size. So if I have to take a 3% position size, but then my stop is 2% to low of day, and I'm risking effectively nothing, good. Let the market get me into a winner, and then I'm going to say, oh, that's an aerospace and defense stock. Let me go buy another. Oh, I've got another winner in an aerospace and defense stock. Let me go buy another. And so operating behind traction versus getting more aggressive to make back losers, it was very easy to make up my 1.5% portfolio drawdown once I got myself into a few positions. Those happened to be shorts. I shorted Rigetti, I shorted UAMY, and I think I shorted Nugget because gold had, a pretty nasty pullback, got a little extended there. And so, but I was seeing things well on the short side of the market, and all it really took was 5% positions on the short side to more than make up for my losses that I had on the long side. So proper position sizing is truly, truly the best way that any trader can really control their risk. The shares that you buy is like the single most important thing that helps control your drawdown. When you're in an up market, you're a genius. Everything is working. Trading is simple. You look in the mirror, your chest is a little bit bigger. You're just a genius, right? Your head weighs 1 million pounds because you can't do anything wrong, right? In a bad market, you should notice by trade number 4 that either you're not seeing things well, the market's not friendly, or your entry tactics are terrible for the environment that you're in. So hopefully that makes sense. Using average true range for position sizing, so sizing for stocks' actual personality, and this goes back to what you said earlier, Richard. If I'm buying CRDO, or let's say AOI, that moves 13% per day, I don't need more than a 5% position. I personally don't know how people put 20% of their account into a name like that. I think that volatility is insane. It feels fun when you catch it and it makes a huge move, but volatility cuts both ways. And, just being wrong could lead to massive paper cuts. So ATR is a stock's average true daily range, or an average daily range. So a $5 ATR stock moves 5 times as much as a $1 ATR stock. And that is effectively just looking at a stock's average daily range with its current price, you can figure out roughly how many bucks per day it moves up or down. So knowing that a stock's personality in terms of its average true range, very important. Stop distance should never exceed more than 1 to 1.5 times its average true range. And I even think that that's a lot. So if a stock moves 5% per day and I go to buy a breakout over prior day high, right, having a stop that's 7.5% away, that seems a little bit steep. Normally, low of day is my stop. And if a stock moves 5% per day, I'll even say this, I never buy a stock when it has moved its full average daily range already. You're effectively asking the market for favors at that point. I don't like to ask the market for any favors. Yes, on a breakout day, you can get an outsized move, but if you're buying a break over prior day high and you got, like, let's say the oops reversal setup, which I know you're familiar with, Richard, the oops reversal is meant to be played after the washout and then a reclaim of a prior day low. and you might be buying it as it's going back through the prior day low, or bouncing off a key moving average, or reclaiming an intraday VWAP. But if you wait until it has to take out a prior day high from an oops reversal, now all of a sudden the stock had to move more. Now it's bullish that it did that, but all of a sudden, if your then stop is the low of the day and you're buying it over a prior day high and an oops reversal, your stop is like twice as big as it should ever be. So that becomes very uncomfortable. And then no ads, one price is 3 times its ATR above your initial entry without a fresh base. And then again, trim into strength, never chase price. And for me, more than 4 times its ATR above the 50 simple moving average is a no-go for buying a brand new position. In this environment recently, I have been bending that rule a little bit. I haven't been breaking it 5 times its ATR from the 50 because things are just so damn strong. That's okay. But 7, 8, 9, 10, I was tweeting about this a few weeks ago when semiconductors were flying. I had 42 stocks in my universe list that were more than 10 times their average true range above their 50 simple moving average. 27 of them were semiconductors. 8, 9, 10 days ago, 0 were semiconductors. In other words, the market worked out all of that froth. So if you showed up to buy something at 8, 9, 10, 12, 15 times its ATR above the 50, the market rinsed all of that froth out. 27 out of 42 stocks were semiconductors extended from the 50. Less than 2 weeks ago, 0 were semiconductors extended from the 50. So that's a huge, you just have to kind of know that. And for me, again, more than 4 times, there's just not a lot of meat on the bone. At 7 times, I like to trim. And then every ATR above that, I like to trim some more. Moving on with execution, cutting losers quickly, the single most important skill. You can have mediocre everything else and still make money if you cut losers fast and let your winners run. I think it was Pat Walker who said this. You're supposed to cap your losers, not cap your winners. So if you have a loss, you take it quickly, but when you have a win, let that sucker work. If it's above the 10, above the 20, let it work. Once it starts to get extended, ATR, consider yourself very lucky if it gets to 10 and 12 and 15 times its ATR from the 50. I consider myself super blessed when Dell got to 20 times its ATR from the 50, that at that point, you kind of got to have it in you to just know to step aside. The stops lives where your thesis is wrong. For me, that's typically low of day or a prior low of day, not where you're uncomfortable. Stops are structural, not dollar-based. At least that's always for me. I always know the dollar amount that I'm going to lose before I enter based on structure. Where am I buying? Where's my stop? How much am I losing in case I'm wrong? Based on how many shares I can take. And then that helps me adjust my position sizing to only take a 0.3% loss if I'm going to have it. No trade ever loses more than 7 to 8% from entry. Otherwise, the chart's just not that tight. Most of the time for me, 3 to 5% seems to be about right based on the stocks that I'm trading and their average daily range. And then math is asymmetric. A 10% loss needs 11% to recover. A 25% loss needs 33%. And if you lose 50% of your portfolio, you need 100% gain to get it back. So keep losses small. Very, very important. And then moving averages is a trailing tool. The 10, 20, and the 50, nothing else. I do use the 200. I think that is the ultimate line in the sand. Above the 200, very important. Below the 200, what the heck is going on? Moving averages are not magic lines. Again, they're just general areas where buyers and sellers can potentially be interested in it. A lot of traders do use them. That's why they are as valid as they are, but they are definitely not the holy grail. I know some people who use the 9 EMA or the 10 SMA or the 21 EMA. I use the 20 SMA.
I like the 9.5 whole moving average. Actually, that's the holy grail for me. Actually, it doesn't matter. It's all about the areas that these are a part of.
Exactly right. I put much more emphasis on price structure. So if you're building technical higher lows. I find that to be way more important than where's the 20-day. If you undercut the 20-day, but you built a structural higher low, I'm still hanging out in that trade. And a really good example of this for me was last year on this ARC trade. And I was using at this point, so I had bought this breakout, and you started to have these pullbacks. And I started to kind of view these as like even where you broke down, but you're still above the 50. At this point, mentally, I was like, I'm going to use the 50. So because I had already trimmed my position. This pullback didn't necessarily bother me. And then I knew when you had made this sharp move right back up to highs, I knew that I would then be using August 1st low structurally as my higher low. Well, when you pulled back again, breaking the 50-day on this day didn't bother me because you were still above that August 1st low. And then this next pullback did not bother me because you are now above August 20th low. So structural, just price structure is much more important than a lagging moving average. I can then sit through these higher lows and it not bother me in any way, shape, or form. And eventually I was stopped out on November 6th because you had broken what I thought to be was another fairly important little base which it had built. So once you kind of got to this close, for me, that was it. And, for now, that has kind of turned out to be the right idea because I don't know that I would have been comfortable watching this thing go, basically back to where I bought it. So, yes,
okay,
at some point...
Actually, sorry, with this chart, we talked about those bad bars earlier, and this is a good example of bad bar off the top, and that gap down...
Yes,
finally,
here.
Yeah. So that gap down finally loses that close, really, which is interesting. Switch sides.
Sorry.
No, you're good. Yeah, that bad gap down there, that to the 50-day, you finally kind of really lose that close from that day. And those bad bars off the top like that, when a name's been trending and then just completely out of character bad bar, I call those like base starter bars a little bit. Like the stock's going to need a little bit of time or a lot of time. I think TTD, there's just an example that comes to mind. Can you bring up TTD back in 2021? This stock has gotten destroyed, but
here.
Yeah, no, I think
2021?
Yeah, 2021. Yeah, off the top there. So it made a new high, and actually to the left, but that's another one. But all the way to the left, there's this big bar. Yep, that's what I'm thinking of. Look at that negative bar. This was a leader up until that point, and then it needed like 2 years of consolidation to work that out, and then it had another off the top there. So those big out of character bars for me, something to keep an eye on as well when I'm holding this
thing has just been rough altogether.
Yeah.
Oh,
it was a great name during 2020, man. Like this was great.
Yes, it was.
Yes, it was. 3 weeks tight, like at the cup and handle
was
spot.
So nice right here too.
Yep. That's a classic cup and handle with the shakeout and everything. Great stock to study. I mean, look at that shakeout.
Point and handle with this shakeout.
Yep.
And you talk about like compression up the right hand side. Look at how narrow of a bar this is on June 20th or June 1st. Like this is the kind of candlestick when I'm looking at the right hand side, I am going, man, that looks amazing. Because if I buy it over a prior day high, I could set my stop to this day's low and be no risk at all. And obviously that ends up working out, great. That ends up working out really, really well, where you just get, even a couple of weeks of momentum. I mean, 40%, not bad.
Yep.
Not bad at all. Okay, so moving averages is a trailing tool. Again, the 10, 20, the 50, the 100 and the 150, they're noise. I have them on my charts for visuals. I don't trade off of them or around them, but there is a big space between the 50 and the 200. So I have them there visually. The 200 is a market health filter or a market stock filter. Like if you're above the 200, technical chart patterns that are bullish chart patterns that take a place above the 200 for me are bullish. Technical chart patterns that take place below the 200 should be viewed under a bearish lens. Of course, you do have reversal patterns, right? I'm sure you saw this tan. And again, the market gives you them every now and again. where you get this, you get these, I don't even know what you call this thing. What do they call this one, Richard? Shooting
the
star,
island gap,
island gap.
Yeah.
And you saw it with Microsoft as well, where you got over the 200 island gap, and then it just gets all bad from there. So yes, the market does give you them, but again, for the most part, below the 200, no good. Above the 200, okay, fine, we're cooking. And technical, clean, bullish technical setups should be viewed under a bullish lens. Above the 200, below the 200 with a bearish lens. Keep it simple. And if you've got yourself a good trend, you'll notice that the typical news for something above the 200 tends to be bullish. And then when you're below the 200, any kind of bad news, tends to get hammered below the 200. Okay, moving on. Management, and we are down to our last couple pieces. Trim, add, scale, rotate, turn winners into outsized winners. So momentum burst, trimming into strength, and then harvest before the mean reverts. So a momentum burst is an 8 to 20% expansion, and that is all obviously depending on a stock's average daily range. Over 3 to 8 days, I typically look 3 to 5, but you can go 8. Sometimes stocks coming out of a correction, even better, right? To be patient for the 7, 8, 9, 10 days. That a stock will shoot up for before you get a pullback. I like to finance my trade into that, so de-risk some of it, and then that allows me to comfortably sit through pullbacks. So 3 to 5 days, especially now I say 3 to 5 because stocks move so much faster than like at any other time. So you get like this 3 to 5 day momentum burst, trim into that. I personally like to trim anywhere from a third to a half of my position. If I get a 20, 30% move in 3 sessions to 5 sessions, I like to just take off half, right? If it goes higher, you still have half. If it comes back lower, you'll be grateful that you sold half. You can go to sleep at night, knowing that you captured a 20% move. After that burst, the odds of a multi-day pullback are sideways. They do rise sharply. Stocks tend to revert to the mean once they get extended from their key moving averages. And then again, layered trims as well as trims into extensions. So sell a third to a half after that strong 3 to 5 day push, and then trail or that 15 to 20% move, and then sell into other pieces. And it doesn't necessarily have to be quote unquote parabolic, but into 7, 8, 9, 10, 11, 12, every ATR above the 50 simple moving average, I like to trim some more and trim some more. And I personally just do 10% of what I have left. So my trims actually get smaller and smaller and smaller and smaller until I think you've gone ballistic like Dell. And then, thank you very much. I'll just go ahead and take my exit here. An extension is what is up a lot, vertical, closing on highs with accelerating volume. That's when you sell. Again, Dell reminded me a little bit of Oracle, but Oracle just so happened to peak when the market was then going to go through some volatility. Dell just so happened to gap up when the market, was going to do a little bit of pulling back, but potentially, go on a continued run from here. Adding to your winning position. So you add to your winners, you never add to your losers. If you're adding to losers, you're already fighting with what the market's telling you. And the market, if it's telling you that you're wrong and you're adding more, again, just fighting what the market's telling you. You need to know where you're wrong so that if you get there, you're not buying more, you're just getting out. And then each ad must be triggered by the stock proving itself further. What I mean by that is it's giving you another clean technical setup. So if you're buying an undercut and reclaim or the oops reversal or a reclaim of the 50-day, you might get that oops reversal and then you get 3, 4, 5 days up in a row and then you trim off a tiny little piece. But then the stock builds higher lows against the rising 20. And that second higher low gives you a very, very tight day so that you can add more above the prior day high. And that is completely fine. But that is the stock proving itself to you after you've bought it well, got rewarded, paid yourself. Structurally, it did nothing wrong. And then it gave you a follow-up setup. You might own it for another 3 weeks. You're up 30, 40% on it. Then it gaps up on earnings. Now, all of a sudden, you might have a HVC to work with. Now, all of a sudden, you might have a fishhook setup to work with, or a high tight flag, or a high tight pennant, or another technical setup for you to be able to add more shares. So again, a couple of clean adds. If you get your first bull flag, and then the next range expansion, you can go ahead and add to your position. So pyramiding. So initial, you have your first full percent, or your first amount, let's call it 1,000 shares. And then your next add, I never double my position size. So I always take a little bit less than what I already own, as to not screw up my cost basis too much. I think that's more of a mental thing. But there are times when you can own a stock for several months. It gives you a really nice consolidation. And then I just treat this next buy as a brand new position, as if I didn't own it from lower. And then move the stop on that position every time you go to add. So if I buy it as a brand new position, my stop on that brand new position might still be low of day, but structurally, if I own some from a few months ago, I might already be trailing the 50-day with those shares. Compartmentalize that, where if you're adding more, treat it like a brand new position. And that is really the only way I do like to pyramid into my stock, is if I'm buying it and adding to it as if it were a brand new position. And then progressive exposure, I find this part to be incredibly important. So you're earning the right to size up. Exposure expands and contracts with the market environment and your recent performance. You earn, and the market earns your investment. So you get a follow-through day. It's a valid one. You buy something. It works. You buy more. That works. You buy more. That works. You buy more. That works. You buy more. You're getting aggressive behind things that are working. But if you get a quote-unquote follow-through day and you buy something and then the market goes and takes out those lows, you have only put on a position or two, and the market didn't prove those to be winning positions. You got knocked out. Now you're back in cash, and you haven't put yourself in more harm's way as the market then maybe wants to turn back down. So the market has to earn your investment. Progressive exposure, again, along with proper position sizing, to me is one of the most important ways to keep yourself out of harm's way and to minimize your drawdowns. Catastrophic blowups happen when traders size up right before conditions deteriorate. This makes that blow up impossible. You could still slowly paper cut yourself to death, absolutely, but if you adhere to progressive exposure, it really limits the possibility for you to just quickly blow up your portfolio. Pilot positions first. Again, I don't even know that I would get myself to 25% invested or invest 25% of my portfolio in a single day. I know with Bill O'Neill, and I've even listened to Mike Webster on this, getting 30% of your portfolio on or just after the first couple of follow-through days, and Richard, maybe you could speak on this because I know you've spoken with Mike quite a bit, getting to about 30% invested on the follow-through day and just after seems to be about the sweet spot, but they go after a couple of stocks. They don't just go after, 30% or 25% in a single name. Again, I won't speak to Mike's personal portfolio, but if you're managing, Bill's portfolio, it would be, let's say, 30% over the course of 2 days, and then build on from there as more setups kind of materialize. Okay, and then constructing an open portfolio from single trades to a coherent book. So in a strong market, 4 to 8 core positions. I could typically go a little bit more than that, right? Especially in this most recent environment, you probably got up north of 12 positions. Again, you'll hear even from some of the most popular canceling traders, it is being a little bit more concentrated in 4 to 8 names is a little bit better than having super small position size in 20 stocks. Your top 2 to 3 to 4 leaders should probably be your biggest positions in a weaker tape. 2 to 4 names I also personally do not mind playing the other side of the market if the market starts to see some distribution. So I will almost always have at minimum 4 to 6 positions open, sometimes even on both sides of the market. So again, your open heat is your total loss across every position. If you were stopped out today, you want to kind of cap that at about 2%. And even that to me is just a touch high, but that would be about it. Not going to get more exposure if you're at 2% equity. And then again, if you put on 3 semiconductors, treat that as one position, right? The last thing you really want to do is get deep seeked. For anybody who knows what I'm talking about, if you have too much exposure in just one sector, correlated names, treat that as the exact same bucket. So if you bought AMD, Marvell, ARM, SanDisk, Micron, you got to start to kind of treat these things as the same exact basket. They tend to go up together. They tend to pull back together. So something to keep in mind. And then
one question, sorry, jump in.
Yep.
That open heat 2%, is that kind of looking at newer trades? Because what if you have a trade that
correct
is just trending, it's above the 21 EMA, like it could easily have, 5,
I don't
10%.
even think about those, Richard.
Okay.
Because under most circumstances, those have already been trimmed.
Mm-hmm.
And even if you get stopped out, and I kind of made a tweet about this, and it really helped me with my mentality. I never look at my unrealized gains as my money. If you started with a $100,000 account in April, and then all of a sudden you got to $160,000 by June, but then you're in a bunch of positions, and maybe they're trimmed, and then all of a sudden, the market gets crushed. You eventually get stopped out of all your names, and you end up with $148,000. Did you lose $12,000 because your unrealized equity peak was 160, or did you make $48,000 because you started at 100? So I only like to, if I'm gonna give back some unrealized gains on a brand new position or on a position that I've had open, not a problem. But that's not the same as taking red on a brand new position to me.
Right, agreed.
So if I have $20,000 in open profits and I close it for $15K, I made $15K. I gave back, a quarter of the open gains, but you still made $15,000. But it's way different than opening up a position and then just losing $5,000.
Yep.
So, kind of thinking about it like that.
Yeah, makes sense.
Flipping from long to short, trading the other side of the tape. Shorting isn't the opposite of going long, although some people do, and you can flip the chart upside down. As silly as that might sound, it's its own discipline. Obviously, if you're trading stocks that are hard to borrow fees, and then of course there's unlimited upside risk. I do like shorting into declining moving averages, and then you couple that with a 5-minute 620 setup back to the downside, and then again you get much more traction on the short side of the market when the index loses the 50, when the 10 is below the 20, or of course you're focused on stocks that are already below their key moving averages. For instance, like any of the MACs, right? You look at Meta, or you look at Microsoft, or you look at Palantir, or you look at if you're actually shorting that side of the market, traction has been much easier to come by if you're shorting stocks that are already below their 200-day. And then same thing, you're going to cap your individual short risk at 1/4 to 0.5% per trade. I personally like 1/4. And for me, similarly, Richard, when I'm looking to get myself involved on the short side, there's only 2 types of shorts I really like to trade, and that's extended parabolics or just the opposite of what we look for when we're looking for that follow-through day. And names that have been showing the best relative strength, I like to say to myself, what names have been super weak? And then when the market starts to show you some periods of distribution, all of a sudden, you're shorting, and it could be, MSTR if you want to short MSTR. Pretty good example as of late could be a name like Carvana, right? Maybe a late stage base. And you've got this late stage base, you're back below the 200, and you're shorting these pushes into flattening or declining moving averages back in March and February, you were seeing lots of that. You could look at a name like Uber, and effectively every single visit of the 50 simple moving average was a short opportunity. But that's something that you're prepared for, knowing that, hey, if the market's going to undergo some distribution, what's already showing some relative weakness, how can I get myself involved in that side of the market if that's something you choose to do? If that works, it's not because you're a genius, it's because you're seeing things well, the market is rewarding that side, and your entry tactics are on point, right? Normally those three things come together, and it's the same thing to the long side. You're onto the right groups, you're seeing things well, your entry tactics are on point, and the market's helping lift the group that you're in. It's the same thing to the short side. If the market rewards you on the short side and you go and take another and it works, and another and it works, and another and it works, you're using progressive exposure on the short side as it's working. You're not arguing with the market like it should go down. Everything's a Ponzi right now. Yeah, the government can't keep pumping the markets, and you're just stubbornly shorting names at 52-week highs is not the way. If you want to short a parabolic, fine. That has its own criteria as a setup, and that's not something that, we should be talking to with newer traders.
Are you quicker to de-risk or take a partial on your shorts versus your longs? How's the position management a little bit different with these?
Yeah, if you're shorting a parabolic, then for me, it's, I'm looking for like day two, right? So you'll get like normally day one, it's usually a big unwind. And then day two, you'll get like maybe a small gap down and a washout. I'm taking some off because I know things can only go down so much. If you get 30% move down from your entry, you've nailed it, right? That on the short side, 30, 40, I mean, that's a big move. Like 50% move down on a short side is huge. So yes, a whole lot quicker. If you're shorting a parabolic, I'm looking to cover into the ascending moving averages effectively, which is also why bounces from ascending moving averages can work so well, because you've got short sellers looking to cover in some of those spots. But if you're shorting something below the 200 simple moving average, 3 to 5 day washout, cover it, and then just trail with a declining 20 day, for instance.
Cool.
And then just play it just like that, just like you would a long, and try to be patient. We don't know how long something can fade for. But again, it just becomes really tough because there's only so much things tend to go down unless your name is the Trade Desk and Duolingo.
Yep.
Those are about the only two. But yeah, 30% parabolics, or if you're playing into a stage 4 breakdown, then treat it almost as you would a long. 3 to 5 days on the momentum washout, and then just trail it on the declining 20 or the declining 50. And then finally, for the last little section, this is fairly quick. Survival, staying in the game long enough to compound, handling a losing streak, surviving the storm so you can compound after. So a 35 to 45% win rate, I tend to kind of fall in like that 37 to 40 is totally normal. Streaks of 4, 6, or even 10 losses happen. That happened to me in October, and it was still a profitable month. What matters is how you aggressively shrink. In other words, how do you shrink your position sizing so that you go from, I'm taking 10% position sizes to 7 to 5 to 3. And then again, mechanical degrossing. So going from, let's say 70, it's like going from, I'm taking, 100% size, which could be 10% of your portfolio, to then 7, to then 5, to then 3. All should be based on your own prior traction. And then as you're getting stopped out of your positions, I don't really use staggered stops too much, but that is something that I've been kind of trying to learn and incorporate. Shout out Jeff Sun for putting that on my radar. And that is one of those things where if you buy a breakout, but then it just doesn't quite break out, take off a third, take off a third, take off a third, stop low of day, or stop at the low of the pivot, but without having your full size at the low of day pivot, right? Usually when you buy a breakout, the best trades go and they don't turn back around. So that's what you want your stocks to act like too. So drawdowns are signals, right? Either the market changed, your setup stopped working, or your execution is off. The answer is always to trade smaller. Either you're not seeing things well, the market is not being friendly, or your entry tactics are terrible for the environment that you're in, or you're just flat out playing the wrong side of the market. All of those scenarios, you want to be trading smaller. Losing streaks make you want to do more, which is counterintuitive. You want to make that money back, right? But again, the right answer is always to do less. Go for a walk, go lift some weights, go to sleep, pick up golf, do some fishing, do some hiking, play with your dogs, do anything but trade more. Again, if you like shorting the market, and this conversation is hopefully based more towards newer traders, shorting the market is probably not the first thing that you should get yourself into, then maybe there is something for you to do in a crummy environment. But if you're on a losing streak, it's most likely because you're not a genius for what you're doing for the environment that you're in. If you change what you're doing for your environment, then you might feel like a genius, right? In March and February, shorting against the declining 50, and I could find 50 examples of that chart, like Uber, was the thing that's working. If you started to buy stocks from April until end of April, you're a genius because you're going long. So, yeah, hopefully that makes sense. So doing less when you're having a losing streak. Don't let perfect get in the way of progress. The trap of paralysis and over-optimization. Again, focus on what you know. Perfectionism is a stall tactic. When you're afraid to be wrong, you don't need to get everything perfect. Again, as a swing trader, I'm right 35, maybe 40% of the time, even in a good environment, even during April and May. Market pays for compounding, not for being right. A B+ trade taken beats an A+ trade watched. So again, the when is very important. You could have a B+ entry, but if you understand that the environment is there and you take that entry, is much better than if you're just waiting for something picture perfect. I know, Richard, when we do these model books, and I've made a model book myself, I am putting SanDisk on there. I am putting NVIDIA on there and gold on there. But if you're waiting for that, you're going to be waiting for a really long time. And so if you're waiting for this quote unquote A+ to come around, this perfect chart in a perfect group with accelerating, if you need everything to be perfect, oftentimes the best charts, the best entries, the best setups get away from you while you're waiting for perfect. And then common traps, waiting for the exact pivot to hit, doing a gazillion back tests, right? Sometimes, getting in there in real time is the best way to learn. And then, when you miss an entry, you size it up 3x the size because you're like, oh my God, now I got to get the chart. That will absolutely kill you. And then a predefined trigger. So the night before, I do a nightly watch list every single day before the next day. I don't ever go an afternoon without putting together a watch list. That is predefining the stocks you want to watch for the next day, predefining your entry tactic, knowing the if this, then that scenario for both the long and the potential short side the night before with alerts set, so that when your alert hits and you're like, it's hitting to the upside, you know exactly what to do. My brain then goes, how are the other stocks in the group acting? How is the market acting? It's time to, execute. And then that's it. Now you have all the pieces. Hopefully that was pretty good. Read the regime, find the leaders, wait for your setup. Part number 2 is risk first, stops without negotiation, trim some into strength, and then shrink your size during drawdowns. You can still take that B+ trade. You don't have to wait for perfect. Perfect is very rare. And then, let your money compound through doing the right thing day after day after day after day. And don't forget to do your nightly homework so that you can be prepared for the next day.
Awesome. Well, you covered a ton today, so thank you so much for the depth here. There's a lot of nuances that you shared. So a lot of folks, I think, will have to watch this multiple times. But this is fantastic. And if you had to say, one overarching message that you want everybody to walk away with having watched this, what would you tell them to focus on, or the biggest piece of advice that you want to share?
Yeah, I think if you're a brand new trader, obviously, if you're a seasoned veteran, you obviously don't stop learning. But if you're a brand new trader, don't be overwhelmed by what you still don't know. To take things, and as the name of this slide is, of these slides, it's puzzle pieces to profitability. You have to remember, take things a small little thing at a time. How do I find the stocks to trade? What is progressive exposure? What is position sizing? What are my entry tactics? What is a clean technical setup? How do I view groups? What is the market overview? But take time to learn each of those puzzle pieces. And once you learn all of those puzzle pieces, that allows you to put the whole picture together. Don't get overwhelmed, because this is at moments, Richard, you know this, it can be an overwhelming career. But if you take the time to learn all of the individual pieces, you can then make sense of the whole without feeling overwhelmed. Like, I just don't know that, I just don't know that, and then get overly frustrated at something that is truly difficult. So focus on one little thing at a time. Treat this as a long-lasting career, not as a hobby. And amazing things can happen, Rich.
Yeah, you might have to relearn the pieces a few times over many market cycles. I know I have had to relearn stuff.
I have too. Yeah. We're, again, I'm not perfect. Like, if I were perfect, I'd have bought SanDisk on January 1st. Instead, I'm buying it 250% higher. And then even that I didn't hold perfectly. So there are always things that I can look back at and just say, I didn't do that well, I didn't do that well. But as the next market cycle comes, I'm improved for the next bear cycle,
yep,
for the next bull cycle. And then you get that follow through day. The important part is that we catch a meat of the move, however long that move might be. And then you can reflect back when it's all said and done and say, what did I do wrong? What could I have done better? And what did I learn from this experience? And everybody has to do that. Even watching this and reading through these slides and going through it yourself, you're never going to be perfect. Let's forget about that, right? Nobody is perfect. I know the best traders in the world who make mistakes all the time. That's not the game here. The game is to make money. It's not to be right, right? People want to be right, which is actually why they have such a hard time selling their losers, because they refuse to be wrong. But if you accept that you're going to be wrong a lot, that actually helps you make more money down the road. So again, don't be overwhelmed. That would be my kind of my lasting message with people. And take every little piece. And there's probably a lot of other little pieces, Rich, that we could talk about. But take every little piece and study it, break it down, and then realize how everything kind of layers on top of each other, even though they're all separate nuances that help you become more profitable. So hopefully that helps, man.
Yeah, this is fantastic. And thanks again for putting this together. And each of these pieces, it actually, and not to do like a selfish plug, but like the book that we wrote, the Trader's Handbook, it fits really well with that, because each chapter of that is kind of one piece that you laid out, routines, entry tactics, screening. So for people looking for more guidance, that's an option for you. This
Love
Trader
that.
Handbook. But yeah, this was fantastic. And again, I think people are going to have to watch this multiple times to really get everything you share today. But appreciate it immensely. Thank you so much to everybody watching. I hope you guys enjoyed. Let us know your biggest takeaway or nugget in the chat right now or down below in the comments. And with that, we'll be right back. Thanks, everybody. Okay, welcome back, everybody. It's my pleasure to introduce the next speaker of the TraderLion Conference. We have Brian and Shannon. He's an experienced swing trader and educator. He's the founder of AlphaTrends.net and the author of multiple excellent books like this one here. We'll be touching on some VWAP strategies later on in this conversation, but we're going to cover quite a few topics. And to start with, Brian, first and foremost, thanks so much for being here and for your time. I'd love to go through this graphic here, which I know you've kind of prepared on your side to kind of talk through the golden rules of engagement and some high-level principles that have helped you as a trader and help you teach a lot of newer traders as well.
Yeah, always a pleasure to be here, Richard. Thanks for including me again this year, and great event that you guys always host. So this is, as you said, something I share with Alpha Trend subscribers. There's just kind of some, I have them as golden rules of engagement. One of the strategies that I created, it must have been 15, 16 years ago now, is don't chase the gap, wait for VWAP. And I've written about that in the Anchored VWAP book as well. But, a lot of times what you'll see is a stock gaps up because of some news or whatever. And we all know the situation. And, amateurs will get excited and say, wow, look at the great news. They'll chase it. It runs, let's say it's a $50 stock. It runs 50 cents after they buy it. They feel like, wow, I'm the hero. This is great. But then it starts to fade. It breaks the volume weighted average price, and maybe it never recovers. Maybe it drops, closes the entire gap, let's say to $48 per share. Now they're down $1.50, and they're thinking, well, look how good the news was. So those initial buyers, sometimes those trades do follow through. But majority of the time, they're going to at least undergo a little bit of profit taking, or some people are going to try to fade that move, add some short to it, and try to either make a scalp or see if that gap will close. So what I observed was let it settle down a little bit, let it regain, let it undergo, bring in the short sellers, a little bit of profit taking from people who are saying, hey, don't look a gift horse in the mouth. And then it instead starts to stabilize and recover back above that volume weighted average price. It says that initial imbalance has been wrestled through and the buyers are back in control once it's above that daily volume weighted average price. So that's the point where I say, okay, now we know the buyers have control. It's their game to lose. So I will often enter in that, as it crosses above that VWAP with a stop below the low of the day, maybe even that tight, or somewhere closing the gap. So that's number one. And it actually stems from just what's underneath that. Before you enter, ask, where has it come from and where does it have the potential to go? So let's say this stock ran from 40 to 48 in the prior week, and then it gaps up. I mean, we could talk about Micron, right? That Micron was in this huge uptrend. It comes out with the best numbers like any company has ever done, maybe, right? Just unbelievable numbers. And what happened? Well, it initially rallied and then it started to fade, and now we're well below that initial high. And what we have to say is, was there a lot of energy expended getting to that point? So back to my example, let's say it went from 40 to 48, then the news comes out, it gaps up to 50. Well, you got to think, well, this stock is up 25% in the last week. Is the smart money, the educated money, buyers up here or sellers? So what's most likely? Is it likely that it's going to go from 48 to 55 by the end of the day? Doesn't mean it's not possible, but we're interested in what's most likely, what's probable, not what's possible, and putting the odds in our favor. So it just says, be careful. It's expended a lot of energy. The upside might not be there as much, but then you look at it and say, where does it have the potential to go? And where is it likely to encounter a source of supply that might be strong enough to offer resistance? It might be a prior support level. Support broken tends to act as resistance. So if it runs into this level where at $50 it was a year ago and traded sideways for 6 months there, well, that there's going to be price memory there and most likely some supply. So it lessens the likelihood of it following through to the upside. So again, and then, the final thing is the perceived risk worth the potential reward? And where do you manage risk from there? So you have to have the next one to the right is a stop loss strategy. So you have your initial protective stop, which of course just protects yourself from protects your capital from losses or outrageous losses that, from keeping them reasonable. And having that strategy say, okay, if the market disagrees with me, I know where to move aside. So the only times that, let's say I enter a trade that day, the only time I'm going to adjust that stop is after it's traded for a couple hours. So let's say the stock runs for, it doesn't gap from 48 to 50, but I buy it on a break past some supply at $48.10. And, 2 hours into the day, it's at $50. Well, at that point, I'm not going to keep my stop at, let's say, 46, where it initially was. Now I'm risking $4, $2 of profit and $2 of my initial capital. Ideally, I can make it so that I put it at, at break even, so that I'm not going to let my winner turn into a loser. So, and the other thing is that for open positions, this is what gets a lot of people, is especially in an uptrend, when we have the market trending higher and the market gaps down for whatever, maybe no reason, maybe because something happened in the Korean market, or because of a jobs report or something like that, we get that knee-jerk move lower. But we're down to an important level, let's say the 20-day moving average in the market, and it'll turn sideways for a few minutes, then the buyers come rushing in, and it goes and closes positive on the day. Well, anyone who had their stop set prior to that open, they're gonna have the stock stolen from them. So again, let's say I own the stock at 48.10. My stop is at 46. It opens at $45.90. It ticks lower for about 3-4 minutes, hits a low of 46.85. Did I say 45.85? And then it starts to recover. So I look at it and say, let's give it at least 5 minutes. If the stop was at 46, now here it is 45.85 was the low of the first 5 minutes. I can't tell you how many times that has kept me in a stock that does go back and turn red to green. And what I'll often do, not often, but sometimes do, is say, there's nothing wrong here. In fact, if I was to throw this away, it would be a stupid thing. So now if I can buy the stock at 46.05, add to my position, average down, because it's a rare time when I'll average down, but my stop is, if I'm buying at 46.10, my stop on the entire thing is at 45.83, 2 pennies below that 5-minute low. Now I've lowered my cost basis to $47.05 per share. And as it runs up to that 47.05, I might sell the initial position that I sold, that I purchased, the secondary piece, the 46.10. So now I've got my full-size position, and I've lowered my cost basis, and I'm break even on that, and I'll keep my stop below the low of the day, and it's just, again, a risk management technique. So now I've got this stock at a better cost basis, and I always hold on to, I'll look at it as just a psychology trick, is that, for me at least, is that I will sell my lowest cost basis first, because my highest cost basis.
Right.
Sorry for that. First, and I will look at it and say, now here's my position, and go from there. So again, if it gaps down in the first 5 minutes, so the bottom line is, just don't set your stop in the first 5 minutes today. Don't panic and throw your stock away. That's what I'm looking for. If I look at a stock and I, tell subscribers, or it's my plan to say, I'm going to buy above $48.10 with a stop of 40. I don't know why I'm saying 46. My stop would likely be $47.38, 2 pennies below a low from yesterday morning at 47.40. So if the stock gaps down to $47.35 below what was to be my stop, to me that says the trade's invalidated. The original structure that we were looking for is no longer valid. The higher low that I was going to protect myself against has now turned into a lower low. So the trade is off the table in terms of how it was set up last night. Doesn't mean I might not reconsider it, but most of the times if they break that stop level, it's going to continue lower. So I'm really just not interested in taking the trade, because it will have to get back to the original price. It's going to have to expend too much energy to get there. So the yellow box there, that's more for subscribers, just saying, all the ideas, and actually, but I think it's a universal rule that if I mention something on Twitter, I'm not going to tell you buy here, sell there. I'm going to say, put this one on your radar. Our worst case stop would be here. Make the trade your own. I'm not going to, I don't know the financial condition, the risk tolerance of the experience level of anyone on Twitter. So I'm not going to give advice to people. I'm going to say, here's the setup. Does it make sense? Make the idea your own. And then when it comes to initial profit taking, what I like to do is, and I've explained this to you before, when I have an A-list idea, I'm going to go, if my maximum risk size is, let's just say, $100,000 in a position, I might go $150,000 on the stock. And if I buy $150,000 worth of that stock, as it runs up to daily R2 is the pivot analysis. I've got a little table I can share in a moment that was actually made for Forex. But the Forex one, it's, somebody did a study, and 83% of the time, I think it was, we'll check my memory when we look at it, a stock trades between R2 and S2 every day. So the odds are it's not likely to go much further. And I look at that and say, on day one, that will be often, let's say, again, it's $48.10 that I purchased the stock at. Daily R2 might be at $49.85. So as it gets there, what I like to do is look to take a quarter of my position off. So because I went in extra heavy on it because it's an A-list idea, I want to be able to sleep well and not worry about it. I want to reduce my risk and take some profit and essentially reduce my overall cost basis on it. So what I do when it gets there is I do what I call my 2-minute rule. So I don't want to exit right at daily R2 if it's $47.85. Instead, I'll look at a 2-minute chart and I'll say the 47.85 is daily R2. As it hits that, I'll look at the prior 2-minute bar and say what was the low of that. The low of that might have been 47.60. And then as this 2-minute bar, when it hits R2 completes, if the low of that was 47.70, my new stop is 47.68. And keep trailing it up under those 2-minute lows. And sometimes it'll keep you in for dollars. I mean, it's just crazy how much juice you can get off of that 2-minute exit. So that's for taking that initial quarter risk off. And then I'll go back and, look at where my initial stop is and hopefully be able to bring the stop on the balance up to a much more reasonable level so that I'm no longer risking. But if it still has to be based on structure. So it might not be that original stop is 46.85. It might be now at this point or $47.90. And even if I get hit at 47.95, I've already taken that quarter off. So if I, lose a dime on the 3 quarters and I gained $1.50 on that first quarter, I'm not losing money. And that to me is just a hugely important risk management technique. It helped me in, what was the stock? Just, SoFi yesterday. Anyway, so let me stop there and
yeah.
This is supposed to be an interview, not a lecture.
Yeah, I've got some questions. First, I love the first section that you went over before you enter. Ask where's it come from? Where's that the potential to go? Because stocks kind of expend energy, if you will, as they make a move. And it doesn't mean that it's not a stock worth watching, but you want to let it settle, kind of reset that. And a question I had for you, Brian, is what's kind of the difference between just a higher low, because as it pushes up, it might make a higher low, versus a low risk higher low that you'd actually want to trade? I think that distinction is important to kind of share with everybody.
Yeah. So when I go, for instance, to set my initial protective stop, I want to do it based on market structure. And I'll typically look at maybe a 10-minute, 15-minute, 30-minute time frame and look for the obvious higher low on one of those time frames. Versus if I'm taking a profit on a 2-minute chart, I'm looking at the higher low on those 2-minute bars only. There's no real structure to that. That's just pure momentum. So we're talking about market structure versus momentum. And looking at it, that's kind of the trick, is to say, what is the most recent relevant higher low? For that, it kind of leads into the 5-day moving average. and we can look at some charts on this as well.
Yeah.
Okay, so here's an example of a stock, and it's a winner, so I'll show some losers too, don't worry, for the people wondering about that. But I'm in OKTA right now, and I got involved in OKTA. It was one that I was watching because this was a nice orderly pullback in here. And we had earnings, so this was the earnings report right here. And the stock gapped up on earnings. It had this huge run. And if we put an anchor on those earnings on the 30-minute time frame on the right, you can see right here, you can see that it initially was starting to turn sideways in here, and then it had that shakeout. I love to see that shakeout, and that's something I look for a lot. And then it ran up here and made this higher high. So again, the question is, so I did not buy on that day because it just ran from 107 to 121. It ran 14 points. And I was thinking, well, I'm not going to buy the higher high above the 5-day moving average. It's not just the higher high above the 5-day moving average, but is there structure here? If I'm looking at a higher low, one, I don't have a higher low. I have a lower low. So I don't want to chase that. So instead, I want to see the stock pull back. And then I believe I bought it over here. My price of purchase was $119.50. So right over in here is where I purchased it. And the initial protective stop was right under here. That was my initial protective stop for the purchase of right here. 119.50, yeah, right in that general zone. The next day it gapped up. It ran into the anchor from the earnings, and that was also daily R2. So I took my first quarter point piece off with a gain of $3 per share. And then it came down and all the way back to my purchase price. And I was thinking, well, glad I did that because who knows if this is going to work. And then the next day it gapped up. So I said, okay, stop goes under here. So I raised my stop up under there. Now, as it went here, my stop, I didn't want to put it here. I said, if it goes back below that level, that's now the anchor from the earnings report. So my stop goes under there. And yesterday I took a quarter piece off because it broke out. It actually broke out the day prior. It broke out yesterday, and it was running into strength. So it was really strong. So let's look at the 2-minute time frame. So what I did here was I actually didn't use the 2-minute exit. I said that I used the low of the day, actually. Where'd that, oh, I thought I knocked over my glass of water. I didn't. So I used an exit right here and got stopped out at this point for a quarter piece for a gain of $20.60 per share. Now my stop on the balance is 129.74, which is the higher low below the rising 5-day moving average. That's pretty far away, but it allows me to say, okay, when is the next time that I adjust this? Let's say on Monday we see something like this. It comes down to and even through the 5-day moving average, but then recovers and rallies back up. Well, then at that point, I will set my stop under here because the 5-day moving average will look like this. And that will be the higher low with the rising 5-day moving average. And I might even add one of those quarter pieces back right here with my entire stop under this level. So that's an example of one, obviously, that worked. And if there's, people saying, oh, show us a loser. The losers are boring because they're so, always so small.
Yeah. Can I jump in with a
course,
question
yeah,
here?
Yeah, 100%.
Yeah, so the 5-day moving average, a lot of people had questions about that actually. Could you kind of break it down how you use it? Because you're not looking at it on a daily time frame. It's
Correct.
using that to help analyze kind of structure on the short-term time frames. Like here, we're on the 15-minute, and we're kind of building that stage one along the 5-day moving average, and then you're trading from that compression. So yeah, could you break down kind of how you use that 5-day?
Yeah, exactly. And that's the key, Richard, is I use it, for trend alignments. When we have a stock in a primary uptrend, let's go back to the 2 time frames. It's clearly in a primary uptrend. But over here on the 30-minute time frame, we have a stage 2 uptrend, we have some distribution, we have decline, we have accumulation, and then we have a new stage 2 markup. That's what my first book was all about, is trend alignment. The trends are aligned in this zone because now we have an uptrend on this time frame that's in alignment with the uptrend on the longer term time frame. So the 5-day moving average, as you pointed out, let's just go back to this screen again. So this is a 15-minute time frame. And the only time that you would, if you were to look at a daily chart, the only time you would actually see a 5-day moving average is at the close. If you're looking at the 5-day moving average on a daily chart first thing in the morning, you're looking at the last 4 days plus 15 minutes. So that's not a true 5-day rolling moving average. So in order to compensate for that, I only use it, as you pointed out, on intraday timeframes. So here on it, let's go to a 10-minute time frame because the math's a little bit easier. But you'll see, here's where that 5-day moving average is. And the price right here is 134.35. And what we're looking at here is, I've done this math a million times, but there, over the course of the day, 6:30 local time, 7:30 actually, 9:30 to 4 is 6.5 hours of day of the day to trade in the regular trading hours. So that is 390 minutes per day. In 5 days, there are 1,950 minutes. So the average of the last 5 days is 1,950 minutes. So when I look at this 5-day moving average I have labeled here, you can see the period is 195 because 195 times 10 is 1,950, the number of minutes in 5 days. This orange line right here is something that I created. And what it does is it just allows me to anticipate the direction of the 5-day moving average. So first thing, Monday morning, when we get a new first bar, the very first trade, this orange line moves forward to this bar. In other words, what it does is it allows me to say at what pace, when will the direction of the 5-day moving average change? Well, this 5-day moving average is going to be difficult to turn lower because we've got, unless it's back below this level right here on Monday. So it would have to go back there, and then the 5-day moving average would look like this. That's unusual to happen, but it can happen. So it allows me to, like I said, anticipate. So 1,950 minutes. On a 10-minute, that's 195. Divide 1,950 by 15, and you get 130. So that's why it's in the same exact spot. If we look at the 30-minute time frame, 1,950, well, it's right there. 65 times 30 is 1,950. So that moving average is going to be in the same spot on all time frames. Yep. Sure. This is one I was stopped out of yesterday, SoFi. This isn't my normal type of trade, actually, because I probably shouldn't even show this because of it, because it has a declining 200-day moving average. However, the 200-day moving average is so far away, and even the anchor from the tariff loans, I was thinking, well, Robinhood is getting some action. I should have just gone with Robinhood. And this stock is bumping up against the year-to-date anchor with more frequency, and we're seeing higher lows. So what I was looking at in this setup was these higher lows indicate the buyers are getting more aggressive. They're not waiting for a pullback to 15. They took control at 16, and they took control at 17. And while that happened, we had the 20-day moving average rising up through the 50-day moving average. And looking at that 20-day moving average is going to continue to rise. Now, the 50 is still declining. That's what this line is here because we're averaging this data out. So it just started to decline again. So in this case, I had purchased SoFi at 18.25. It must have been this day, just 2 days ago on the 1st. And that very first day, it wasn't much, but the 2-minute exit, we can look at it here. When it hit, we won't see a daily, that's just 1 day's pivot. But okay, I had it circled. This was daily R2. Daily R2 on that day was actually right here. And it came and made that lower low on the 2-minute time frame. So I sold my first quarter position, and it actually was only 14 cents per share. But still, that's how I do it. So I wasn't looking at the number of, how many cents or whatever. My initial protective stop was at $17.82. That wasn't actually my initial. My initial protective stop was $17.70. So I raised my stop 2 days ago to $17.82, So I took a quarter position with a 14-cent gain, lost 43 cents on 3/4 of a position. And that means on average, I lost 29 cents. The original stop was 77 cents away. So it ended up being a 0.37 R instead of a full R by taking that first quarter off and raising the stop up.
Yeah, perfect. And I think people might be wondering, what's kind of your process for finding these trade ideas? Do you have screens you use? Is it more of a universe method where you've got a universe of stocks that you'll review each day, each week? What's kind of your process for finding different trade opportunities?
Yeah, so it's more of a universe, as you mentioned, and I enjoy that. Screeners are great. They're really awesome for cutting the workload. For the number of years I've been doing this, I can get through a large list of stocks really quickly. So I go through a master list of stocks. It's about 800. I just did it yesterday, and I whittle it down to this list here. I don't know if that can...
We can kind of see it.
See it.
So you write down kind of interesting names, basically?
Yeah, and these are the ones, and there's maybe 12 per cause. There's maybe like 70 stocks there. I don't plan on trading all 70 of these stocks, but what I notice is things like this when I look at it. And, a lot of people get hung up on prior themes. They get hung up on the themes of, quantum names. So I'll have... like here are a 15-minute time frame of quantum names, or the space stocks, which are the drone stocks, which are declining and not working well. So a couple of weeks ago I noticed ILMN, and I put this on X right over in here, saying, look, I like the way it's consolidating along this 20-day moving average. If you look at the weekly chart right here, it's got room to run up into this prior band of resistance. This looks like an inverted head and shoulders pattern. If the head and shoulders pattern hits, this is our first level of interest. So that's to justify taking a trade there, to say, okay, that's not a price target, but that's a level of interest where it might have the potential to go. If for an investor, they're looking at it, it has the objective maybe of 225-ish. So I look at ILMN and I say, wow, that's the largest gene DNA sequencer in the world. So I look at it and say, well, what other, genomic names are popping up? And I noticed mRNA.
Moderna. Yep. Moderna.
Yeah, Moderna was in a similar situation. And then now I've got Beam, which is another one. And Beam has yet to go. But so here you can see I've been doing some drawing in this chart.
There's a good stage analysis example here. Look at that. Perfect.
There's a great stage example and anchored VWAP. So there's the anchor from the IPO. And here's the anchor from the all-time high and from this peak. So you can see that these VWAPs are coming together to say, this is an important level. Above this level, basically, the biggest losers in the stock from the average price, everyone's making money. So this is, as you said, stage 1 accumulation, stage 2 uptrend, stage 3 distribution, stage 4 decline. If they don't scare you out, they wear you out. Now we've got this nice long-term base where we keep hammering away, and same thing. We keep seeing us hammering away at this level. The frequency is more often, the higher lows are coming in. All these moving averages are stacked perfectly one above each other, and they're all rising. So then I look at it on the daily chart. That's beautiful. It's holding this prior band of resistance. Here's what this stock, though, look at this thing.
It's a little whippy. It's a little the character. Yeah.
Right? And the funny thing is the ATR is only 7.5%. So it's not just that, and that's pretty high. That's, but it's what it does. This is clearly not a stock to buy on strength. If you buy on strength, you're going to have these things happen to you over and over and over again. So instead, you look at it and say, okay, now on this shorter term time frame, the 30-minute time frame, we just saw this shakeout on what day was that? This is so that was Wednesday. It recovered yesterday, and now I bought a little bit of it. My worst case stop is under here. What I really want to do is raise my stop under here, and I probably will add to it because I don't have that larger size position. If it pulls back, I think what I'm likely to do is actually add call options because I don't like the personality of this stock. I actually I have been trading it a little bit and selling into this strength, but I want to be in for the move. I don't want to be in for these little stupid spikes that fail. And I think that holding options is probably a better scenario for me. So anyway, so to answer the question is I will then start to say, well, what else is on my list of genomic stocks? And DNA just ran from 7 to 11. So, where has it come from? From 7.5 to 11. And where's it potential to go before it's likely to encounter supply? It's right there. So is buying here a good low risk idea? No, that's just chasing. That's dumb. The people who buy this breakout are likely going to end up spitting it out in a few days, because what's most likely with this stock in the 30-minute time frame is that we're going to see something like this, and then if it comes down and in the next few days we get the 5-day moving average to this, then I will be interested in buying it here. And maybe it pulls back to, let's say, that that anchor, and that's the daily time frame, but this is what it'll look like on the intraday. I noticed just going in through charts yesterday, I was looking at, at first I think it was CCJ that popped up, and I was thinking, wow, CCJ looks like a short here. I mean, this thing looks awful. You look at the weekly time frame, it looks terrible. So I looked at, UEC, and a lot of people are still hung up on, energy for the AI power. But you know what? That's yesterday's news. This is a big head and shoulders pattern. Doesn't mean it's going to go do what it indicates. People are still hung up on this stock, ONDS, which is a kind of a cult drone stock. But, stage analysis 101, uptrend, sideways. It just broke some major support here. And the interesting thing here is you look at the anchor off of the IPO and look at how that had been support.
Yep.
Now it's become resistance. So you break that down to a daily time frame, and there's the anchor off the market low. And here, support broken, acts as resistance. It's doing exactly what it's supposed to do. And I still see people on Twitter saying, what's wrong with ONDS? I'm buying more, to the moon, it's going. And, that's not the way money flows work. Anyways, I went on a little bit on your answer, but it's a manual process.
Yep.
I notice themes. And when I find, 3 drone stocks that look weak, it tells me, okay, if we get a pop because of some headline, it's most likely going to be sold into. Don't get excited about it. It's probably not worth looking at. Same with uranium plays. All the, even in the SMRs, OKLO, they just look awful on pretty much all time frames. NNE, SMR. They'll probably go up on, next week, and people, there's the new one. But, structurally, they're broken. They're going to need time to heal. If they don't scare you out, they'll wear you out, focus on where the strength is, all that good stuff.
Perfect. So just to double click on what you said there, you've got a universe of stocks that you go through on a day-to-day basis. Each of those kind of has a theme that you're aware of. And when you start to notice one chart setting up, you try to investigate and see, okay, are there any sister stocks also acting well? LLY as well as another, biopharma name that's been shaping up. That theme, you start to see, similar charts setting up together, moving out of bigger patterns. That's what gets you interested in a theme. And then similarly, all themes have their time when they end. And we had a great space, drone theme, earlier, but now that theme has kind of exhausted itself a little bit. So am I accurate in kind of what I just described? That's kind of how you typically do it?
So I'll go into my, lists here. I've got oil service, photonics, power generation, power grid, psychedelics, quantum computing, rare earth, robotaxis, robotics, rockets. So in here, if the group starts behaving well, I'll just look at this group and say, okay, let's sort them by average, by volume. Of course, SpaceX is number 1. And I'll go through them and say, well, Rocket Lab, maybe it's going to try to stabilize and rebuild. RDW, it's broken. It's just left for dead. ASTS, they're just choppy mess. They're just a choppy mess. Learner's down to the 200-day moving average. Who cares? We've still got a declining 20 and 50. Same with Fly. And Iridium is bucking the trend. BKSY. So they're all, SPIR probably looks the best. But I look at that and say, okay, what if I like SPR based on its own merits? I look at the space, the money flowing out of space. I would look at this one and I say, this isn't an A-list idea that I'm going to do extra size. This might be, again, if my size unit was 100,000, I might only do 75 or $60,000 worth of the stock because I don't feel that there's that I have confidence from the market and the sector.
Right, perfect. And I actually wanted to touch on SpaceX a little bit more, like around its IPO, because I know in your book you kind of talk about how to anchor things. That first day. Could you kind of walk us through this recent IPO and how you've been analyzing it using the Anchor VWAP and also just looking at multiple time frames? I think that'd be great.
Sure. Let me see if I can go back to the start. I can't on a 2-minute time frame. Let's do it on a 5. So, as we just saw with ONDS, it's down to the anchor from the IPO. Here's a great example. I've just got to go back on this for a moment. Intel. If you look at Intel and go to, this is daily, how to switch to daily. It's supposed to be my monthly chart. If you look at Intel and anchor to the IPO, look where this move just occurred from. I mean, it's pretty insane how well it holds value and for how long. So going back to SpaceX, what I always do is the very first moment it starts trading, I put an anchor on that first minute of trading. And then I'll put an anchor on the second minute of trading after about 10 minutes. And the reason for that is that first print is a negotiated print. It's all the people who are matched up. Where opened at 135. It opens on its largest volume. You won't see a higher volume bar. Most likely, well, maybe when they add it to the NASDAQ, you won't see a higher volume bar than that. So that's a negotiated transaction at 135. It matches up buy on the open versus sell on the open. So that is not free market trading the way I see it. And oftentimes that, in just for the first day, it'll be important to anchor from that second minute. As we start to see a day and a half, 2 days worth of data, you can just default it to the anchor from the IPO. So when we see that, that's what we want to do, is anchor to the IPO. And while we're above it, so we had initial volatility, it's very similar to an earnings report. Anchor to the open of the earnings, and for a day or two, it might chop around there, but then the buyers take control. What we want to see is, do the buyers maintain control? A healthy IPO, if this was a healthier after market action, it would have done something like this, right? Instead, we ramped it up, gapped it down. We came on Tuesday morning, pre-market, it actually touched this anchor. So it doesn't count, I guess, but it was there and it was actually trading there. And I was saying, listen, be careful. It's just run from 150 to 172. It's just run, 10+%. Where has it come from? Where does it have the potential to go? Is that anchor as well as the anchor off of the high. So the high actually occurred here, but I want to put my anchor at the beginning of that day because I want the psychology and the average price of everyone from that day. So I was looking, and I'm still looking at this as, here's a potential supply zone. If we see future rallies, let's say Monday it starts doing this, if it rallies up into this zone, I look at that as a level of interest to say, okay, let's say I bought it here and I'm looking at this. Now it comes into this zone. I'm going to treat that as, now I'm going to use my 2-minute exit. If it, undercuts the 2-minute bar low, I'm going to sell some. And I'm going to get aggressive. I'm not going to keep a stop way down here or even here. Maybe I'm going to look at it and say, I'll sell half of the position. And then if it builds a higher low, then I'll raise my stop up under here. So that's the way I want to look at. The blue one, by the way, is the month to date, which I always leave on there. And that was just Friday's action. This was the week to date from last week. So what I also have here to look at is the anchor off of the low. So from the lowest it's traded post that first 10-minute bar, that the anchor is right in here. So it's telling me that, the sellers are pretty much in control from the IPO and from the highest point. Now we're trying to find buyers in this zone where it kind of opened. breaking below here, if it did something like this, they add it to the NASDAQ and it does this, then you're probably going to see it quickly drop to 135 or whatever. But, that's just the way I'm looking at the probabilities of it. I'll let market action dictate. So anyways, it made its higher high above the flat to rising 5-day moving average right here and rallied right to where it was supposed to, meaning the anchor from the IPO in the pre-market.
Perfect. And do you handle IPOs any differently than a more mature company, or is it's all based, it's all the kind of same thing for you?
I pretty much the same. I'll look at them. When I look at IPOs, we had a couple this week. Lime was one of them. This one actually is a little bit under what my typical, it's the scooters. Everybody knows who it is. So I decided to watch this one. But there were two others. I generally look at it and say, who's the investment bank? And is the market cap at least not the market cap, but the valuation of the company at least $200 million. If it's less than $200 million, I'm just not interested in the name. So that's kind of my cutoff point. And there were two of that. BSG, I think, was one of them or something like that this week. No, BG.
Yeah, I don't know.
Yeah. It doesn't matter.
Yeah, cool. And is there like a liquidity, I know you've kind of answered this in the past, but an average volume that you need to kind of get involved or to be more interested in a name?
Well, for my general trade, not IPOs not included because they can't qualify yet. But my rule is at least 500,000 shares over the last 20 days. A lot of places use 50-day moving average, but a lot of times what I've noticed with that is a stock will break out. It might trade 400,000 shares a day, and it breaks out on 10 million shares, and then it does 8 million shares, and 6 million, 5 million. And now the 20-day moving average of volume is going to be 1.2 million, whereas the 50-day moving average might only be 480,000 shares because it's still got that longer tail of data to whip. We've still got an extra 30 days of lower volume. So to me, the 20-day is what I'm looking for. It keeps you in some of the more active, powerful, fresh breakouts.
Mm-hmm. Perfect. And I think you wanted to touch on a little bit about the personality character of stocks too, and how you look at that. I think ADR or HDR is one way that you look at that, but I think there's a really important concept because it's a nuance of technical analysis. Like we talked about with Beam, it's got its character. You kind of have to learn that and know how to deal with the names you're trading.
Sure, and the easiest way to look at that is the ADR is the average daily range, and that's measured based on points. Right. The ATR is, the average daily range is high to low. The average true range is
gaps
from the prior day's close, so it includes the gaps, like you just said. So if a $200 stock has an ATR of 5 versus a $25 stock having an ATR of 2, how do you normalize those? So the percent is how you normalize those. So a stock like some boring industrial stock. I just had one on my list. What was it? Oh, well, like UPS. I don't know what but I was just looking at UPS because that has a decent chart. But its ATR is 2.5%. So it's a slow, boring stock. It tells you, listen, don't expect to have a move like you're going to see in Micron. Okay, so this is where beginner traders should start with these types of stocks. Or you can also use it as position sizing. So there's different ways of saying it is, I don't want my portfolio to, and this goes too much into too much theory of what your ATR for your portfolio is and how it'll adjust that. But just based on individual stock, I look at the ski ratings and, trail ratings. And, if you've got a friend you want to introduce to skiing, you're not going to go take them on the expert run. They have these for a reason. That person's going to go get injured over there. They're going to hate the sport. They're going to think you're an asshole for bringing them there and, swearing the whole way down. So you bring them over the bunny slope and say, practice here, get your skill set. As you become more comfortable there, you either raise your share size at that point and stick to those stocks because that's your personality. It matches well with that. Or you move up to the intermediate. Now you start looking at more difficult. You start throwing some moguls in there and doing some things like that. Now you're hucking down cliffs and steep gullies in the 10% ATRs. And I see newer traders attracted to these names. And it's very similar to the analogy of, a baby has to, crawl. That's 2% ATR. They walk 4%. They jog. They run, and then they're sprinting in 10% ATR. So that's just a general snapshot of anything more than 10% ATR. The way I say it to Alpha Trend subscribers is, if you have to ask my opinion about a stock that's trading more than 10% ATR, you're not qualified to trade it. If you can't know what to do in that stock yourself, then you shouldn't be trading because things move so quickly. And with a 10% ATR, I'm not going to swing trade that the same. I'm going to be much more aggressive about taking, like in Beam, I'm going to take some of those profits on those rallies because I know that they're going to fail until they don't, which is why I want to have options to say, okay, I'm going to hold that piece. I'm going to trade this stock like an idiot because it's an idiotic stock and that's the personality. That's how I have to match myself to the personality of the stock if I want to trade this stock. Or I have to just look at it and say, okay, this is a volatile stock. Instead of putting $100,000 in this stock, I'm going to put $20,000 into it and just leave it alone. But that doesn't suit my personality. Matching your personality with the personality of the stock and the difficulty level and the liquidity, these are some of the things that people often overlook.
Do you also look at ATR as like an indicator at all to help you find like where the tighter entries would be? So like a moving average of ATR, trading it when it gets tight, compressed, and then throughout a range things will get wider and looser towards the end of a trend. Just want to hear your thoughts on that if you look at that at all.
Yeah, let me go back and share the screen because I don't talk about this much because I haven't really formulated what the value is yet. But if you take a look at a stock like Micron, and you can see here I've got the average true range points, and then the 14-day percent. So let's just compress the volume. And so here we can see, very clearly the points is rapidly rising, but that's because the price of the stock is rising.
Yeah.
So that's not as valuable as the percent ATR. I said this the other day and people said, how can you quote that horrible man? George Soros says, volatility peaks at turning points and diminishes with the trend. Now, it doesn't mean that this is a peak, but this is the highest volatility we've seen in this stock pretty much, you go back, ever. So I have to look at that and say, is this a turning point, or is this maybe just we're due, maybe not for a deeper price correction, although I'd love to see it pull back down to the anchor from the year-to-date low, down near 800. It wouldn't go there quickly. It would, because of the high volatility, it'd probably do something like this. But I look at that and say, okay, this volatility likely needs to cool off a little bit before it sets up in a lower risk way. So I'll look at these and say, is it coming out of a lower volatility, even though it was in an uptrend? So I want to match that ideally with some pullback or some contraction in range, not just, absolutes.
Cool. And could you bring up Beam actually again and go back to a weekly? I actually had a question. I forgot about this.
Yep.
Beam, yeah. So one question a lot of people might have looking at this chart is it's very far off all-time highs. They view a lot of supply, but that's kind of what you're using the anchor view at from the highs to judge, right? So yeah, kind of talk me through how you interpret that, whether there's supply that could impede a trend or something like that, and how you use that anchor view up to kind of diagnose that.
Sure, you could look at it again with these anchors. We'll just put those in there and say, well, that's the average price that it's traded at, adjusted for volume since it came public. So that's where the greatest price memory is. And then I'll just look at basic horizontal support and resistance, right? And you look at it from that standpoint, and then I might look at it and say, okay, where's the next level of interest? A place that has been, prior, we saw resistance over here, become support, and then resistance. So that's a natural level that, we saw in here. There was 6 months worth of trading that by now I would hope that most of those people are out, that they've done something else. But it's not necessarily that there's people at 43, 42, 43 looking to break even. But everyone sees the same thing on the chart. And they say, and the phrase is, support broken tends to act as resistance. So everyone looks at it and says, wow, it looks like it's got a clear shot, maybe up towards that 42 level. And I'll look at that and say, that's just the basis of my risk reward to say, if it can push it through here, I want to hold up into at least this zone, hopefully. Not a price target, but that's a level of interest where it seems likely some supply would be released, either because these people are looking to break even or because everyone's looking at the chart saying, oh, it's coming into resistance. We only know it's resistance if it does this, of course. It might continue to move right up through it, and that would be great. That's why our job is to manage risk and say, as long as it makes these higher lows, I'm going to set my stop under these higher lows and then get stopped out over here. So to me, it's just, you could use, the tool's not as good on here, but you could use volume by price. TradingView's got a great way of doing that. I think your software does as well. So those are some of the things that you could look at and say, where's the the most prior trading and therefore price memory.
Perfect. And obviously you've mentored and educated many traders over the years on technical analysis. What are some I don't want to say chart crimes but like technical analysis mistakes that you see kind of maybe newer traders make that are worth pointing out to be aware of, and how people can prevent doing those?
Well, it's, I pointed this out to subscribers this week. We were involved in Cognex, CGNX, and this is another one that I could have pointed to as a loser. But Cognex, it's created this little head and shoulders up here. It's supposed to be a reversal pattern, but can sometimes be a continuation. But it was breaking, so we got involved right in here, sold a quarter up at this point. And then I saw someone mention, hey, Cognex is breaking out. And they were all excited and buying the stock right up here. We owned it at, and it's not necessarily that, we did it better, but it's just more about, again, where has it come from? So we owned it at 69.50, 69.50 on this day, and sold a quarter point as it broke out. We used the 2-minute exit because it had just run actually from 63 to 73. So it just ran 13% in the matter of a week. So I said, it's prudent to sell some to the breakout chasers. So people who chase breakouts without asking, how did it get here? So in just, 6-7 days, it ran from 63 to 73. Buying that breakout doesn't make sense. People always complain, well, breakouts don't work. Well, not if you're buying the breakout up here. What we're buying is the higher high above the flat to rising 5-day moving average with a stop underneath the most recent relevant higher low here. So our initial risk was this much. We sold a quarter off up there. And then the balance, I think we sold still at a profit somewhere in here maybe. We had raised the stop. But it was a small profit overall, but it's better than still holding it and being down $1.30.
Right. Perfect.
So again, where has it come from? Where does it have the potential to go? That's one of the biggest chart crimes I see, is people just chasing momentum without saying, and you can buy momentum. You can buy the 5th day the stock is up in a row, but you better be doing it on a 1-minute time frame and managing your stop off that chase the gap VWAP morning low. Because if it pulls back a stock that's up 15% in 5 days, it's totally normal for it to pull back 4 or 5%. And you're the guy who's going to feel not your profits deteriorating, but you're feeling actual losses from that chase.
Perfect. And actually, do you have an example of the chase the gap by the VWAP that comes to mind that's recently happened?
Okay, so going back to OKTA, again, this was a stock I was already involved in. But on this day, you can see it gapped up. This is the opening bar on July 1st, and it gapped up. It gapped up, and then it pulled back, initial profit taking. And as a long holder, I was thinking, okay, no problem. My stop's under here. It's got some room. This is fine. So the people who chase that gap, it doesn't look like much, right? What's the big deal if I bought it at 138.20? Well, within 10 minutes, you're down $2 per share. Within 5 minutes, you lose $2 per share. You're not thinking you're the smartest participant in the market, I hope. And maybe you're thinking, well, that's part of the process. My stop is down here. I don't care. I want to be precise from the, I would rather not buy the pullback and think, okay, maybe I'm going to get lucky here. I want to buy that strength right here. And then for an additional, for an add-on or new position, your stop can go right there, that close. And then as it runs up that day, this might have been daily R2, let's say. Take a quarter of it off. Raise your stop up to under here. Now you have a riskless transaction overnight, theoretically, unless it gaps below that low. But the markets do it on a consistent basis.
Gap
Chase the
downs
gap.
too. Yeah.
And gaps down too. Chase the gap or wait for VWAP right here. Gaps down, hits the prior day's VWAP or the week to date VWAP, and then buy right there with a stop under here. It is, to me, the best entry technique there is. Some people might say wait for the opening range. And I would say opening range or red to green. So red to green has you buy up here. Opening range has you buy up here. Chase, buy above VWAP has you buy right here. Would you rather own it 730, 43.70 or 70, 45, 20, $1.50 higher, or even up to the red to green here, $3 higher. So to me, that's the best entry technique on shorter term time frames.
And looking at that gap down, that spot where it reclaims a view up, it's basically like the sentiment shift of the day, because anybody who's bought that day, at that point, they're starting to get green. So there's that's where kind of the momentum really starts getting going to the upside, is as we reclaim that VWAP after the gap down.
Yeah, and it works great in an uptrend. So the bottom line was we were above a rising 5-day moving average, and we came down right to the week to date anchored volume weighted average price as well. So that told us, hey, we're in an uptrend. We're down to the week to date anchor. Let's take a look at this on the shorter term time frame. I want to be long the SPY either for a day trade, or maybe you want to buy it for a longer term position, and maybe you got stopped out under here. But for me, it would have been a day trade. I didn't day trade it that day. I was involved in other stuff, but that's an example there.
Perfect. Well, Brian, this has been great. I think we've actually covered a ton of different useful concepts. So hopefully everybody watching has at least one great takeaway. Any kind of last message or overarching, thing that you want, if somebody watching this has one thing that they take away today, what do you think the most important message you can share is?
Understand the trend and trade with it. Don't get hung up on stories. The stories of the day, like we spoke about the uranium stocks. Yes, these data centers are going to require a ton of energy, but that doesn't mean you can just buy nuclear stocks in a downtrend and make money. If you are going to buy them, you're going to likely experience a lot of unnecessary pain waiting for the buyers to regain control, which might be in 6 months, and you might even pay a higher price, but you're going to have the wind at your back, and you don't have to, look at your stock for 6 months thinking, why am I holding this loser? It's down 10%, 15%, 20%. Oh, shit, I was wrong. Sell it at the exact worst time when some bad news comes out, and that ends up being the bottom.
Perfect. Well, Brian, thanks again. As always, always enjoy talking with you and always learn something new. So thank you so much. To everybody watching, I hope you guys enjoyed. Leave a like down below if you did. Subscribe if you're new to the channel, and we'll be right back. Take care.
Thanks, everybody.
All right, welcome back, everybody. It's my pleasure to introduce the next panel of the TraderLion conference. We have Matt Caruso and Jason Shapiro. We have both fantastic traders with very different styles, and today we're going to be comparing and contrasting and distilling the common principles between them. To introduce them a little bit, Matt Caruso is a top performer in the U.S. Investing Championship, where he returned over 300% in 1 year using a growth swing/position trading approach. And in the other corner, we've got Jason Shapiro, hedge fund manager, market wizard with over 3 decades of experience in the markets. And Jason is a contrarian who uses COT data to trade positioning of the crowds. Jason, Matt, first and foremost, thanks so much for being here. This will be a lot of fun, I think. So welcome. Thanks for your time.
Yeah, thanks so much, Richard.
Of
Good to
course.
be here, Rich.
Awesome. So to start with, I'd love for you guys to, from maybe a high level perspective, share your overall approach and goals in the market, because both of you, like I said, very different styles. But yeah, well, let's start with that to add a little bit of context. So Matt, maybe we'll start with you. Could you share kind of your general approach and what your objectives are in the market?
Sure. So I kind of really fall in the shoes, I guess, of William O'Neill and Can Slim type of investing. But my background is just a little bit different. I was a market maker, so I kind of took what William O'Neill did as the basis of things, and I've kind of adjusted over the years and way suits me with different types of entries I use as a market maker and different kind of ways to kind of figure out market direction. So nowadays I pretty much just trade long only equity, and my aim is to really kind of avoid the big drops and then participate in the best leaders for the uptrends, and just do that with as much focus as possible.
Perfect. And Jason, over to you.
Yeah, I'm a futures trader. I manage a CTA. I have some institutional clients who allocate money to me, mostly because I think my return streams end up being very non-correlated to just about everything else that they run it against, which obviously adds value. If I can be zero correlation with positive returns, then I'm going to increase their risk-adjusted returns. The way I approach it is I take a very sort of, I guess they call it contrarian point of view, but it's more contrarian of positioning. So I'm looking at where people are massively long or where people are massively short, and then I'm looking to go the other way, which is why I end up with zero to negative correlation to everybody, because I'm essentially doing the opposite of what everybody's doing when they are all doing it, or when I can measure that they are all doing it. And then I wait, once my measurements tell me that, I don't just get in, because I don't want to get run over. I wait until the market confirms what I'm saying. So I always like to say I have 3 pillars of what I do. Positioning needs to be one-sided, sentiment needs to be one-sided, and then market action needs to confirm what I'm saying. So, okay, it's going down, everyone's getting short, everyone's getting bearish. I'm not just going to buy, the falling knife. I'm going to buy it when the market then gives me confirmation that, hey, now it's not going down anymore.
Yeah, I think from our previous talks, people know you for the news failure concepts, which I think I definitely want to touch on. But perfect. That's a good kind of starting point so people can hear both sides. Let's dive a little bit deeper. Obviously, by the way, you guys do a fantastic podcast, The Market's Unscripted, where you guys both give your perspective each week about what's going on, which is awesome. We'll link that in the chat. But Matt, maybe starting with you again. Obviously, you guys have different edges. What would you say are your biggest edges as a trader, and how do you apply those in your process?
Yeah, so it's funny. First of all, when we were doing the podcast, we just thought it would be just, we were just kind of talking at an event last year, and we were just saying, the perfect trader would be basically being able to play that uptrend to the maximum capacity and be really focused on the key leaders. But then at the extremes, because the trend followers are always going to be late. Then at the extremes, be able to fade that. I'm like, Jason and I together, it'd be like a superstar team. We thought that would be like a great basis of, the podcast. And what kind of some elements that I thought were great. I always figured, in the directional trend, like that'd be more my wheelhouse. But what I found was amazing is that, just when both of us are in sync at the same time, that really kind of actually pointed to the strongest part of the rally, which we had the past couple of months, because we were both seeing similar types of things. And so, but I think, kind of what makes my side stand out a little bit more is, as being more to equity focused and really like zeroed in on it. My true mission is to find the absolute like equity leaders of the rally. And I think that is one of the keys, because, a lot of people can play the long side of the market, and it doesn't take wizardry to kind of figure out if we're going to start going in an uptrend or not. But tying that in with really find a leadership with the market. Like to me, a leading stock is one that does two things. It goes up more than the market on upswings and it'll decline less than the market on downswings on a relative basis. And so in that, in reality, that's alpha. That's what everyone is seeking, or else you can just buy a levered QQQ ETF. So really, one, being able to bring the universe of thousands of stocks down to a few is like a critical component, because you're going to be wrong anyways. But when you're right, you really want to be right. And then after is what most people won't talk about, but getting that right with the right positioning is the next key, because anyone can point to, I got these 5 great stocks, but if it's a 1% of the portfolio and doesn't really do anything either. So I think that's kind of really that zeroing in within stocks. Even when we chat on the podcast, that's something I always like to kind of bring up and share as a standout feature, I guess.
Yeah, perfect. Yeah, anybody can identify the leaders, but actually getting meaningful size, that's the whole name of the game.
And also identifying them before they become crowded, like Jason was talking about. It's not, after the fact doesn't do you as much good. It's got to be when things are kind of not feeling so comfortable when you're buying them initially.
Yeah, it just wins you Twitter points, which don't count for anything. So there you go. So Jason, perfect. Let's dive a little bit deeper into your method. How would you describe your edge? I know we've talked about this a little bit before, and but yeah, to explain it again, how would you define your edge in the markets?
So it's funny. I think that answer's changed over the years. When I used to go out and try to raise money, the people would ask me, "What's your edge?" And I would usually say something like, well, the data that I use is not data that a lot of people use, that I'm taking this contrarian approach. Means, and while I believe that maybe gives me some edge, as I've started, I started this crowded market report a few years ago, and I've had so many people join, and I've been able to watch other people going through, and I talk to them, and it's really sort of changed my view on this whole thing. I think it's actually a lot simpler. I think that what my edge is, I'm very disciplined and I'm very patient, right? And really what that means is I have a lot of experience. That's all it is, right? I've come to the conclusion that, do I believe that what I do over time works? Yes. I better believe that, otherwise what am I doing? Two, the numbers have proven that. But I've come to the conclusion, like I always say now, I don't care what makes you want to buy or sell something. I really don't, but you have to be disciplined about it. You have to be patient about it, right? You're not going to buy something here. My macro view is this, so I'm going to buy this. Well, that might be your macro view, but don't buy that thing until the market is agreeing with you. Like, don't fight the tape, right? And it's the same thing that I do. Okay, I'm going to buy this thing because I think everybody is short. Okay, but I'm not going to do it until the market agrees with me. So I think it's those things that give me an edge, my ability to do that. And like Matt was saying, it's one thing to have a plan. We all know ride winners, cut losers. We all know this crap, risk management, but do you actually have the patience to do that? Do you actually have the discipline to do that? And I think as I go through it, and like I say, when I compare myself to a lot of the people that are on my thing and the way they do all their different things, I think that's really where my edge is. People say to me all the time, like, hey man, you just went 7 weeks without making a single trade. How do you possibly do that? I'm like, well, because I'm not here to make trades. I'm here to make money, and if that's what I have to do, then that's what I have to do. And that's what process is so good. And again, everyone knows, you have to develop a process and it has to have okay, but if you're not going to follow it, then what's the point, right? So again, how am I able to do that? Well, because I developed the process, because without a process, I went through a long time where I did what everybody does, make a bunch of money, lose a bunch of money, and get nowhere. So I developed the process. And then once I had a process and it was working, I still screwed it up by breaking the process, doing all these non-disciplined things. And then I learned that doesn't help me. That only hurts me over time, right? So I got rid of that, so I think that's what the edge is at this point.
I would just follow up on that though, because same with me with Caruso Insights. When I started that, it was interesting. We started off, but like just learning to deal with people every day. And I think, I think Jason would say something similar, whereas when you trade for a living, like I've done, for many years now, and Jason, you start to kind of get insulated with other people who have like similar levels of experience. Not that everyone does things right, but, you almost start to forget, some of the strengths. Like Jason says, I thought my edge was something else, but it changed over time. You start to kind of like overlook the strengths that you built up over time. And we could see it like in March, it's like, it's panic, right? Then after everyone, I'm in full cash is a position. And sometimes that's the place to be. But if then after you just wait until it's comfortable to kind of buy stocks, well, then you're late. And so like if the market just will almost naturally train you to do the wrong thing. During an uptrend, when you're scared to buy, all the dips work, but the first ones feel scary. Then at the end, you say like, wow, this discipline has been hurting me. Like, why use stops? And that's when the trend ends, and then you kind of give everything back and more. So just that discipline is just so incredible. And I think Jason's right. Time in the seat is something that you can't kind of just learn in a book, but sticking to one process is key. I also jumped so many systems over time when I started off, and it's like every system has its nuances. Like Jason does. Looks at news failure. Well, there's a nuance to that. Like, I mean, I try and learn from Jason every week when we chat, but I'm trying to get my eyes to be trained that way. And same with holding positions. When are you stepping on the accelerator? When are you taking your foot off? Like, what are the key levels? When is it now time to just scale out completely? Like, those on paper, it seems simple, but everyone analyzes a chart typically one at a time, and then working it all together as a system is like, then suddenly you're in real time, you're hit with this whole other barrage of problems you're totally unprepared for. So I think finding what works with you psychologically and with your personality, and then I'm sorry to say, but give it a few years, and then after see how you do over time.
Yep. And I was going to add to what Jason said about patience. I think that fully applies to our style more met too, because there's those 2 to 3 times a year where we want to be active, right? After a correction,
Right.
after kind of a reset. And like you said, those are when the breakouts work. Those are when the gap ups work and follow through. Nobody trusts it. Everybody, is, in this recent year, everybody was chopped to shreds for the last 4 months. And then that's when it works. So that patience element applies to both styles, I think, really well. And I think that's a key pillar. Anything to add on how you incorporate patience into your process, or stay in tune with when to be aggressive and when to be patient?
Yeah, early on, I tried to always kind of systemize things the best I could, but but the problem with that is the market always does shift a bit. But I've really gotten to the point where if we're at the start of a new trend, near follow through day or whatever tool you want to use, breakouts will work. Then after a month or two, again, what's the exact definition? Again, every cycle is different, but after a month or two, breakouts, again, then they look good, they all fail. And then pullbacks are where you want to kind of shift. So you want to have different tools. Even if you're a trend follower, you want different tools to time things. The trend's great, but like Jason always says, if these stocks move 30% in a week, you better have some kind of, you better understand the game you're playing with. So, timing is really critical when those are the kind of swings. So you have, and you'll still get it wrong, but at least keep working towards kind of optimizing the best you can. So just understand where you are in the cycle of things is just so critical.
Yep. Perfect.
And I just want to say to what you guys were just saying, right? When I talk about positioning, you're talking about okay, so it's a bull market and it dips and then it goes back up, and you should have bought it, but you didn't because you were scared. And you should have, because then it goes back up and then it dips, and you should have bought it and you didn't because you were scared. And then the market rips back up and it dips, and you should have bought it, but you didn't because you were scared, and it rips back up. Then it dips and you say, this time I'm going to buy, and that's the time it doesn't work. Well,
That's positioning in real time.
that's positioning. And the point is, it's not just you. Okay.
Yeah.
This is one thing I think people have to get over. I know you love yourself, and I know that, and you should. Okay. But we are people, and we all are human beings, and we all suffer from the same exact issues. Okay. We all fit under that normal distribution curve. So we all make those same mistakes, and we all do them at the same time. And so, where that shows up is positioning. Okay. Because on that first dip that you should have bought, the positioning will show that nobody's long, because you didn't get long that dip. I didn't get long. We didn't do it. So the market rips. Second dip, it'll show. People are probably selling the dip again, right? It rips. And then that one dip that they did buy, the positioning will show. Oh, everybody bought this dip. Okay, well, then this is the one I'm not going to buy, right? And this has actually been, as Matt knows, my thesis to answer what everybody wants to answer right now. When is this bubble going to end? And my thesis, which to this point has not been proven either right or wrong, so I don't know what it's going to be, but my thesis has been, I don't think that we're going to see massive longs on a rip higher, because people have been calling it a bubble every time, so they're not going to chase it. I think if we're going to see positions show people get super long, it's going to have to be on a dip. Just like we just said, that will be, they haven't bought any of these dips. It's never showed up on position. Then all of a sudden, somewhere in here, I think there will be a dip that they all buy, and then that will be the one that they shouldn't have bought. Is it this one? Is it the, I don't know. Does it end up being that way? I don't know. It would be much easier, trust me, for me, if they ended up chasing, at the top, because then I could get great sell signals all the way up there. That would be great. And I hope that's what happens. It just kind of feels to me like it's not going to happen, because
there's one, I don't want to
chase this thing. If they haven't chased it by now, in other words, like what's going to make you chase it now? Like if you've missed, what are you going to do? You're going to come in and say, oh, this AI thing actually is real. I mean, if you haven't come to that conclusion yet, then I don't know when you're coming to that conclusion, right? I've been saying, like with the show on that, I think that this last move up from early April, late March, early April, was the people who were doubting AI actually coming in and saying, something, this thing is real. And that's why you start hearing, oh, we're in the second or third inning. Now all of a sudden they're justifying the fact that they missed this entire 700% run on these stocks, that we're only in the second and third inning, so we can get at that. So is this going to be the dip they buy? Again, I don't know. I'm not here to forecast what's going to happen. That's why I have data. But my point being, that positioning data helps to determine exactly the things you're saying, right? And the second thing I would say is, with all that, and then I just came to my mind here as you guys were talking about this whole idea of when to add, when to reduce, when to do this, when to do that. The problem with that a lot of times is, you added this time, it worked. Does that mean it was the right thing to do? You know what I mean? And by the right thing to do, I mean over time. What was the thought process that made you do it? Because what happens then, you do the same thing next time for the same reason, it doesn't work, right? How do you determine what is the right decision-making process? And I don't know the answer, but I think that it's an important question, right? I think that it traps us a lot of times into believing that we are doing the right thing when maybe it was just luck. I always go back to the coin flip thing, If I say it's coming out heads and it comes out heads, does that mean that I got it right? Or does it just mean it was a 50-50 bet to begin with? And I would, of course, argue that it's a 50-50 bet to begin with. The other coin flip thing I like is, if you get, 1,000 people to flip a coin, you're going to have 500 to flip heads. They flip again. Now you got 250 that did it twice, 125 3 times, and so on down the line. And eventually you're going to have one guy that flipped heads 10 times in a row. Does that make him the greatest heads flipper that ever lived? And he can go write a book about how to flip heads every time. And he can start a Twitter feed about, follow me and I can teach you how to flip heads all the time, And he can be in coin flip market wizards because he flipped 10 heads in a row, which is theoretically impossible. No. It means somebody was going to do that, and he happened to be the lucky person to do that, right? So if you think about it in terms like that, I think the only answer is less is more. The less moving parts you have and the less stuff to fool your mind into thinking that what you are doing is the great thing, the better off you are, is my view on that.
There's just two things I want to touch on there. Jason, there's one of your quotes we had on the podcast a couple of months ago. I wrote it down. I don't want to throw too many accolades your way. No, I'm joking. But one of my favorite lines that Jason said that really kind of put it in my mind. Everyone says, price tops when fundamentals are fully discounted in price. And Jason says, no, it's when it's fully discounted in positioning. And I thought, like, wow, that was such a banger. That is so accurate. It's not like, because when is it that fundamentals are fully valued? Like, I'd argue a lot of people understand the AI trade. It's when the bulk is too crowded and it's represented in positioning that the problem shows up. So I thought that was really cool. And also to touch on, like, the other thing you're talking about, saying that you don't have the answers. I find trading's a really interesting business, because I find the more I go on and the more I trade, even if I'm doing well, the harder I realize the business is. When you're starting out, it's like they say, oh yeah, cut your losers, ride your winners, simple. Then after you're okay, well, how long do I ride my winners? And how many losses in a row is now a problem? And then, is it the first time well? Did I do it because I was right? And so even simple things over time, you realize, wow, that super simple thing I thought was just like an easy part of the process. You're going to hit an environment where it's totally going to work against you. So, and I think this is why most successful investors over time, their systems actually get simpler and simpler versus more and more complex, because you want less variables to be playing with every time you have to make a decision. If you have like when people start off, they'll go to a chat GPT or whatever systems test and have like 40 entry rules, and like, how much of that is curve fit? How much of is that rule in real time going to change? Did it break? And it's way too much. Like, you want to keep this as simple so you understand your tools and you understand when not to use your tool. And that only comes from having like a simpler strategy. But again, it's like Einstein says, you want everything to be as simple as possible and no simpler. And that takes some time to do. But I think that's the goal everyone usually ends up working towards.
Yeah, so they're people early on, they're trying to optimize. They're trying to find this
Yeah.
secret sauce when in reality it's keeping it as robust. The most robust system has the least, dials to turn and
Yeah.
all of that. Is that what you're talking about, Matt?
Absolutely. And also, you have to dial this. If you are going to optimize, I would say instead of optimizing the system, optimize like in terms of signals, optimize it for you. So many people try and learn a system and it's too risky, it's too volatile. They can't handle it. And so they're going to fail because they can't handle it. Other people, it doesn't give them the type of returns. They get fed up, they'll go somewhere else. So the parts you should be dialing in once the system is robust and you feel somewhat happy with it, instead of always trying to get like the perfect moving average or the perfect entry technique or what, make it the right size for you. So if you go through a really bad period, you say like, wow, that was way more than I could handle, that then you say, oh, I should dial back my risk. Or if there's an uptrend, you say like, oh, I made way less than I should have because I was scared to buy. Okay, next time force yourself to dial up your risk. I feel that you get more value dialing in your own personality versus always kind of tinkering more and more with more indicators and more tools.
Yeah, I was
some guy on
okay,
Twitter
Jason.
the other day. As I'm sure you guys know, I sometimes will put things on Twitter, and this is something that we talk about a lot on my Discord as well. But there's a certain person who's a CNBC personality who I think is one of the, if not the greatest fade there is, right? And so I will comment on when he's making different moves, and it's not a personal thing, right? I just think he exhibits the personality traits of somebody who is doing it wrong. And A, and B, it is proven. We have kept records of the trades that he makes for years, and he has been very, very bad. So I put something on Twitter the other day saying, oh, this guy did this, so, everybody should watch out for that. And some guy came back at me pretty hard saying, this is stupid. Like, I don't know why you put this on here. Like, I'm a hedge fund manager and it's not as simple as just going opposite people. The market is a lot more complicated than that. And I was like, yeah, making the easy money sucks. Let's make it complicated and make the hard money. Like, you know what I mean? Keep it simple. If I knew a guy that absolutely lost 100% of his trades, why would I need anything else ever? You know what I mean? To stroke my ego? Oh, to justify the fact that I spent, how much money going to an Ivy League college and an Ivy League MBA program, and all that knowledge and money was spent so that I could get this incredible knowledge of the difficulty of all that stuff. I guess if that's what you want to do, but do you want to make money or do you want to prove you're smart? If if there was something that told me, like I said, if there was one person who I knew 100% of the time got things wrong, and I could just take the opposite of that all day, every day, and make money all day, every day, why would I care about anything else? So, like we say,
That's like they say, the market will always give you what you want to get out of it. If you want to gamble, it'll be a casino. If you want to build a business,
right.
It could be a business. If you want excitement, it'll make it exciting. So you get out of it really what you want. So yeah,
That's right. And if I say that all the time too, like if what you want to get out of it is actually making money, and yeah, everybody says, well, what do I want to get? I want to make money. Yes, that's what you say. I get it, but you really have to, you really have to dig deep and be honest with yourself. What is it that you're doing, right? Because when we go to the casino, I think almost all of us know that we're walking away with less money than we walked in with. There's a chance that we don't, obviously, otherwise we would never go. But we know that mathematically, we lose money in the casino makes money. That's why they have big, beautiful hotels and all this stuff, right? And they can give away food and drinks and all that because they make a ton of money because the odds are in their favor. It's pretty simple, right? We're flipping a coin in there. They're getting paid 52. We're getting paid 48. Over time, we're going to lose. Yet we still go. Why? Because there's some excitement to it. There's some entertainment to it, and there's
Flashing
that
lights.
hope. Huh? Yeah,
Flashing
everything,
lights, yeah.
and it's exciting, you know what I mean? You're waiting for that card to flip, and you're waiting for those dice to roll, and you're with the people, and you're getting free drinks, and you're having fun, and it's fun entertainment. It can be fun. Um, So it's the same thing in the market. Is that what you're in the markets for? The markets are very exciting. They're open every day. They're up, they're down, they're bullish, they're bearish, the news, the tweets, the this, the that. It's very exciting, can be very exciting. And if that's what you're in it for, then just know that. And that's fine. I'm not judging, you know. This is my business, you know. I can't be in this for the excitement because it's not exciting for me to be broke. I've been there. There's nothing exciting about it. Okay. There's nothing exciting about me losing money for clients. All right. And them calling me up, telling me I trusted you and you suck and, you know, all that. And there's nothing exciting about that. Right. So these are the things that end up helping you develop the discipline. You really have to focus on what is it I'm trying to get here. Is it for fun to break up my boring life? Okay, fine. I do things. Look, you see my guitars hanging back there? I always say I play guitar to break up my boring life, to have a hobby, to do something that I think is fun and exciting. It costs me money. I had to pay for that guitar. I got to pay for my guitar teachers. You know what I mean? Like I ain't getting paid to do that. My hobbies cost me money. If it's a hobby, just realize that it's a hobby and that's fine. And set your expectations as such. If you are intent on actually having this something that is going to make you money, then you really got to develop these disciplines that we're talking about. Otherwise, it just ain't going to happen. The number of people that are successful doing this is in the low single digits. Get it, believe it, live that, understand that, because that's a fact. The low single digits is how many percentage of people are going to be successful doing this, right?
And I'd say guys who are successful.
Think about what that takes. You know,
and I'd say guys who are successful, like you and I, like, you know, we've shared battle stories. You know, it's like we've shaped our life around it. It wasn't a hobby, and even then, it's a very hard journey. It's not easy. Like beating the market is not an easy thing. So you better approach it with, I think, the respect it deserves.
No, and that's fine. You know what I mean? It can still be fun. It can still be exciting. It can still be a form of entertainment. You can still just like go to the casino. Hey, every once in a while, you know, hit that number and get that pay and, you know, go out that night and party and all that. It can still be all that if that's what you want it to be, but just realize that that's what it is for you, you know? And therefore, like I say, your expectations are set, but just understand what I think it means that 2 to 3% of people do this. You know, put most of your money into index funds at that point and take the 5% and have fun with it if that's what you want to do, right? That's great. But otherwise, you know, you got to know how difficult over time it is. And yes, people are making, like, look, from early April until, you know, recently in this market, shit, man, these things took off, right? You're a genius, you know? It's that saying, everyone's a genius in a bull market. Just realize that this is an over time thing. And just because I hit the blackjack table today, and I've walked out of the casino before with money from the blackjack table. I've walked out of the casino before with money from the craps table. We went on a heater and all that stuff, right? But do I think that over time I'm going to go to the casino every day and I'm going to walk out with more money than I walked in with? I know for a fact there's zero chance, despite the fact that there are times that I do. So you got to remember that. You're not a hero, okay? You have to stay humble more than anything else, right? And you're not going to make, this is another subject, but you are not going to make money in this game. I promise you. And you're not going to listen. I know no one's going to listen to me, and that's fine. I'm going to say it anyway. You are not going to make money in this game by being a better predictor of the future than everybody else. You're never going to do it, okay? You're going to do it through these other things, right? Like that people talk about, what we're talking about, patience, right? You can be better than everybody else at being patient. You can be better than everybody else at being disciplined. Okay, those are the things that are going to put you in that 2-3% of the winners. Not, I predict the future better than everybody else. It's not going to happen, man. Nobody does it. Okay, we all, like I said, we all predict the future once in a while and get it right. But did we get it right, or did we just make a guess that just actually happened to happen? You know, that's where I go back to that flipping the coin thing, right? Don't kid yourself, because that's what your mind will do. You will remember the times you got things right. You will forget the times that you got things wrong. And over time, the sin of it all is you will lose money. And that sucks. Okay, so I think those are the important things to think about.
And speaking of prediction, Matt, I think you wanted to talk a little bit about looking at a chart versus actually trading? Is that kind of what you're getting at about it's not really predicting, it's about, you know, you got to trade what you're given with. That's just a way to get an idea, and then it's about managing the idea properly.
Yeah, you know, I even though like I have my CMT and I'll talk technical analysis with people and stuff, you know, but like I see a lot of analysts from all disciplines, fundamentals or whatever it is, and like, oh, this is what I think is going on. Like trading through something, and you need those skills. Like you need to know, like, you know what COT data is. You need to know what volume is, how that works, patterns. You know, a lot of that, you know, really most of everything you're doing is to figure out, of the thousands of stocks that you have, how do I bring it down to like 15 or 20 that I actually want to trade? And then if I buy this asset or this stock, where do I know I'm wrong? You know, so part of it you can do with charts, you can do with fundamentals. But the problem is, you know, most people really like a confident answer. You know, like I was on Fox Business yesterday with, you know, and I have my views, but, you know, like most people want to see, like, you know, oh, Matt, you were wrong. Maybe I was wrong, maybe I was right. But if I'm wrong, I'm going to be selling early. But see, like the way most people, when they come to the market, is like they have a view, and then after they wait for the market just to prove that they're right. So like everything you're going to use, a chart, whatever data you're going to use, it's great. But the process of trading with that information is vastly different if you want to do it successfully, because you have to, it's that old saying, you know, you have to have very strong opinions weakly held. You know, it always comes down to that, you know? So, you know, so looking at the chart is just part of it. And understanding what that is like to live with and to trade through is then a whole other feature with it, which again takes experience. But knowing going into it that the chart has limited, I'd say, even if you call it zero predictive value, doesn't mean it has no value, because if you can figure out quickly where you're wrong, that's great. If I know if I'm buying above this price point, I have either a chance of a 20% rally or a 5% loss at 50-50. If that's still zero predictive value, but I'll make money over time. So, but just knowing what your process is and where you're wrong, I think is critical. And that's the difference between being like an analyst and being a trader. And if people trying to make money, you need to be like a trader.
You know, and I think there's a very important point there as well to people that are listening here. A very difficult point as human beings for us to get to, but one that I have noticed. People want to hear people come on TV, on Twitter, wherever it is, on YouTube, and tell them what's going to happen. That's who they listen to, right? And that's exactly the wrong thing to do.
Yeah.
Right? The people to listen to are the ones who say, I have no idea what's going to happen, because that's the only truth. Okay. The rest is all salesmanship, right?
It doesn't mean you don't know what you're doing, but the truth is you don't know exactly what's going to happen. It's being able to react to those things.
It actually does mean you know what you're doing, I think, right? if you can admit that. Those are the honest people. You know, we're all trying to figure out who's honest, who's a scammer. Okay. My first thing is people who come on there with these strong opinions, this is what's going to happen, automatically they're gone, in my view. You know, it's about risk, reward, and odds. Not about me or anybody knowing what's going to happen. And people that are, and again, I can get on there and make a YouTube video. I'm going to flip heads, and I flip heads. See, I told you I was going to flip heads. Did I do anything? You know what I mean? And it's the same thing. Look at it as the same thing. The market is going to go up this week, and then the market goes up this week. Oh, this guy's a guru. I'm going to listen to him all the time. Wrong. You know, wrong. Okay.
Well, you know, but like I would argue that a lot of people come to the market, and we're all trained in school growing up, right? And you know, you're rewarded in school to be right. That's the only thing. The test, if you got the answers right, that's all that matters. It doesn't mean it doesn't matter if you had a fallback plan or anything else that you get the answer right. So I think it's just, I've been doing this for so long, like since I was a teenager. So I reprogrammed my brain. But most people come to the market, one, they hate being wrong. And they actually just think that their job is to be right all the time. And I don't blame them. That's the natural human way. And it's how we're all trained for many years. You're 15 years, you go to school, and whatever, 15, 20 years. Every year is the same thing. Every class. Do you have the right answer? And the market, that doesn't matter. You could be wrong. You could be wrong 9 times in a row, be right once, but catch a sand disk at 40 and take it to 2,000, and you made a boatload of money. You know what I mean? But if I told you, you know, Rich, I have the best system ever, but you can be wrong 90% of the time, you say, wait, it's a horrible system, but not for the guy who bought SanDisk, and it went up, you know, 3,000%. So there's all these sound like small things, or they may even sound obvious when people hear them, but you'd be amazed at how many of these like subconscious issues you have, or I don't call it an issue that you have, but these biases, and that totally will undermine everything else you're trying to do and ruin your process without you even realizing that you're doing it.
And I think that gets right back into why such a small percentage of people are successful doing this. Because like Matt says, the things that we have been taught in life are the things that we're going to do. And those are the things that aren't going to work in the market. So therefore, it's only like this small percentage of people that can see that I have to do things differently in this game in order to be successful, not the things that got me A's in school, or not the things that got me successful in other ways, right? Those are the things we've been taught to do and taught to measure. With this, you're playing an unknown future, okay? So the thinking has to be different. It's about odds, not about facts. If I sit here and study my math and study it and study it and study it and get the math right, well, then when I go to the test, I will get an A on the test. That's not how this works, because math is known, all right? The future is unknown. So
And I would also say,
about it differently.
to be
And only
successful,
a small percentage of the people are willing to accept that you have to think about it differently, and are willing to take to task how to think about it differently. And that's why only a small percentage of the people succeed in this, quite frankly. Sorry, go ahead, Matt.
No, and I'd say, like, think about like the process you have to go through to be successful. It's like, one, you have to learn a system. You probably have to read about many systems to find the one that works for you. You have to work through it. You have to risk your money to see if you're wrong. And then you're absolutely going to have to learn all of your personal failures only through failing in the market, and then still have the perseverance to want to go back and fix yourself. And you have to do all of this while you're living your life. Like I always say, if people want to trade for a living, there's only two ways you can do it. One, be very young and ideally get someone to back you, or be retired and you're financially independent. If you're going to like quit your job at 40 while you have a wife and 3 kids and you're going to start this, I'd say almost 0% chance of succeeding, because the path is just way too difficult, because you have to do all those, you have to do all of these things to get it right and succeed over time. So if you're younger, you have the pathway and some backing and so hopefully some tutelage. If you're older, the money pressure at least is gone, so the life pressures are less. But that's why only, because apply that to any other, first of all, even if you look at entrepreneurship, what is it, 90+% of businesses fail, and that's just general businesses. I'd argue the market's harder. The upside's bigger, but the market's harder. So that's why people say, how long is it going to take? Well, how long is it going to take you to fail, figure out what you did wrong, and fix yourself so you don't do it again? That's your answer. For some people, they're stubborn. Some people, they're malleable, and some are more dedicated than others. But that's why most people will join at the end of a bull market, leave in the middle of a bear market, then miss the start of the new bull market, and the market just has you all trained, and it's all part of psychology. And these are all and this is why it's not because in the end it's some kind of black art and news failure is a concept that no one ever has spoken about before in history, but it's incorporating into a system that you understand, that's simple, and that works with your psychology, and you've trained yourself to kind of work with. And that to me is what really separates someone who's successful and the many who try and then don't.
It's a great line. The upside is bigger, but the business is harder.
Mm-hmm.
I don't think that the word "but" should be in there. The upside is bigger because the business is harder. Like this is what life is. We know that, right? Why do hedge fund managers make billions of dollars, right? Because one out of a very, very large number makes that money. And those are the ones we hear about. We don't hear about the other million who have failed, right? It's incredibly difficult to do it, right? Why does an NBA player make so much money? Because there's only a small amount of people that can be NBA players, right? Why does somebody who works, parking cars for a living does not make that much money? Well, because it doesn't take very much to become a car parker. All you need to do is get a driver's license, right? That's pretty obvious, simple economics, right? So think about that. The fact that these hedge fund managers make so much money proves what Matt is saying. It's because it's so difficult to do, right? Another more proof that how difficult it is to do this, Again, something to think about. The whole thing about the doing it for a living thing is also, I think, totally spot on.
See, this is why Jason and I, even though we have very different approaches, when we just started chatting, there's like a common understanding of the journey and the path that it doesn't matter the system. I just happen to like what I do and he likes that, but the common underpinnings. And if you're around enough professional traders who are successful, I don't know if I can point to a successful trader who was incredibly arrogant. I'm sure there's some walking around, but most really get humbled over time. And anyways, that's just the path.
Yeah, and I do want to get to how you guys differ in just a second, but
Sure.
because I think that's valuable too in and of itself. But first, to get a little bit more tactical, and this is right along the lines of what you guys were saying about this is a game, a discipline where we're trading an unknown future. How do you guys address that with regards to position sizing and risk management, and maybe just talking guidelines? Because obviously there's traders watching this of different styles. But Jason, to maybe start with you, how do you deal with that unknown future through proper position sizing and risk management?
It's all a function of my process and my system. It all works together. Why am I getting in tells me why am I getting stopped, right? Or why am I taking profit? They all answer the same question. And within that is, so therefore, how am I sizing the position, right? So I'm getting in. Why? Because the market, everybody's super short and the market is no longer going down on bad news, okay? Because here's my news failure day. That's why I'm getting in. Okay, well then where am I getting out? Well, if it takes out the low of that news failure day, then my news failure day did not work. Just like if I'm trading a head and shoulders and it goes back through, then the head and shoulders didn't work, right? Or if I'm trading a breakout of a moving average, if it goes back down below the moving average, then the moving average didn't work. Okay, so I know why I'm getting in, and therefore I know where I'm wrong based on and therefore that's how I size. I know how much I want to risk per trade. I know where I'm getting in. I know where I'm getting stopped. So I know how to size. That's it. I don't add. I don't reduce. I just put on my size, and then the trade either works, I get to my exit, I get out, or I get stopped, I get stopped. That's
Again,
it.
less dials you have to push once you're in the trade.
Less
Just keep it
dials.
simple.
I don't want to get into it. And people say it to me all the time. Why don't you add when it starts working? Why don't you? Less dials, man. You know what I mean? And you know, my real answer for all these questions that people ask is because what I have done has worked for me for 25 years. So why am I going to change it? I mean, you know, that's the real answer. Could it be better? Could I go and back test? And I have done that. And we have tested all these things, and they have shown that they don't help. So that's the second part of the answer of why I don't do that. But the real part of the answer is exactly what you said. Less dials. Keep it simple. You know, that's going to do nothing but mess with my head. So now I'm adding the risk. So now it goes a little bit against me and I get out, and then it goes back up and I get back in and chase it. And there, you know what I mean? Suddenly a winning trade becomes a losing trade, right? It's hard enough as it is just to get a winning trade. I don't want to mess it up by doing that. It's all about, this is why I got in. I'm putting the trade on. I'm putting it on. I'm sizing it so that I know what my loss is if I get it wrong, and I'm out. That's how I do it.
Yep, Matt.
Rich, can you just remind me of the question again?
Yeah. So, how you think about sizing and risk management, and obviously you guys have different styles. Yeah. So, kind of how you think about, you've got
Yeah.
a great setup. How do you think about how much you're going to allocate to that initial setup, and also how you manage your risk if it turns against you?
So similar to Jason, you know, I have just a different a process where my process is one, I want to follow the leader, find the leader of that cycle. Unlike Jason, I do like to build into it, because at the start of a new cycle, a lot of stocks will show relative strength. Some will be the key leaders. Some, maybe it's a little bit of like a leftover of a stock that was just getting some, you know, safety buying or whatnot. So I will, but you know, so everything I do though is trying to kind of, how do I filter down to that process? And I'll add into strength, but I want to make sure that if I'm starting early or if I'm in a very choppy period, I don't get cut to shreds. So my sizing is actually always consistent. I always have a similar size of my portfolio that I'll put in a stock. And, you know, the real key of what I do is there's two things you want to do. You want to figure out when you're in an uptrend, and you want to be in the leader. You know, but you know, stock market's uptrend maybe a third of the time. So 2/3 of the time is not a very good time to be probably running the system. So knowing when is a big part of that. And so, you know, the position sizing is important, but I have so many other things that I have to kind of dial in to figure out. Getting position sizing wrong is what will blow you out. You know, so if you're just too heavy and it goes, so like that is something I like. I want to defer away like a worst case scenario to something else. If the stock is working, I can add to it, I can build into it. But if I'm wrong and it's a really bad time, either I'm getting chopped up or the market just falls out from beneath me, I don't want to have excessive size. So people always ask me too, why don't you size it to the, to how big the risk is to the low of the bar? And the reason for that is, I was a market maker and I was trading all these gold stocks for years. And a lot of the stuff you use, this is again where you want to know your strategy, because a lot of these stocks, they'll have a very like a powerful day. And I remember early on, I'd be like, oh, wow, the stock's breaking out. So I'd buy a whole bunch, more than usual. And guess what? Financing after the close. Clearly the book runners like raised it up so they can offer it at the same price it was yesterday, but make it seem like a discount. But on that gap down, because you went really big, well, this 10% drop is like, oh, I had 40% of my account all at once and I'm down 10% on 40%. It's a big drag. So like that's happened enough times that like, there's also subtleties beneath the surface where the risk is fine. If I'm right that it's the leader, if I'm right it's the trend, the trends usually last 3 to 5 months. I'll get more than this one entry. And so I try and keep my sizing simple and just try and answer those other questions first.
And sizing affects your head too. I was talking with Jim Ropel about this, like to truly handle it with his rules, he can't be too oversized in it. He has to size at a level where it makes a difference if it works and moves the needle, but not too much that it can dramatically hurt him if it goes against him and pulls down.
The way I think about it, like I always tell people, you want to be on the knife's edge, where if you have any more, you can't sleep at night. That's too much after. And if you have any less, you're probably not going to be focused or you won't care as much. And that dial is different for everybody. What it is for me is different for somebody else. And also, like, you have to realize some people, it's more hurtful to take a loss. For some people, it's more hurtful to have, I had this great idea that turned into a big winner and I was undersized. So like, you always like, for me, I've always been someone where like, I always try and catch that leader with the right amount. If I have like a small position and it takes off, I'm kicking myself more than if I just have a bad opening one session. I'm okay. I'm a little numb to that. But getting the size right will totally affect your psychology. It goes back to what we said before. You'll do more good for yourself by getting the dials of you than trying to say, oh, should I use the 9 EMA or is it the 10? Or should I wait for a 14 RSI versus a 9? Like that's not going to make you successful over time, in my opinion.
Yeah. There is no, we were talking about this, I think the other day, there is no answer. There is no perfect system. There is no solving the market. Okay. It's you have to solve yourself, right? Yeah. That's really the game. And this whole sizing discussion points to that, right? You can get the market right, but the sizing wrong, and that screws you up. That's you, right? This whole thing of you have to have enough on, but not too much on. That's you. This whole greed thing, right? The reason you have too much on is because you're getting greedy on this trade. One trade should not make a difference. I know you want it to, but it shouldn't. This is an overtime thing. And the only way you're going to get to overtime is by not over leveraging. I am guilty of under leveraging personally. I will admit it. My clients tell me all the time, I'm too small. Well, I'm sorry. That's how I am. It's fortunate for them that I'm a futures trader. They only have to put up margins. So if they want to lever me up, they can lever me up. Okay. But this is how I do it just because that's how I am. I'm a futures trader that is risk averse. Okay. Other people, like Matt was saying, you have to dial that based on where you are, where your mind is, where you are in life, where you are financially, what your goal is with all this, is it for fun? Is it for this? Is it your lottery ticket? All that. But that's all these things that are in your head. This has nothing to do with, is it telling me that the market, is something telling me that the market's either going to go up or down? This is all the stuff that's in your head. Like,
and I would say another reason why it's so few people succeed is because no one wants to hear this. I'll bet you this is not going to be the blockbuster clip of your conference. Someone who says, I have the new system for trading the QQQ that's like super effective and avoids the drawdowns, but I get 5 times the upside. That'll be the most successful clip. Look at books. Every book is how to buy stocks. Like, what books do you know that discuss this? Because number one, there's no perfect answer for everyone, so it's difficult. So everyone just learns, like, how do I buy? How do I buy? Then when that doesn't work, okay, they try and figure out some books on when to sell. There's even fewer of those. And if you just go to portfolio management books, it's like boring, dry stuff that's more for institutional investors. That's like a PM, not really for what we do. So you could see it in the book market. Like the skills that people need aren't there, but they're not there, not because they don't want to teach people, but because the booksellers know that book won't sell because no one wants to learn that in the first place. It's not fun. So that's just the answer's right there.
And that's true about not just trading and trading books. It's true with everything. Nobody wants to hear the real answers. Everybody wants to hear the simple answers. Like you go through anything, exercise, right? Everybody wants. I want to lose weight. Well, everybody wants to just put a shot in like now, right? They don't want to hear, well, change the way you eat, change the way you exercise. That's boring. You know what I mean? I don't want to deal with that. I just want to get skinny. Okay. Give me a shot, for crying out loud. I'm telling you right now, I ain't no doctor. Okay. I'm no chemist. I'm telling you right now, in 20 years, these GLP shots, there's going to be side effects that nobody thought of. All right. That nobody came out with. I'm telling you right now, the shortcuts always have side effects. All right. And in our business, the side effects are losing money. All right. Do things the right way, man. This is a life thing. And
Jason, what's that quote you told me? You get rich by selling things people want that they don't need.
Somebody gave me that on one of the interviews I did. It was like, you get rich by telling lies to people who want to be lied to.
That's it.
Right.
Yeah.
It's much easier to sell a book, How I Made $1 Million, than it is on how to be disciplined so that over time you can make, like, I'm already falling asleep here.
How to lose small on
how to
trades
lose
that don't
small.
work.
And Eli Lilly is doing pretty well with their $1 trillion valuation, selling their injections, right? I mean, because
I'm a 24-year-old kid. The last thing I want to hear is this gray bearded dude telling me that, to build wealth slowly. I mean, who wants to hear that? But by the time you get to be a gray bearded dude, you look back and you say, damn, I should have listened to that guy, right? I know I do that. When I was 24 years old, I was swinging it around, driving my Porsche that 6 months later I had to sell. I went through it. I know it. I'm, like I say,
we all went through it, man.
No different than anybody else. We're all the same. So I get it. But I can only say what I've learned, and people can either take it or leave it,
All right, we've agreed too much. I think we got to disagree now. So, what's a topic or a concept that you guys have found in your podcast that you do have different views about, and maybe it's just different approaches about how you address it? But does something come to mind? And maybe Jason, we'll start with you. Is there something you kind of disagree with Matt on that comes to mind?
He's trying to break us up, Jason.
I don't know. I find a lot of disagreements from the big picture point of view, right?
Right.
We disagree because we trade differently,
Right.
right? So like we just talked about, his sizing, the way he sizes is different than the way I size. But that's because the way I size is a function A, of me, and B, my process, or I would say A, my process, which is then a function of me. Whereas the way he sizes is a function of his process, right? Like I was saying, one is the other. How I get out is based on what my process says on how I get in. How I size is based on that. And it's the same thing with his. So I agree in principle with how he's coming to that conclusion, but his conclusion is different than the conclusion I come to. Fair enough.
I think this uptrend is perfect as an example where we I don't want to say necessarily just disagree, but where we're at odds in certain cases. About a month, it was 3-4 weeks ago, it was after we were talking all this AI stuff. I just like, oh man, I'm way underexposed and like these things, I should have had more. And then like just a couple of days ago, I was talking to Jason. I was like, man, Jason, when you had that MU news failure you spoke about, like peak day, I should have cut back like a lot more. I had too much. And it's just, again, it just goes back to the system, right? We were saying that's when we first started talking, like a combination of these two ideas would be like an optimal way to trade everything. But again, we have our own process. It's hard. So it's not so much like, I think any two traders will agree that if you read the Market Wizards series, all the traders have the same core principles, all vastly different strategies. No one is saying like, keep averaging down until you finally get to the low. Like no one's taking that angle, right? Everyone's a risk management, cut your losses. Like that's the consistent type of stuff. Some will do it differently, but I think that's like a good example of how in real time, we could both make money over a couple of months, but like, oh man, like, Jason, like he said, I should have had more, and because I'm a little more aggressive. And then after on this past week, I'm saying, oh, why the hell? Like I backed off. Why didn't I back off? Like way more than I did when I saw like even subtle signs. I should have been more at it. And I think that's like a perfect example.
Yeah, perfect.
Yeah, so I don't think it's more about, it's not so much disagreement, it's just different methods. But that's what I kind of truthfully this has all been new to me. Okay. Since I became this like public figure on YouTube and all this stuff, I never really spoke with people about this stuff. I did my thing and I lived my life, but it's all been very new and very interesting to me. And it's kind of why I liked getting together with Matt, because it's very interesting to me, this whole thing of, hey, totally different ideas, totally different processes, but at the core of it, it's the same. And that's why I was saying before, it's not just trading, it's everything. There's no difference to success in trading and success in life. I was speaking to this doctor yesterday who was asking me about, what I'm doing about my health. And I went into this whole thing because just recently I changed the way I do everything, and I changed the way that I'm eating, and I've had to become ridiculous about it, right, in order to do it. And she's like, it's a little over the top. I was like, okay, but this is what I've learned. For me to be successful in something, I have to be extremely disciplined
Yeah.
to get there. All right. As a trader, that's what finally got me to a place where I was successful as a trader, was I had to become extremely disciplined to what I'm doing. So now I'm going from being a sugar addict, okay, a very unhealthy person, and I'm trying to become a healthy person. So therefore, I'm becoming extremely disciplined about doing that, because that's the only way I know how to do it. All right. That's what's worked. So like I say, it's the same thing for everything in life. How are you going to succeed in trading? How do you succeed in anything else? Find something that you have succeeded in life and see why that is. Have you succeeded in your marriage? Great. How? Wasn't because you were lucky. It was because you worked at it, man. You know what I mean? I've been married on the bad side and now on the good side. And yes, there has to be some compatibility there, just like you have to be compatible with your trading system. But within that, there's still going to be some volatility, and there's still going to be some bumps in the road, and you're going to have to get through those. Okay. And you're gonna
That's Jason at marriage counseling. There's been some volatility in our marriage.
Yeah, well, I'm just saying, like, you have to get through that, and you have to have a process for getting through that, and you have to be open, and you have to be honest. It's the same thing with trading. What else have you been successful in? I was successful as a baseball player. Okay, how?
Yeah.
Think about that. Those are the things that didn't get you. Weren't born a great baseball player. You might have been born a good athlete, but you still had to work on your baseball. It's the same exact thing. There's no difference. Find something that you've been successful in, or that somebody else has been successful in, and apply those same principles to approaching trading. You're not just going to walk into this and start swinging the bat and start hitting home runs. Okay, I promise you.
Well, it's a perfect. Pete Rose is one of the all-time. I think he's the all-time hit leader for the MLB.
Certainly
and
is.
he popularized the concept of going to look at the tapes and figure out exactly where the most likely place that the ball would come down, for the different batter, different pitchers. And that's how, he had to be obsessive about it. I was actually talking to my brother-in-law recently about, A-Rod with the Yankees, about how he was so obsessive. And it's like after every game, he'd go home and rewatch the game 2 times. Like, that's not a normal thing to do. But then I can't hit homers like A-Rod. At least I don't think I can. But it carries over through everything. I agree, Jason.
Yeah, it's all just because people get this thing like it's so accessible trading.
Yeah.
It's so easy to open an account. You can't just walk into a major league ballpark and see if you're going to be a home run hitter, right? But you can open up an account in 5 minutes, and I am a professional trader. You can do exactly what I'm doing within 5 minutes. Okay? So just because it's so easily accessible does not mean that it's easily mastered, all right? And I think people confuse those two things because it's so easy to get into the game that it can be easy to do. Well, no.
Excellent. And just because I can see people asking this question in their heads already, and just to clarify, we've mentioned news failures a few times so far. Jason, would you mind just giving a general definition of that, maybe some recent examples, like we talked about the MU earnings, and then Matt, I'd love to hear kind of how you've taken that concept a little bit, because it's not classic CanSim, right? But it's part of learning different styles. And I know throughout your career, you've learned how market makers act, and that translates to how you approach a stock going into a pivot. You might, you're recognizant, you're observant of that. So yeah, Jason, would you mind kind of explaining that concept for everybody?
So let's start it with this. Matt said earlier, You want to figure out when you're in an uptrend or a downtrend. All right. I like to look at it as, are you in a bull market or a bear market? And clearly you want to be long bull markets and short bear markets. Okay. Obvious. The way that I see it, what is a bull market? And it's not the way I see it. This was stated by people in the market wizards books. You hear it all the time. But what is a bull market? A bull market is one that goes up a lot on good news and does not go down very much on bad news, fights off bad news. That's a bull market. Okay. So I am trying to catch market turns. So it's going from a bear market to a bull market. So what am I looking for? I'm looking for a market that no longer goes down on bad news. If a bear market is going to go down a lot on bad news, all right, well, now bad news comes out, and not only doesn't it go down a lot, it goes up. Why does it go up? Didn't everybody see the news? Of course they saw the news. We got the whole world watching all these news things every day, right? It's because, in my view, everybody's already short. Okay, so it's a combination of those two things, right? So we're now switching from bear phase to bull phase. Not definitely, but we're getting a sign that the odds could be that we are now switching. Therefore, the risk reward of the trade changes, right? So what's an example? I think the best example that I can remember recently was the low of the 2022 bear market. You have to pay attention to what was the narrative? What was the narrative that was driving what the market was doing? 2022, the market started going down because the Fed was raising rates. The Fed was raising rates because inflation was going higher. That was the story. Every time an inflation number came out, the market would go down. Every time the Fed would raise rates, again, the market would go down. That was what was going on. You have to be able to figure that out, which is not very hard to figure out. If I could do it, you could do it, okay? But that's what was going on. So what happened? In October of 2022, we had a CPI number come out that was not only higher than what was expected, it was also the highest CPI number all the way up until that point. So if the narrative was higher inflation leading to higher rates, leading to lower stock market, then clearly a higher than expected number should have been very bearish for the stock market. And it was. The market opened down, it went down a lot. By the close of that day, the market closed up. This was the driving narrative of why the market was going down. It could no longer make the market go down anymore. That was the exact bottom day of the stock market. Okay, that is news failure. And people come to me all the time, is this news failure? Because this is a danger. Again, getting back to the psychology and the discipline. Now all of a sudden you're trying to force news failure. Is this news failure? Well, you could say this, this ISM number was kind of bullish and the market went down. Is that news failure? I always say, if you have to ask, then it's not. It should be obvious. We're talking about major, at least in my position, major market turns. They only happen once in a while, okay? A major market turn doesn't happen every day, all right? Lucky if it happens every 6 months to a year, right? So if you have to ask, then it probably isn't. It should be obvious. What was the driving narrative, okay? And was that just confirmed by the news? And therefore, how did the market react to it, right? Why was oil going up? Because of the war with Iran. Obvious, all right? If the war with Iran news gets worse and oil can no longer go up, there's your news failure. There was one on April 2nd with the stock market. Why was the stock market going down in March? Because the war with Iran was causing this oil issue. The oil issue was causing the potential for an inflation issue. The inflation issue was causing a potential for an interest rate issue, which then caused the potential for a stock market issue. Okay? And there it is. Pretty simple. Well, on April 2nd, oil was up over 10%. The stock market closed up that day. That was the bottom of that market. Now, does that mean that I knew that the market was going to go from April 2nd and do what it did over the course of April, May? No. Of course, I had no idea. If I did know that, then hey, we wouldn't even be sitting here because I'd be on my boat right now. You know what I mean? sitting in Monaco or going to the casinos, blowing a whole bunch of money, right? But my point being, it gave you the sign. That was the news failure, right? The market is no longer reacting to this horrible news in a bad way. So therefore, the odds have changed. Did it mean that that had to be the bottom? No, it didn't. But it means, again, it's a good risk reward bet that it was.
Excellent. And Matt, what are your observations about the news failure? Is it something you're incorporating a little bit more? Or how do you think about it? Yeah.
So I've been thinking about this a lot, actually, just this past week, where, because we talk a lot about relative strength, which again, I get the question. Relative strength is not the RSI indicator. Relative strength is comparative. So the stock is stronger than the index. It's not the momentum oscillator. It's always a common misconception. But I was just thinking, applied correctly, relative strength off of the bottom, which everyone's looking for these leaders, is the concept of news failure, but it's applied to price. So basically, you're looking for an index that is weak. For example, this past week, all the AI stocks got, now what day are we today here? Or July, I know it's going to be after, but it's July 8th. So the past week has been a massive sell-off here in all these AI names. And every day the markets opened up, they were already to the downside. Today was the first day where there's oil news. The S&P is underperforming the triple Qs. The triple Qs are doing a bit better, and almost all of my AI stocks are already positive. That was the same stuff we saw back in March. So it's not news failure, but it's I guess price failure sounds wrong, but it's index failure. So the indexes are weaker and these stocks are stronger. They're already positive. Usually that points to accumulation. It's not a buy by itself. It's something that I watch super close. But you've mentioned before, how does, as a market maker, influence your breakouts, or when you do what? Well, that's why at the beginning of a trend, breakouts work, because you have this coiling spring, right? The market's been weak. It's been weak. The stocks don't go down. They're not going down simply because someone's accumulating them, because they're all tied with this passive index investing. They've always been, but now even more so. So if they don't fall, it's because someone is purposely going in to buy when the market is weak. Who would do that unless they had a really strong view of this stock? And they're not going to be selling it in 2 days if that is the case. And so then after, when the market improves and everyone's worried, well, of course the breakouts work, because everyone who wanted to sell is already sold, and the guy who bought it all is not looking to go and sell it now because he had to buy it in the midst of all this uncertainty. So that's why the breakouts work early on. And relative strength is basically another form of news failure, which again doesn't guarantee, but you stack the odds. Like if there's positive relative strength over 1 week, 2 weeks, and then the financial crisis hits, well, the stocks are going to break down anyways, because that buyer will be overwhelmed and the future turned out differently. But you're stacking the deck. If the market does, hold itself in and find whatever reason to rally, well, if the stock didn't fall when the market fell 3%, if the market goes up 2 or 3%, I bet you it goes up a lot more than the market, because it's already been under accumulation, and everyone else is noticing that too. So everyone's kind of charging into the same names, the smarter investors, those who are apparent. So again, really similar, like applied differently, but like a underlying mechanism is right. There's a lot of similarities and overlap.
Perfect. And oh, by the way, and again, I don't conclude anything until the market closes. All right, intraday moves can fool us a lot about what we're saying. Mm-hmm. But to Matt's point, suddenly the Nasdaq's leading today, right? Well, we've been going through this big rotation where people are getting out theoretically of these stocks and getting into more Dow, Russell type of stuff. We have seen that, right? Guess what? The Dow is now the most crowded thing on COT there is, okay? But we are now seeing today the Nasdaq start to outperform. Oh, by the way, on a day when the Kospi was down over 5%. The Kospi being, as I've been saying, calling it the mothership of this AI trade, the thing to watch to give you a clue as to what's going on, right? So that in a way is, if we in fact close like this today, in a way, news failure. The Kospi was down again. The market is weak. The Nasdaq is the more volatile thing. It's what the narrative has been doing, right? This whole switch and out of those. Why isn't the Nasdaq the weakest thing today? Can you explain to me why? Is there some other reason? I don't think that there is. This may be, and again, there's never a guarantee, I'll say it every time, but this may be the sign that this rotation is now done and going back. The positioning is showing that's what it should be, all right? The Dow positioning is where, in the stock indices, by far where people are the longest now. The NASDAQ is where people are now the least long. All right. So the positioning contrarian trade is to start thinking NASDAQ rather than Dow, right? The narrative has gotten that way. We hear the narrative all the time. These stocks have gone too far, too fast. We don't, all of a sudden there's all this issues with over this, that, and the other thing with the chip stocks. And now we're getting a failure. The Kospi is down 5% again overnight. And now the NASDAQ is leading. There it is.
You know, I find every trader, as you go on, a lot of what we're always looking for is what doesn't make sense or what's abnormal. So everyone wants to predict, if it gets above here. Instead of predicting, again, like you would have to predict, you could trade 1 minute charts, 5 minute charts, dailies, weekly. There's an endless number of things you'd have to predict, which is impossible. But if you could notice, like we're saying, like, suddenly there's this shift. And like, okay, well, now I could zero in on this. I mean, most people will want to fade it the other way. They'll say, the Dow's down, the NASDAQ's not down yet. I got to sell the NASDAQ. It's going to catch up to the Dow. But the market is not the grocery store where like it's on sale this week, so it's a good deal. The price is happening because someone's anticipating something and it's reflecting that in demand and supply. So and that's another reason people kind of get tripped up. So you want to zero in on what's abnormal, and then have to try and back out what's causing it. Is there news? Is it because of positioning or whatnot? And then after, not always try and fade what's abnormal, try and understand it. And if it's happening when it's crowded, go with it. If it's, or fade it if it's a weak abnormality. And that's, I think, a good way, to look at things.
The least reasons that there are, the less reasons that there are for it to be happening, the more you want to believe it. That's what I think. Because the market is giving a message there, right?
If you go back to Livermore,
that is what reading the tape is. The tape is telling you, and I always say, like I say, no matter how you want to get long or why you want to get long or short something, I don't care. Let the tape agree with you first, because at the end of the day, that is the ultimate judge, right? Because that's where we're going to make our P&L, right? Mm-hmm. Be wrong, make money, like who cares as long as you make money? And the place you're going to make money, obviously, is the market. You're not going to make money by making a prediction. You're going to make money because the market's going to make you money. So it's telling you, go with what the market is telling you is the point. And one last thing about the news failure thing, and Matt is calling it now, the relative strength kind of thing. Well, there's another form of news failure. It doesn't necessarily have to be a news item. We call it correlation failure, right? Mm-hmm. So one thing is like, okay, I find that everybody is mega short the British pound here. I want to get long the British pound. How am I going to look for news failure? Well, one thing could be some really bearish news comes out in the UK about the British pound and it doesn't go down. Okay, that's sort of a classic news failure. But what about all the other currencies are down today, right? There was some bullish US dollar news. Every currency in the world went down, but the British pound didn't. So there wasn't necessarily news on British pound, but that's a correlation failure, which Matt is explaining as a relative strength message. Same thing.
And people will notice this. I remember when I started off trading, it was like what? I was trading the 2000s. I started trading pro in 08, but the market will fixate on the news. Like with Iran, it was about oil prices and oil going 100, 153. And if oil is up 3%, market's down. If oil falls 2%, market goes up. And then at a certain point, it won't matter anymore. And it'll be the same thing with a news topic. It'll be tariffs. Trump's going to do this and Trump's going to do that. And this is the response from Italy and this is the response from Canada. And at a certain point, these headlines are still, and no one's going to care anymore. And so when you're first starting off, you'll think that like, there's this strong core. If oil goes up, market goes down. For that moment in time, because everyone's fixated on it and the algos get fixated on it. And then just slowly, the uptrend will start. You'll see these correlation failures. By the time it's obvious, like when the tariff, like last year, 2025, when did tariff worries finally leave? Like, I don't know, it was from March, maybe September, October, people stopped talking about it. Like I know my local news had a thing at the top, Trump's tariffs for like a year after the bottom came in. They were still like always every time he said something. So, but like it stops being relevant way before it comes out of the news cycle. So the correlation failure is another thing that you have to kind of, whenever something's abnormal, what is the known thing? And then what's an abnormal reaction? It can happen on a shorter term time frame, like we're talking over this past week with the rotations. It can happen at major events, and sometimes the news, I remember in 08 at the bottom, it was like crazy. And things are always going to look awful at the bottom. Things are always going to look beautiful at the top. And it's just the industry is just built to kind of push stuff that way. Because when things are good, no one wants to hear a bad argument. And when things are bad, no one wants to hear a good argument. If you just sold all your stocks in panic, you don't want to hear something we're about to start a bull market. It's the last thing you want to hear, right? So again, you get rich selling lies that people want to be lied to. It's like, you'll see that everywhere in the market. It's astounding.
And again, and not to beat a dead horse or sort of stick, but I'm going to do it anyway. At some point, the market doesn't respond to that news thing anymore, the tariffs or whatever it is. Why is that? Because the market is a discounting mechanism, right? How does it discount it? Positioning. At some point, everybody has already positioned that the tariffs are bearish. So then, once they're already positioned for that, it stops reacting to bearish tariff news. And hell, if you look at the bottom day after the whole tariff thing, it was on a Monday, where over the weekend, there was more bearish tariff news. The market gapped down on Sunday night, and by the close of that Monday, the market closed up. Okay? And COT was showing that people were max short the stock market there. Okay? And then the market stopped going down, and 3 days later is when they came out with the news that the tariffs were not going to be so bad, and we went up and had like one of the biggest days in the stock market history. 3 days after the bottom on bad news. So just another example.
And I would say that's just a function of markets, like you said, because like, let's say a big bull market, like when Bitcoin in 2021 topped, like valuation never mattered. It never valued at any time in that uptrend. It wasn't driven by valuation. What killed Bitcoin is when buyers ran out of money, and why they ran out. The Fed started hiking rates, so they couldn't afford to keep pushing it higher. And that's a microcosm of everything. Same with the market, where it could be the AI trade. It's going to keep rolling on unless someone chokes out the money supply. And same thing on the way down. Why does a bottom happen? If everybody's sold who wants to sell, at that point, even if the news is still going to be bad for a while, there's only going to be buyers from here on, because everyone's sold in anticipation. So like the positioning is what takes the fundamentals and brings it into the reality of trading. That's like the mechanism. And the positioning is a function of money and institutions and all the rest. But that's why people say, the stock is not the company. Yeah, because everyone's trying to kind of position or bet or place a trade on what they think it will be. So what they're actually doing with their money is a major determinant of what the price of stock's going to do in the future. If everyone's already bought, well, the money's gone. There's no more buying. Even if the stock keeps killing it, there's no more money if the Fed's hiking rates. And that's why Apple came out with the iPhone in 2007. It still crashed in 2008 because the system crashed. The iPhone was still killer, still amazing, right? Still the iPhone. But for that period of time, the stock fell 50, 60% because the market broke. So there's all these different things you're trying to kind of manage in real time. But that's what these key points we're talking about. These are the principles that are what drives markets, whether it's futures, stocks, 5-minute chart, daily chart, pick your specialty, but that's what it is. And it comes through in the news field, it comes through in relative strength, it comes through in then price action to confirm. And that's why it's the underlying principle that kind of ties it all together.
Perfect. Jason, any last bits to add on there? Or I think that might be a good place to call it for today, unless you've got more to add.
I think I've made my point.
You don't want to beat the dead horse again?
Too many times already, but
Horse is dead, Jason. It's dead.
well, what can I tell you? I mean, it's just these things just show up again and again and again.
Yep.
And,
Yeah. Awesome. Well, I've really enjoyed this. I think this was fantastic, and to hear both your guys' perspectives. I tried to break you guys up. It didn't work. You guys instead just shared awesome lessons. And Matt, I'll push back that I don't think this will be a popular one. I think people who are watching this right now are loving it, because there's a lot of truths that as you're trying to figure out trading and build your system, whatever it is, you guys are speaking to a lot of things that everybody has to think about. So I think this is really great. I just want to close it out with maybe one more question each. General advice for traders watching this. If there's one thing that you think they should take away from what we've talked about today, what would it be? And anybody really want to start, or we can go with Matt to kick things off?
Yeah, sure. One thing I always tell people, and I did this years ago, is write out your process, build a manual, take some time. If you really want to be passionate about this, you have a bit of time to do this. Write your manual out, where if you had to go away to a desert island for 6 months, you couldn't look at the market, you had to hand off your nose to somebody else to trade your account for you the way you would. If you can't do that, there's probably some major holes in your process that you're unaware of. If you say, well, how much of the stock is this guy going to buy? And what if the market has a gap down event? Or what if, then see, you don't have that planned out. So take some time. Like I wrote one years ago, and I still go back and add to it after every cycle. Like, oh, this is something that I didn't realize. And so write it out, and you'd be amazing when you actually sit down and write stuff. Like Jason always says, he started Crowded Market Report to kind of was part of his tracking of his own ideas of what the market crowding was. You know, when you write it out, it forces your idea to paper, and it really forces you to be cohesive. And that's why with Caruso Insights, I mean, I first started doing it because, you know, people want to learn how, but I've gotten so much value out of like forcing myself to have to articulate it in like an intelligible and, you know, usable process that really kind of forces discipline and clear thoughts. So write out your process. If you can't explain something, the market will force you to explain it at some time. You're better off doing it before you're in a bad situation. So that's what I would recommend to people.
Excellent. Jason?
First of all, yes. You got to do what he's saying.
Yep.
Write stuff out. Keep a diary. I can't explain how much that's going to help. But in general, I think as you're approaching this market, as you're approaching how to make money out of the markets, be cynical, okay? This is not what we are told it is. The market is not what the press tells us it is, right? It's not about trying to figure out, is Micron going to beat earnings this quarter or not beat earnings this quarter, or blah, 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 blah. You're not going to be able to predict the future over time. That's not going to work. What this is about trying to find situations that offer asymmetric risk return, okay? If you're wrong, you're going to lose $1 and be fine with it. And if you're right, you're going to make $5. Lose $1, make 5. Lose $1, make 5. Lose $1, make 5. That's what this game is, right? It's not about trying to figure out, well, what the future is, and that's what all of the 99% of the press is built around, right? You turn on the TV, what are they doing? They bring on experts who are telling you, you know, the AI this, or, you know, this is what it's going to look like, and therefore this is it. It's not going to work, and this is why those experts underperform the market. You see it all the time. 90 whatever percent of these fund managers underperform the market, right? Because they're playing the wrong game. Believe it. The game is about finding asymmetric risk return. That's what you should focus on. Do I think I have a way of doing that? For me, yes. Okay. Is it the only way? No. Find your way of finding asymmetric risk return, and then be very disciplined about doing that. That's how you win this game, period.
Great. And by the way, your quote earlier, I think this should be a t-shirt that you should make it in, but be wrong, make money. Like you said, lose $1, make 5, you know, be wrong, and then just make money over time. Accept that you're going to be wrong, plan for it, deal with it, build a system around it. Perfect. Well, Matt, Jason, thank you guys so much for your time today. You guys made my job easy. I didn't have to jump in too much, so I really enjoyed this. I'll look back at this and take a bunch of notes. So thank you guys both sincerely for your time. I really appreciate it. To everybody watching, I hope you guys enjoyed as well. Leave a like down below for Matt and Jason. Subscribers new to the channel. Check them out as well, Caruso Insights and the Crowded Market Report. And we'll be right back. Cheers, everybody. All right, so that's it for day 2 of the 2026 TraderLion conference. Hopefully you guys dug that. Let me know in the chat right now, who was your favorite presenter? What was your favorite quote or takeaway? And also just a huge thank you to our speakers. We couldn't do this without you guys. You know, everybody shared so much knowledge, and I look forward to rewatching it myself and taking more additional notes. So again, let us know in the chat, what was your favorite quote or biggest takeaway from today? And who was your favorite presenter? We'd love to hear it. All right, so here's a quick reminder on how to get the most out of the experience. First and foremost, check that you're subscribed to the TraderLion channel. That will give you access to our podcast as well. Also, if you're looking for the slides, we're setting up the resource right now. So grab your VIP pass while you can. You can either scan this QR code or click the link that's down below in the description. It's also pinned in the chat, and you'll have complete access to the resource we're building with the slides, with additional notes, and the recordings as well for each of the presentations, all organized in one place for you. Also, it's all really great to engage in the chat with others during the conference. We saw a ton of that today, so great job. If you took notes today, feel free to share those notes on X, your key takeaways. We'd love to hear it. Tag me, tag TraderLion, and we'd be happy to retweet it as well. And then just a quick reminder, this is being recorded, so you can rewatch your favorite presentations right now, whether it's day 1 or day 2. Just scroll back on the URLs of the streams and you'll be able to, access all of those. And I'll be adding timestamps to easily, jump to key parts as well. So this is just a quick reminder on how to get the most out of the experience. Thank you again to our sponsors. Check out the sales in the description. The DeepView Summer Sale, fantastic deal on 1 year of DeepView. The TraderLion University Sale, 25% off any training masterclass. These are fantastic for helping you, reach that next level of performance and help you improve your trading system. And then last but not least, we've got the Trade Lab. Again, email me at richard@traderlion.com and just mention Trade Lab if you're interested in learning more about that deal. Also want to mention and highlight the TraderLion University free resources. It's completely free. All you have to do is scan the QR code and create an account, and you'll have access to model books, free resources, free courses. There's a lot here that can help you improve your trading as well. 100% free. Again, just scan the QR code right here. Last but not least, and certainly not least, help us pay it forward with a donation if you're able to Parkinson's research. Earlier this year, my grandmother passed away from complications of Parkinson's disease. It's a neurological disorder that impacts their quality of life, and doesn't just impact them, but also impacts their family members as well. So any donation makes a difference, and this foundation is extremely highly rated. Your dollars directly go to helping with develop treatments, help develop and improve quality of life, and could help out a lot of people in need. Over 1 million Americans suffer from complications of Parkinson's. So definitely go ahead and donate if you're able to. If you got one great golden nugget today from the conference or yesterday and you haven't yet donated, please go ahead and do so. And again, pay it forward with a donation to Parkinson's research. Thank you very much. All right. Another reminder to subscribe to the TraderLion channel if you haven't already. We've got the podcast, in-person interviews, tutorials, free webinars, key clips, and we'll only be expanding the resources we have on this channel. Our goal is to make this the one-stop shop, the best place to go for serious traders to learn and improve. And we're well on our way to do that. And you can help us reach 200K right now by clicking subscribe down below. It's 100% free, and thank you in advance. All right. And with that, thanks so much for attending day 2. Super excited for the next weekend. I'll be releasing details about the schedule and all that throughout the week. And we'll stay tuned about the conference resource that we're setting up, and all the VIP Pass members will have access to that. So thanks so much. Thank you so much for attending. Hopefully you guys are enjoying the conference so far. Let me know in the chat what you think. Again, who's been your favorite presenter overall? I'd love to hear it. And we'll see you next week for the next part of the conference. Stay tuned. Cheers.